morning. I'm Brian Zazi.
And I'm Alexis Christoforous, and this is a Yahoo Finance special report. The hotly anticipated December jobs report is out in less than a minute.
We're going to dive deep into this report from top to bottom to figure out what it means for your portfolio and the economy and what it could mean for Jay Powell and the Fed.
And it looks like this is going to be the final jobs report of the decade.
Yeah.
And we're expecting 160,000 jobs to have been added to the economy, looking for the unemployment rate to remain at that 50-year low of 3.5%. Wages going to be the big thing.
Alexis, I think this market wants to see a blowout jobs report. Just given how we've started at the year, stocks are at record highs. I would suspect anything under 200,000 will get sold.
You think so?
I do.
You know, the consensus is for 160,000. We've got Jessica Smith live at the Labor Department now with the numbers for us. Jessica, what do you have?
145,000 non-farm payrolls rose by 145,000, below expectations of 160,000. The unemployment rate at 3.5%, and wages missed expectations. Average hourly earnings rose by 3%. Rose by 3 cents to 28.32. That's a 0.1 increase month over month and a 2.9% increase year over year. Again, 2.9% increase year over year. Economists were looking for an increase of 3.1%. The average work week was 34.3 hours in December, and the labor force participation rate was unchanged at 34.3 hours in December. Labor force participation rate was unchanged at 63.2%. In some industries worth noting, retail added 41,000 jobs in December. Healthcare employment increased by 28,000. Leisure and hospitality added 40,000. Mining lost 8,000. Manufacturing lost 12,000 jobs. And we did have some revisions to the downside. November jobs number was revised down to 256,000 from 266. October was also revised down to 152,000 from 156. That's a total of 14,000 fewer jobs than previously reported. U6, the broadest measure of unemployment, was 6.7%. That is the lowest on record. And looking at 2019 as a whole, we saw 2.1 million jobs added compared to 2.7 million in 2018.
Thanks so much, Jess. We have two of the best in the business here to help break down this report. Christina Hooper is the Chief Global Market Strategist at Invesco, and Greg Dacko is the Chief U.S. Economist at Oxford Economics. Good morning to you both. Christina, let me start with you here. How disappointing is this number?
I don't think it's too disappointing. I mean, we're in an environment where the dominant factor impacting markets is the Fed. And the Fed has told us that it's going to keep rates pat. And in fact, what we heard yesterday from Neil Kashkari was that if we see inflation continuing to trend lower, he would be supportive of more monetary policy accommodation. So I think this is not that far off from what was expected in terms of non-farm payrolls, a little lower than expected in terms of average hourly earnings. And so that presents some possibility for some upside from the Fed in terms of accommodation later this year if the trend continues.
And if you take a look at the futures, they're not doing much of anything, pretty much the same as they were before this report. Does this mean that Wall Street was expecting that things had to slow down a little bit from the torrid pace?
I think in general, there's an expectation that we expect the labor market to cool somewhat. It was not sustainable to see job growth around 200,000 on a monthly basis. This job growth print is in line with an average that is trending gradually slower towards 165, maybe 150, in an environment in which, let's not forget, the U.S. economy is gradually cooling. We're no longer in an environment of 3% growth. We're in a 2% growth economy, and in that environment, we're likely to see some further downside in terms of job growth. It's not negative. We still have wage growth that's still around 3%. We have an unemployment rate that's at a 50-year low, and we're still adding jobs. We've added jobs for the past 9 years at a clip of more than 2 million each year. So that's a good labor market.
But Christina, is this the jobs report that investors really want to see? I think investors have been sold on this notion that the U.S. economy will reaccelerate in the first quarter. But I look at manufacturing down 12,000, and that, at least to me, that solidifies some of this weakness in manufacturing we've been seeing.
Oh, definitely. It's certainly not the best jobs report you could ever ask for. But I think that investors look at everything, including the crisis in the Middle East, through the lens of greater Fed accommodation. And so that really provides a safety net. I think it provides a cushion under stocks.
What about the fact that wages rose just 2.9% in such a tight labor market? Why aren't we seeing companies, offer more to get the talent they so desperately need?
Well, I think there are a couple of factors that are restraining businesses' ability to pay more wages. One of them is the fact that corporate profit margins have been squeezed and continue to be squeezed. And the other one is that businesses have limited pricing power. And in that type of environment, you're not going to see the surge in wage growth. If anything, we're expecting a gradual stabilization of wage growth around 3%. Let's not forget that for the past 18 months, we've had wage growth above 3%, which used to be a landmark in terms of achieving strong wage growth. We've been there for the past 18 months. There's been some moderation since February when we reached that 3.4% peak. Now just under 3% is not terrible. It's still enough to support income growth and support the main pillar of U.S. activity, which is the consumer spending.
Greg, what we've learned this week, at least from some of the Fed speak yesterday, this Fed remains very data dependent. Does this data suggest they might cut rates?
No. This will not suggest that they cut rates. I think the economy is in a good place, as the Fed has been accustomed to saying. Monetary policy is in a good place. But if we look into 2020 and see further job growth moderation and inflation continuing to undershoot the target, we believe that there will be space for some further Fed accommodation by mid-year. It won't happen at the next meeting in January. It won't happen in March. It's likely to happen later in the year as the Fed proceeds to what we believe will be a material reassessment of their outlook.
What about the participation rate holding steady at 63.2%? Is this what we want to be seeing at this point? I would imagine we'd see a rise in the participation rate if wages were rising materially.
Well, I think we have to recognize that this has been a very flawed jobs recovery. It took a very, very long time to get anywhere near normal. And, quite frankly, if we were to look at this economic expansion, the real laggard has been jobs up until recently. So we're still seeing the effects of that. Certainly, we'd love to see labor force participation better. But we're moving in the right direction in general in terms of trends. I think just a lot of the weakness that we're seeing today in the jobs market, the wage growth that's not near where you would expect it to be after this multi-year expansion, is really just a result of what we've seen in the early years of the recovery and how long it took to have jobs really participate fully in the recovery.
Greg, looking through this report, there is some weakness. We had good numbers in construction, up 20,000, but overall, do you think the Fed's actions, notably cutting rates 3 times last year, is that helping the real economy?
I think to some extent it is. Not so much via lower interest rates and via the traditional credit channel, but more via financial conditions. Let's not forget that 2019 was a year of headwinds. We had global growth that was slowing quite sharply. We had trade tensions that were on the rise. We had policy uncertainty that was elevated. And in that environment, every time we saw the risk of further tariffs, financial conditions tightened. What the Fed did was provide further accommodation to prevent this tightening of financial conditions after what was a pretty traumatic turn of the year in late 2018, early 2019.
What causes that rise in the stock market, I guess via the Fed, to be shown or to show up finally in a jobs report?
Well, I think to Christina's point, the fact that the markets believe that the Fed is there to help them and to provide accommodation if needed is what is supportive of stock prices at this juncture.
I just want to bring to everybody's attention a possible quirk in the wage component of this report because it has to do with the calendar. So this survey on wages is taken on December 12th. This year, payrolls happened on December 15th, but which they usually do, but both the 12th and the 15th did not land on the same week, during the same week. Could that have skewed things? And that's perhaps why we're seeing this 2.9% rise in wages when we were expecting 3.1%. I mean, we're splitting hairs, but do you think that we need to take that into consideration?
I think there can always be seasonal quirks in any payroll report, any jobs report. Let's not forget also that we've seen strong wage growth at the lower end of the income spectrum. Low wages are rising faster than higher wages. What does that mean for average hourly earnings? It means that it drags them down. So in this environment, it is not that surprising to see some slight downside in terms of wage growth, but we're still around 3%, 2.9, 3.1, doesn't really matter. We're still in this environment where wage growth is around 3%, and most importantly, this environment continues to support, along with job growth, income growth that is around 2.5%. And that's enough to support consumer spending growth around that 2.5%. That's the type of environment we need to prevent a sharp fall in the economy.
But this is also the kind of environment that has Taco Bell, because of the tight labor market, I would think it's because of the tight labor market, saying it's going to now offer its managers 6 figures, $100,000 to be a manager at Taco Bell. Do you think that speaks directly to the issue of the tight labor market, Christina?
I think it does. I think what we're seeing is a lot lot of retailers having difficulty sourcing employees. So it makes sense that at a certain point, when you have difficulty sourcing your, frontline employees, then you have difficulty sourcing good managers. I think this is part of what we're seeing in terms of a late-term recovery in jobs. I mean, this makes sense that we're seeing this kind of increase in wage pay.
Does the Taco Bell economy, I'm calling it the Taco Bell economy, does that spur inflation this year? When you're paying $100,000 to a Taco Bell employee to manage some restaurants, it seems like a lot.
Yeah, but I think we make a lot about these big figures because we're thinking about a fast food chain and some managers being paid that price. The key question is how broad-based this wage growth is. And as of right now, we're seeing low-end wages rising faster, which is very encouraging because it goes to people with greater spending power, in a sense, and that could stimulate consumer spending. In this environment, I don't expect to see much upside to inflation. We still have an economy that's cooling. We still have limited pricing power. We still have profit margins that are tight. I don't see businesses in this very cautious environment and uncertain environment going out and raising wages tremendously, and therefore the inflation wage push dynamic not rising that fast.
Are we going to see a pickup in capital expenditures this year? Because that was the big thing we didn't see last year. Is there any reason for businesses now to feel confident enough to start spending a little more?
Well, I think the Phase 1 trade deal is a very good reason for confidence to pick up because economic policy uncertainty has gone down. The problem is, will it get replaced with another form of economic policy uncertainty? And that's a very good question because there are some very significant possible sources. We have, of course, the U.S. presidential election. We have no idea who the Democratic nominee is, and we may not know for a long time. We also, of course, have the potential for the U.S. to turn its sights onto the EU in terms of extending a trade war with the EU. And of course, we also have the conflict with Iran. While it looks like it has died down for right now, if that were to amp up, especially given concerns about the potential for a cyber attack on U.S. companies, that could be problematic for business confidence. So I would expect, just based on Phase 1 getting done, that we would see some kind of increase in capital spending, but I see some possible headwinds on the horizon.
Christina, does this jobs report or all the jobs reports, do they matter anymore? I look at the futures here. The futures are not doing a lot, but I remember, let's say a year ago, you got this type of jobs report, stock market would have went straight down.
Brian, that's a great question. I think a lot of it has to do with the kind of assurances the Fed provided in the last quarter of 2019. What we heard loud and clear from Jay Powell was that the bar is very high on a rate hike. And so I think that definitely makes the jobs report less important. For sure.
Would you agree that it's low interest rates in the Fed that's really feeding this stock market?
The combination of the two is indeed providing some support to stock prices. And let's not forget, with the Phase 1 deal, we have reduced trade risks. That doesn't mean that the risks are off. I think we have to be very careful with the interpretation of that. But if you look at fiscal risk with the passage of a budget, if you look at trade risk with the Phase 1 deal and the USMCA, if you look at even the monetary policy risk with Fed support, those have all diminished. So we think that the odds of a recession, a downturn in the U.S. economy, have clearly diminished going into 2020, in large part due to this support from the Fed.
All right, Greg Dacko, Christina Hooper, thanks so much. Stick around. We'll get back with our conversation in just a moment. But first, we want to check in with Inez Ferre, who's down at the New York Stock Exchange with a guest this morning. What does your guest have to say about how the market is reacting here to this jobs report?
Alexis, I'm here with Mark Otto. And Mark, the market's not reacting too much to this jobs report.
Absolutely. We came in this morning, the futures were up. They're still up 50 to 60 points right now. There's been a little bit of a disappointment with these numbers. We came in at 145,000. The estimates were 160,000. And for the hourly wages, we were looking for 3.1%. They came in at 2.9%. Slight disappointment, but it's not impacting the futures.
As far as the wage growth miss a bit, what are we seeing there with regard to skilled labor? And we were just commenting on this just a minute ago.
Yeah, so what we saw in November was unskilled labor outperformed by 3.7% versus 3.1% overall. So you have to remember, it's that time of year, it's seasonal, so the holidays, a lot of retail in particular, they boost up their workforces. So what we are seeing, though, in the headlines that's relevant is, for example, Taco Bell is now saying to retain skilled labor, they're willing to pay up to 6 figures later on this year for jobs that are now paying 50 to 80,000. So what we're seeing is the field of skilled labor is narrowing, which may make corporations or businesses pay up for their skilled labor.
And we're seeing that we're on watch here, really, for 29,000 on the Dow. Is this a pivot point?
Oh, we're about to find out, right? So one trend that we saw in 2019 was that every dip was a buying opportunity. The market reverted back to record highs, and what we're seeing is the same thing now. This week is a perfect example. It's been a crazy week with geopolitical tensions between the U.S. and Iran. So the market's taking that in stride, and this dip is once again proven to be a buying opportunity. So I'm optimistic for the market going forward. I think in 2019, people underestimated both the economy and the market.
Thanks so much, Mark. Alexis, Brian?
Ines Ferre, thank you. Hang with us. We'll have much more on the December jobs report right after this quick break.
This Yahoo Finance special jobs report, taking a look at the stock futures. Not moving a lot, barely at all, really, after this somewhat disappointing jobs report. And we want to get over to Heidi Chung now for the latest at the Wi-Fi Interactive Board on just why the market may be reacting the way it is. Heidi?
Good morning, Alexis. Yeah, all eyes this morning were on that December jobs report, but taking a look at the futures here, like you mentioned, we weren't seeing a ton of action initially, but we did take a bit of a leg lower here. It seems as if investors are digesting this slightly softer than expected headline print. So I want to go over some of the main numbers here for you. In the month of December, the U.S. economy added 145,000 non-farm payrolls. Economists were expecting about 160,000 jobs there. The unemployment rate held steady at 3.5%. Of course, that is a 5-decade low. And the average hourly earnings actually disappointing a bit and ticking lower, growing about 0.1% month over month and 2.9% year over year. But I want to take a look at the other major indices as well here. The Dow futures still indicating a strong open, up about 24 points this morning. And the NASDAQ futures here also higher. So we will be paying close attention to how these major indices open. But of course, yesterday's session, all three of the major indices closed at record highs. Now, gold actually getting quite a bit of a boost after this report. As you can see here, this big jump higher. We're seeing per ounce right now, $15.57 per ounce. Now, of course, we have to take a look at the 10-year. We did see the bond market rally a bit. We have the 10-year here down about 2 basis points at 1.84%. Alexis?
All right, Heidi Chung, thank you. So what does this jobs report do to the Fed's thinking ahead of its meeting later this month? Our very own Brian Chung is in the newsroom to explain just that. Brian, worse than expected jobs report, some are calling it mixed, but the headline didn't come below expectations, and some weakness in manufacturing. So where is the Fed's thinking right now?
Well, the Fed's thinking is actually not in the headline number or even the headline unemployment rate for that matter. I had the chance to ask Jerome Powell, the chairman of the Federal Reserve, this exact question in the Fed's last meeting that was on December 11th, so well before this report. But I said, what is it about the jobs and the labor market that you're looking at closely? And he said, it's all about wage growth. He said, quote, at the time, the labor market is strong. I don't know that it's tight because you're not seeing wage increases. Ultimately, if it's tight, that should be reflected in higher wage increases. So the big number to watch in this report is really that 2.9% year-over-year wage growth figure. That was a tick down from some estimates that I had seen on the street. A lot of shops, their economist teams were basically saying they would expect maybe about 3%. So it did fall just a tick short. Doesn't necessarily mean it's a meaningful miss on estimates on the street, but is kind of notable because it says, hey, actually the labor market might not even be running even as close to as tightly as maybe some had expected originally. This doesn't necessarily mean that the Fed needs to cut at this time, but at least at a baseline, it says the Fed will probably stay steady at the current range of 1.5 to 1.75% on rates.
All right, Brian Chung in the newsroom. Thanks so much. Christina Hooper, Greg Dacko back with us again. You just heard Brian's report. Greg, I'll toss it to you. Are you in agreement? Does this report basically put no pressure on the Fed to move on interest rates?
I think this report is in line with the Fed's view in general, broad view that we have an economy that is still in a good place. We still have a labor market that's delivering a steady amount of jobs on a monthly basis. The 12-month moving average has cooled somewhat, but is still in the 180,000 jobs being added on a monthly basis. We've added, again, for the 9th consecutive year, more than 2 million jobs. So we're still in a very strong labor market. We've added jobs every consecutive month since October of 2010. So it's been 111 months of this strong labor market. That is still good enough. That is still strong enough to support an economy that is growing at that 2% clip. Whether the Fed provides further accommodation will be determined in early 2020. Not so much just now, but by the middle of the year when we get more information as to how the economy is faring in the first quarter of this year.
Christina, is this report bullish for President Trump's reelection?
I think it certainly helps because what it tells me is that the Fed is going to be even more laser focused on inflation and hitting inflation targets. So it will be more inclined to be accommodative. I think what we expected going into this year is that the Fed would hit the pause button and that we wouldn't see rates go higher and we wouldn't see rates go lower. Now it looks as though the tilt is towards rates possibly going lower if we see more jobs reports like this one. Mm-hmm.
Let's dive into where the jobs were added last month. Retail, 41,000. Mm-hmm. Is that a surprise to you? I mean, I know December can be skewed because they bring on, or especially retail brings on more workers for the holiday season, but this still seems to be a high number.
This is a good number for the retail sales sector, unusually high. We've seen a lot of weakness in the retail sector. Payrolls for the retail sector had been declining over the past 12 months. So this is a very encouraging report for the retail sector. Now, I do believe that there might be some seasonal effects to that, and maybe a weak year last year tweaked the seasonal adjustment so that this year we're artificially high in terms of the payroll print. We'll have to see what happens in January, because I wouldn't be surprised that this reverts back to this sluggish trend in terms of the retail sector. Retail is really not where we're adding jobs. We're adding jobs in other sectors, in leisure and hospitality, in education and healthcare, and in transportation and warehousing, where a lot of the Amazon purchases are filtering through.
Right.
What's the outlook for jobs reports looking out over the next decade? Obviously very hard to predict, but the days of 300,000 plus on the headline, are those days over?
Yes, I think the days of 300,000 jobs are over. I wouldn't be as pretentious to know what will happen over the next decade, but over the next year, I think we're going to see a moderation in terms of job growth. We're no longer going to see even 200,000 jobs being added every month. We're looking for job growth around 150, maybe slightly under that in the first half of the year, and ending the year, I think, closer to 100,000 than 200,000.
So 100,000, is that the new 300,000?
Well, I think it's good enough because you have to remember that what matters at this stage is whether we're matching the pace of growth of the labor force. Mm-hmm. And when you have statistics like the labor force participation rate at 63.2 and being very stable despite the drag down from structural forces of the aging of the U.S. population, that is still a very good number. And let's not forget that in this environment, you still have an unemployment rate that's at a 50-year low. So there's a lot to be happy about. There's still potential to increase employment. We're not quite yet at full employment, I believe, but we're getting close to that environment. And in that environment, it's hard to find the right skills.
We also have that U6 rate, the underemployment rate at 6.7%. That is the lowest on record. This includes what, discouraged workers who are no longer looking for work, part-time workers who want to be full-time. What does that U6 number tell you this month?
Well, that tells me that there's a lot of optimism about the job market. And so those that are disaffected are back in the search and are actually finding jobs. So those are all good signs. But those are also, I should say, late cycle signs. Now, the beauty of this expansion has been that it has lasted so long, and we don't expect a recession this year. So we're likely to see the continuation of these kinds of moderated jobs reports, but still positive for the rest of this year and going into next year. All good signs that we're probably going to see labor force participation go up from here.
Greg, what is it about the U.S. economy at this stage in the cycle where it could shake off a year of trade war headlines and now more recently impeachment headlines?
Well, I think what's very important is what the Fed is doing. The Fed is providing accommodation. It's providing a buffer against some of those headwinds. The insurance cuts that were initially approached by Clarida and referred to back to the late 90s or the mid 1990s are what the economy needed at this stage of the business cycle. We're in a late stage business cycle in which headwinds and a number of uncertainties can drag down growth. So having the Fed standing by, watching data, watching policy developments, and standing ready to provide further accommodation is really what is needed for this type of economy. We're in a soft landing mode, or at least that's what the Fed is trying to do, and having the Fed standing by the economy is essential at this stage.
What about manufacturing? Lost 12,000 jobs last month. Were you surprised by that?
Not at all, because I think of manufacturing as being on the front lines of the U.S.-China trade war. And so that really has had an impact. We probably should see some improvement in coming months if we do see that phase one trade deal signed. But that was really collateral damage with the trade wars.
You know, something else we saw was the wage gap was quite large between non-supervisory positions and supervisory, meaning managers were, the pay raises for managers were much smaller than those for their underlings, if you will.
Yeah.
Why do you think that is? Because it's been a trend we've been seeing over months now.
Well, it tends to be the case that employees that are not managers, their wages and their salaries tend to evolve generally in a cyclical manner, in a manner that reflects the underlying pace of the economy. So if the economy is doing well, if businesses are doing well, then they tend to remunerate the employees of that company. Managers, it's a little bit different. Remuneration can depend on very sector-specific developments, and what we're seeing is that in some sectors, we're seeing some moderation in those earnings. But overall, I think we're still in this environment where you have enough wage growth to support disposable income growth for the overall economy. And that, again, I come back to this point again and again, but that is essential to support the main pillar of U.S. and perhaps even global activity, which is the U.S. consumer.
Real quickly, how much credit does the administration deserve, tax cuts and fewer regulations, for this jobs market?
I think little at this stage. I think the tax cuts were a thing of 2018, to some extent 2019, but not really. The corporate tax cuts might have filtered through to 2019. We did see some increased government spending in 2019. We're going to see some further increases in 2020. But on the margin, on the whole, it didn't really jolt the labor market to the extent that we would still see it today. It might have in 2018, but that's gone. This is 2020, and the fiscal stimulus is no longer there to support the economy.
Big morning, to be sure. Greg, Christina, stick around. Don't go anywhere, folks. We'll have much more on the December jobs report here on Yahoo Finance right after this brief break.
Good morning, everyone. I'm Alexis Christoforous.
And I'm Brian Sozzi, and this is the first trade for Friday, January 10th.
Staying strong, but below expectations. The December jobs report shows steady growth, even though the top line number fell a bit short. We're digging into the latest snapshot of the economy.
Bad attitude at Boeing. Internal documents show workers trying to trick regulators and cover up potential issues with MAX 737 jets. That is while investigators increasingly think that Ukrainian jet was shot down in Iran. We have the latest.
And special delivery. Grubhub slides here in the pre-market, insisting it is not for sale, even as rumors swirl that Walmart could get in on the bidding. How this drama is playing out in the delivery wars.
Let's get a quick look at the futures here ahead of the opening bell. Some mixed action off the latest jobs number, which was worse than expected, 145,000 increase. Dow futures up about 21 points. The S&P 500 and NASDAQ slightly in the green.
And we have to start with that big December jobs report.
December's jobs growth came in a little below expectations. There were just 145,000 jobs added last month. Strong, but not quite as strong as the market had been hoping. Unemployment is holding firm at 3.5%. Let's get right to Jessica Smith at the Labor Department. Jess?
Brian, wages missed expectations a little bit as well. Average hourly earnings rose by 3 cents to $28.32. That's a 0.1% increase month over month and a 2.9% increase year over year. Economists were hoping to see a 3.1% increase year over year. And looking at some of the industries worth noting, retail added 41,000 jobs in December. Healthcare employment increased by 28,000. Leisure and hospitality added 40,000 jobs. Mining lost 8,000 and manufacturing lost 12,000. The labor force participation rate came in at 63.2%, and we did have some revisions to the downside. November, that number was revised down to 256,000 from 266. October also revised downward to 152,000 from 156,000. That's 14,000 fewer jobs than previously reported. In U6, that's the broadest measure of unemployment, is down to 6.7%. That is the lowest on record since the series began in 1994. And then looking back at the year as a whole, in 2019, there were 2.1 million jobs created compared to 2.7 million in 2018. Brian and Alexis.
All right, Jessica Smith live for us at the Labor Department. Thank you. Emily McCormick is in the newsroom this morning. And Emily, not a big reaction, hardly any reaction at all here to this jobs report for stocks. What's going on?
That's right, Alexis. We had a mostly muted market reaction both on equities and various assets, just as we had this jobs report crossing at 8:30 a.m. ET. So we have Dow futures first briefly erased gains just a couple of minutes ago, but we have them back up in the green now. S&P 500 futures still on pace to open at a fresh record high, just slightly above yesterday's intraday high levels. Crude oil prices and gold both edging slightly lower, and Treasury yields just slightly higher across the yield curve. I want to dig a little bit in on that wage growth number coming in at just 2.9% gain year on year. That's the first time this has been below 3% since July 2018. We saw a slowdown in wage gains really across industries. That was in construction, manufacturing, education and health services, and leisure hospitality. All of those saw their wage gains decelerate, and we actually saw pay decline year on year for mining and trade and transportation industries. Neil Dutta, head of economic research for Renaissance Macroeconomics, really had a good quote about this. He said he thinks the important thing here is that there is not much pressure on margins from this report. Wage growth cooled for both supervisors and non-supervisors. And what this is telling you is that we're going to probably see less margin pressure as we head into corporate earnings season for the fourth quarter, kicking off in just a couple weeks. Brian and Alexis.
Emily McCormick, thank you. Let's bring back in Greg Dacko, Chief U.S. Economist at Oxford Economics. Greg, good to have you back here. One number that stood out to me, and this comes from Peter Bookvar at Bleakley Advisory Group, wage growth year over year, 2.3%, slowed from 2.8% the prior month. Does that suggest that the Fed is right to not only stay on hold, but maybe leave the door open to another rate cut?
I think the Fed has all along said that it's ready to cut if needed. Mm-hmm. It needs a material reassessment of its outlook. In the current environment, I don't necessarily see this payrolls report as an indication that the Fed needs to cut right now. Mm-hmm. But if we continue to see an environment in which wage growth slips, at the same time as inflation undershoots the 2% target, and the labor market shows further signs of weakening, then the Fed might have to intervene. And it is our view that in an environment in which the economy is expected to grow about 1.7% this year, that would support a further rate cut in June of this year.
We also saw revisions lower for the prior 2 months by about 14,000. What does that tell you at all, or does that concern you? Should we be concerned?
I think not excessively, because we had seen some upward revisions over the past few months. So this minor revision of 14,000 is not a big concern from my perspective. I think what's important at this point is that we have a labor market that is showing sustainable signs of ongoing growth. A labor market that is adding just enough jobs to maintain the unemployment rate at a steady level of 3.5%, which is a 50-year low, and enough wage growth to still support disposable income growth. That is key at this juncture. You want a sustainable labor market that is not putting too much pressure on businesses to pay higher wages, because productivity is not rising that fast. And in that type of environment, that's a big concern for margins.
All right, Greg Dacko, thanks as always for being with us on Jobs Friday. And stay with Yahoo Finance. We'll get the White House's take on this jobs report when Peter Navarro, Director of Trade and Manufacturing Policy, joins the final round. That'll be happening at 4 p.m. Eastern, right here on yahoofinance.com, as well as on our app. Internal memos from Boeing are out this morning showing some harsh criticism of the problems surrounding the 737 MAX jet. Alexis Keenan is on the Boeing beat, and she joins us now. All right, did you get a look at these documents? What do they say?
Yeah, there are about 170 documents.
You got a lot of bedtime reading.
A lot of emails. As you said, these are internal emails between Boeing employees. Some of them are pilots. One of them we know to be Boeing's then chief technical pilot at the time of these emails. The documents were released at the urging of congressional members. This is part of the same group of documents that we heard about in the latter half of the year last year, and that Congress was really concerned about the criticisms that Boeing employees were making about the 737 MAX program. The time frame is between 2013 and 2018 for these communications. Most of them are emails. And in those documents, they express concerns about specifically the simulator program for the MAX. Okay, that's the simulator, the physical thing that pilots can go in before they actually fly the aircraft. So listen to what the employees were saying. I'm going to read a few different passages. Like I said, there's a lot of documents here, but here's one 2018 exchange between Boeing employees talking about these problems with the simulator. Would you put your family on a MAX simulator trained aircraft? I wouldn't.
Oh, wow.
Another one from a Boeing employee. This airplane is designed by clowns who in turn are supervised by monkeys. Another 2018 email, this one coming from a management pilot at Boeing to a coworker saying they're concerned about some prior work. This one saying, I still haven't been forgiven by God for covering up I did last year, perhaps a word missing there. Can't do it one more time. Pearly gates will be closed.
These seem damning.
Really damning. And, Boeing is saying in response that these are completely unacceptable, these exchanges. They say that they regret this content and that they are apologizing to the FAA, to its consumers, and to the flying public. But, this is at a time when Boeing's really concerned that the simulator would be required, not only by the FAA, but that customers would want it. And they were really having trouble at this time making the simulators work as they wanted to. Boeing has also said that these exchanges happened early on in their attempts to get the simulator process right, but these are pricey enterprises. They just in Southwest's contracts alone, according to a lawsuit that Southwest filed against Boeing, they said that they had an agreement with Boeing that they would get a $1 million rebate on each plane if simulator training were required.
Cultural issues at Boeing clearly run very,
It's not
very
about
deep.
money, it's about
Very
lives.
deep.
This is really troubling. All right, thanks so much,
Thanks
Alexis.
so much, Alexis. Coming up here on The First Trade, Aurora Cannabis shares are really taking a hit, and investors aren't feeling too good about it. Time for one of today's Yahoo Finance trending tickers. Shares of Aurora Cannabis are stumbling after a bad hit from analyst Michael Lavery at Piper Sandler. He issued a $1 price target on the stock. Ouch. And he downgraded the pot producer to the equivalent of a sell reading. Definitely not a TGIF for Aurora Cannabis, Alexis.
Yeah, I'd say so. I mean, look at 2019 for this. I mean, I don't mean to laugh, but I mean, the stock was down more than 65% last year. This is not exactly a bold move on the part of the analyst at Piper Sandler. The stock is at about $1.70 now. He's saying it's going to go down to $1. And he's saying they have serious cash flow problems. You have to wonder whether or not Aurora is going to be around this time next year. Perhaps they get eaten up by a larger competitor.
Well, I will say this. I will give them a shout out on the positive side. Their financial releases, the overall press releases, look very pretty. They have a lot of good pot plants on there, very nicely done. But to your point, there has been a debt explosion at Aurora Cannabis the past couple years.
Yeah.
And I don't think, it's not just Aurora Cannabis here. The whole pot sector has been completely obliterated the past year. For these stocks to work again, they're going to need federal legislation to come through in their favor.
There is some good news. Vaping, edibles, all were okayed in Canada in December. So we'll see if that starts to trickle down for some of them this year.
I ain't touching stuff.
All right, that's good. I'm glad to hear that. Time now to head to the New York Stock Exchange. Check in with Yahoo Finance's Inez Ferrer for a look at what is going on. There is plenty going on. What have you got for us, Inez?
Alexis, Eli Lilly will be acquiring the biopharma company for skin conditions Dermira for $1.1 billion or $18.75 a share. And I should note that Dermira has been on a tear over the last couple of months. Back in October, it was trading at around $5 or $6 a share. In December, the company received a fast track from the FDA for one of its therapies. We're also this morning watching Grubhub under pressure, giving back some of the gains from earlier this week after reports that it was considering a sale. Well, Grubhub has come out with a statement denying those reports, saying that there is no process in place to sell the company and currently no plans to do so. This morning, Grubhub giving back the gains from earlier on Wednesday when it was up more than 12%.
Inez Ferrer, thank you.
Thank you.
Let's get a look now at European markets. Mixed action overseas. The FTSE 100 down slightly. The CAC 40 slightly in the red. And the DAX slightly in the green. Yahoo Finance's Edmund Heafy joins us from London now. Edmund, UK average household debt hit a record high last year. What's going on there?
Well, Brian, what seems to be driving it really is that the UK has been contending with years and years of slow wage growth. And then there's also been a rise in precarious and insecure employment. The view of the union that produced this analysis is not that households are borrowing to keep up with the Joneses, but rather they are borrowing to scrape by. Total household debt, excluding mortgages, reached £407 billion in the third quarter of 2019, which is 30% higher than its financial crisis peak. And then debt as a proportion of household income is also above its crisis peak, hitting 27.5%.
And Edmund, of course, the story we are all talking about here, I'm sure you are big time over there, the ongoing drama with Meghan Markle and Prince Harry stepping back from the royal family. What is the latest there, and what's the mood like there?
Well, yes, Alexis, we're into day 3 essentially now of this story, and it has still gripped the nation here and is still dominating the front pages of every media outlet. What newspapers here are reporting today is that Prince Charles, who is the heir to the throne and Prince Harry's father, he's considering withdrawing the grant from his household that Prince Harry and Meghan Markle get, and that amounts to about £2.3 million.
That's a lot of money to leave on the table. All right, we'll be continuing to follow this story. Thanks so much, Edmund Heafy. Let's take a look now at what's happening in Asia. Here's Yujing Liu from the South China Morning Post.
Hong Kong and China stocks posted small gains this week. The Hang Seng gained 0.7%, rising for a 6th week in a row. The Shanghai Composite was up 0.3%. Several factors boosted the market. First off, China confirmed Vice Premier Liu He will fly to Washington next week to sign a trade deal with the U.S. Meanwhile, Washington appears less likely to engage in a full-blown war with Iran. Earlier, data showed China's consumer inflation steadied in December, giving more hope for further monetary easing. A severe pork shortage has pushed inflation to an 8-year high. The problem will only become more acute in 2 weeks' time over Lunar New Year, as pork is vital to Chinese family dinners. Looking ahead, China's official 2019 GDP figures will test the market next Friday. Beijing is likely to meet its target of 6 to 6.5% growth. That's all from me in Hong Kong. Back to you in New York.
Escalated tensions between the U.S. and Iran from this week have U.S. government officials on high alert for Iran's most likely form of response, cybersecurity attacks. GenTrust Chief Investment Officer Jim Besaw joins us now to discuss. Jim, good to see you here. And interesting notes from you. You actually model cyber attacks in as a key risk to your portfolios. Why are you taking that action right now?
Yeah, we've been doing that for a while. I think that it's certainly more relevant after the last week's events in Iran. We had kind of put an estimate of cyber attacks around 2 or 3% as of last year, the year before. We've elevated those to about 5%. And the way that we think about cyber attacks are things such as something that causes widespread drop in confidence across the general populace. So things like a compromised bank account numbers at a large institution that forces them to close for a period of time.
As you take up that risk component in the portfolio, are there certain stocks that you sell?
Not necessarily, no. I think what it helps us do is think about the risks of client portfolios more broadly. So certainly a cyber attack would have different impacts on different sort of asset classes. So gold would probably be positive. Things like treasuries would probably be positive. Certainly equities would be negative, and probably more negative in the country that's the most affected. So what allows us to do is make sure that our clients are not overly exposed to that sort of event.
Jim, do we also have to worry about copycat cyber attacks, maybe extremist individuals who say, oh, good, now I can go ahead and do this under the guise of it being Iran?
Exactly. Yeah, no, I think that's when we model cyber attacks, we're not necessarily saying this will definitely come from Iran. We're thinking of it more broadly. But your point is exactly right, that this kind of gives other potential cyber attackers a veil to come in and say, North Korea or Russia or Ukraine. It allows them more cover to potentially make those attacks and be able to have the populace think it might be coming from Iran.
Have you added any specific stocks based on increased cybersecurity risk? No,
I think what we've done is not necessarily on the stock side. What we've done is we've added more protection to portfolios. So we're one of the few places that I know of that has been long fixed income for a period of time, which worked out fairly well last year, even though stocks did much better. So not shying away from the safety assets for client portfolios. That's basically what we've been trying to do at GenTrust.
So you haven't plowed into cybersecurity stocks because that's what we've been seeing. We've been talking about it all week.
We've been seeing a big rise in them this week.
Yeah, it's a bit tricky. I think that we're not stock pickers, so we're not looking at individual stocks. Certainly, cybersecurity as a broad sector is something that's very interesting. I think there will be a lot of winners and losers in that space. And because it's such a fast-growing space, you'll see more volatility.
What would make someone a winner in that space? It is a crowded space right now.
Yeah, I mean, I think it depends on what the threat is. So, for example, if there's some sort of, whether it's a malware threat or some sort of unique thing that a company is particularly well suited for. Think of the Ebola incident. Nobody knew that the handful of companies that were creating vaccines for Ebola would be the winner in some sort of event like that, yet they ultimately prevailed. So because you don't necessarily know in what form the attack will come, it makes it difficult to pick individual securities. So having a broad-based approach where you're owning more of the whole sector makes a lot more sense in our opinion.
All right, Jim Besaw, thanks so much.
Thank you.
Coming up here on The First Trade, will House Speaker Nancy Pelosi take the next step in the impeachment process? That's next in your News Bites. take a look at today's News Bites. House Speaker Nancy Pelosi may be gearing up to finally send the articles of impeachment against President Trump to the Senate. The New York Times says Pelosi could announce her plans as soon as today. She's been holding out until the Senate details its plans for an impeachment trial. Senate Majority Leader Mitch McConnell has signed on to a resolution to dismiss the charges if the articles aren't delivered soon. President Trump is now saying that the U.S. and China may sign that Phase 1 trade deal shortly after January 15th. Trump originally announced the deal would be signed on the 15th in a tweet posted in late December. China's Vice Premier Liu He will head to Washington next week to sign that deal, which is expected to reduce tariffs and boost Chinese purchases of American farm goods. And nearly 250,000 people are being told to evacuate their homes in eastern Australia. That's because winds are picking up and spreading that devastating wildfire. Temperatures are expected to climb well above 104 degrees. Over 15 million acres have been burned, killing at least 24 people, millions of animals, and destroying roughly 2,000 homes. We have the opening bell coming up here on The First Trade. But first, here's a look at the action in overseas markets. Mixed market there. We'll be right back. Welcome back to The First Trade on this Jobs Friday. We're about 3 minutes away from the opening bell. Stocks have some modest gains, a muted response to that somewhat disappointing jobs report this morning. Let's go around the bell with Christina Hooper, Invesco Chief Global Market Strategist, and Ralph Bassett, Head of North American Equities at Aberdeen Standard Investments, along with Yahoo Finance's Heidi Chung at the Wi-Fi Interactive Board. Good morning to you all. Ralph, I'm going to start with you. Christina was on with us in the prior half hour, so we know her thoughts. Want to get your thoughts on this jobs report today.
Yeah, I think bluntly our expectations were that we would see some moderation of jobs growth into the year. But the interesting thing from my perspective is the whispers that we heard coming in were actually much higher than even the baseline result that consensus had. And so the fact that we've disappointed, I think, obviously is being factored into what we see in futures. And obviously the counterbalance there is what does the Fed do on the back of that? And I think that's what the market's trying to grapple with.
What does the Fed do on the back of that?
Yeah, I think our baseline view would be that we're not going to see action immediately. And certainly there's a meeting this month. And we heard the vice chairman come out yesterday and suggest that we still are seeing or witnessing strong economic growth. So I think, if anything, gives them ammunition in the back half of the year.
Christina, as long as the Fed appears to be in play with this notion that, yeah, they remain supportive of the economy, and I would say the stock market too, even when they won't acknowledge it, the buy the dip mentality, will that stay intact?
I do think it will, unless we have some other kind of concern that pops up. But even there, we saw with the Iran crisis that was not a deterrent. In fact, that certainly was an environment where a dip that was created brought investors in.
This is a Teflon market.
It's pretty close to a Teflon market, but keep in mind that is what the Fed has created by really communicating in, I think, very, very clear terms that the bar is very high on raising rates.
Is there any sign out there to you, Ralph, that we are at a peak, that there's something that's going to prevent this market from going higher? Because we saw it push through the Iran situation, the trade policy issues. It just seems to be breaking record after record, defying what we all would, defying logic really, with all of these headwinds.
I would say our caution is really whether earnings growth comes through this year or not. And I think, we've been telling clients we're constructive but cautious on that front. And so there's obviously been monetary accommodation. We had some relief on the trade front, are likely to see that ratified next week. And so if we don't see earnings growth come through, I think that would really, in the middle of this year, cause some concern for markets.
How big a problem is it that the U.S. economy doesn't appear to be accelerating? I would argue that is what has sent the market up, at least higher over the past 2 months.
So I don't think anyone was looking for acceleration. I think if anything, it was stabilization. So there is a natural kind of decline in the GDP growth rate, and we've seen that in 2019. And I think for 2020, our estimates are right around 2% or just below at this stage. So good growth, but certainly not an acceleration, albeit the underlying factors that are driving that are certainly better in our view than they were 6 months ago.
Yeah.
And the opening bell has been rung at the New York Stock Exchange and the NASDAQ. The narrative is sort of the same, right? I mean, we saw indices in the futures hovering around these levels before the jobs market, before the jobs report, after the jobs report, the Dow now up 15. What about the first quarter, Christina? What are some of the sectors you think investors need to be in?
Well, in the first quarter, what we can assume is going to happen is that we remain in a stable growth environment. Perhaps we see some moderation in growth. And typically that's an environment that favors secular growth sectors. So I would favor technology. I mean, I'm long-term positive on technology, but I think technology should be a good performer in the first quarter.
We saw Apple hit another record yesterday, just one of many tech stocks that have really been sort of off the charts. Do you expect things to continue for the FANG stocks this year? Do you think it's going to be a good year for the FANG stocks?
Well, I do if we see that modest growth to slowing growth environment. But there's one caveat, and that, of course, is the U.S. presidential election. And we've already seen some volatility, in particular in tech and healthcare, as the fortunes of different Democratic candidates have risen and fallen. So I would expect that will continue. Certainly, high-profile primary results should have an impact on these sectors. So we should expect more volatility.
Heidi, busy day for you over at the Wi-Fi Interactive board.
A lot of action, Brian, yeah, but of course here, as you can see, all three of the major indices actually opened higher, but we had the Dow just now flip into the red, down about 4 points here, but the S&P 500 as well as the NASDAQ composite here at record highs. So the Dow, of course, was flirting with that 20,000 or 29,000 level that we have been watching very, very closely, but I want to take a look at some of the commodities very quickly, specifically gold here, because it was getting a boost, a very solid boost before falling again. Right now we're at about $15.53 per ounce, but of course you can see the volatility right there. I want to take a quick look at the 10-year Treasury yield as well. We are down about 1 basis point, holding steady at that 185 level right there. Let's take a quick look at what's moving within the indices, though. The Dow Jones here, we have a lot of green on the board. We have Intel, Merck, and Pfizer leading the way higher. And on the flip side, we have Home Depot, Walmart, and Travelers lower. Let's take a look at the sectors here in the S&P 500. Again, a lot of outperformance here. We have healthcare, utilities, tech, and real estate leading the charge. So it's kind of a mixed picture here. But when we take a look at what's lagging, of course, it's energy. Energy continue to not get a solid bid here in the session.
Thanks so much, Heidi. Christina was talking about liking cyclicals and tech going into the new year. You actually came with some stock picks that I wanted to get to, and one of them is Charles Schwab. Interesting, the brokerage industry continues to consolidate. Charles Schwab, of course, coming together with Ameritrade. Why are you bullish on Charles Schwab?
So the issue Schwab as a stock has faced is really in 2019 the shape of the yield curve. They obviously have a lot of float income, and I think twofold. One, into 2020, assuming we get approval of the deal, that will drive cost synergies for the business and really make it a leading platform. And so they've already reduced commissions to zero. We're going to see an influx and a continued influx of assets into an RIA-like model and robo-advisory model that Schwab offers. But really the driver is, from our perspective, the cost savings paired with the revenue synergies, and that will be basically assets coming onto their balance sheet from TD over time. We're also constructive on the fact that the valuation really, in our mind, is not implying that upside just yet. And so in a world where we're contending with what's happening next month, next week with the shape of the yield curve, that's why we're placing a bet on Schwab.
You also like Kansas City Southern, a railroad. Does this jobs report support a stock like that?
So as you know, the kind of consensus cyclical trade is in fashion now, and so we're really approaching that cautiously. But Kansas City Southern is one that we think has very stock-specific drivers. Again, they're implementing PSR, which is precision railroading, really driving down costs.
Hunter Harrison, right?
It was initiated under Hunter Harrison. Yeah. Unfortunately, he's, as you know, no longer with us. But indeed, also the USMCA is a benefit to them. 40% of their volumes are cross-border. And so all this really, in our mind, is really solidifying the revenue picture for them. And we think that the stock has upside, roughly 20% from here.
Okay, I want to get to one more of your stock picks, and that's in the cloud space. Five9.
Yep.
Yeah, talk to us about that.
So we really saw Five9 from one of its larger competitors, NICE Systems, which is an Israeli company. We have a very large presence in small cap stocks, and Five9 is a leader in contact center software. So essentially, as companies focus more on the experience for the customer, they're a native cloud player and really are seeing demand accelerate. And we think this company has the ability to scale margins over the next decade, but they're investing aggressively right now to drive those volumes of customers.
Christina, we just put Ralph to work with a lot of pitches. What's the ultimate play right now in this type of environment? Is it value or is it momentum?
That's a great question. What I would say is that it is probably low volatility because we're in an environment where we're likely to see heightened volatility. So the opportunity to participate, because we know that the Fed is very supportive of the stock market, but also tamp down volatility for those who are particularly sensitive to it, I think is very important. Volatility, low volatility as a factor has performed quite well.
All right, Heidi, you've got to look at what's happening there in the Dow, which has actually turned into the red.
Again, Alexis, it was actually fluctuating a bit and seesawing between positive and negative territory. And as we're looking right now, it's down about 22 points. But all three of the major indices did hit a record high at the open. But the NASDAQ and the S&P 500 are holding on to those gains here. Now, I want to take another quick look at the sectors in the S&P 500 to see where the action is. Again, we're still looking at the same sectors that we were earlier. We have healthcare, utilities, technologies leading the charge here. Energy, the worst performing sector in the S&P 500 this morning.
Ralph, why do you think the market is selling off on the jobs report? Is there a number in there? Is it the weak wage growth? Because I see the weak wage growth, and it tells me maybe the Fed's actions aren't doing what they're supposed to be doing.
I think it's the uncertainty of what is going to happen as a result from the Fed. So in other words, we don't have the clarity yet as to how their actions might underpin growth in the back half of the year. And so I think, while this jobs report, was disappointing relative to expectations, I think broadly speaking, it's still supportive of what we view to be, consistency in economic growth. So I think, if anything, it's just kind of a reverberation of where expectations were heading into the report.
Were there any real surprises for you? It seems like there weren't for Wall Street, the way stocks are reacting to the report, but anything really stick out to you?
Well, I was surprised that wage growth was below 3%. That came as a bit of a change from what we have seen in terms of the recent trend. But again, not outside of the realm of what could normally be expected. So nothing huge, but I do think that certainly gets the Fed even more laser focused on how it meets its inflation target.
Do you expect some change in statement when the Fed meets later this month?
I don't. I think they've done their modifications, and I think they're very comfortable with where they're sitting today. But I do believe that the focus will be on the next few jobs reports and what we see in terms of wage growth there, as well as, of course, as other inflation metrics that the Fed follows.
All right, we'll have to leave it there. Christina Hooper, good to see you. Ralph Bissett, welcome to the Yahoo Finance family. And Heidi Chung, thank you. We're a few minutes into the trading day. Let's see what Inez Ferre is watching down at the New York Stock Exchange. Inez?
Brian, and we're watching Elanco Animal Health. This is a company that spun out of Eli Lilly back in 2018. Its earnings guidance for 2020 came in below what the street was expecting. The top end of their revenue guidance, though, for 2020 came in line. And the company also did give an update on the acquisition of Bayer Animal, saying that it continues to advance. They recently received antitrust clearance from China, and other jurisdictions worldwide are also reviewing that acquisition. And Eli Lilly we're watching this morning. This is after the company announced that it will be acquiring the biopharma company for skin conditions, Dermira, for $1.1 billion or $18.75 a share. Dermira back in October was trading around $6 a share. In December, it received a fast track from the FDA for one of its therapies. The stock has been on a tear really for the last couple of months. And finally, we're also watching Boeing, the Dow component, relatively flat after the company released some internal memos, some disturbing internal memos about the 737 MAX jet, showing that some employees were mocking the design, saying one of them saying that it was designed by clowns, and Boeing has said though that those messages are completely unacceptable.
Inez Ferre down at the Stock Exchange, thanks very much for that. Well, not everyone is bullish on the U.S. economy. Vanguard, one of the biggest names in investing, is predicting a 50% chance that stocks tumble into correction territory this year. Let's bring in Vanguard Global Chief Economist Joe Davis. Joe, good to have you on the show. Thanks for stopping by.
Thanks for having me.
Before we dig in there, I just want to get your reaction to today's jobs report.
Pretty much as expected. I mean, we're not expecting a significant acceleration in the U.S. economy this year. Now, we are not anticipating a recession. So I think the numbers we saw today are pretty much in line with what I think investors should anticipate over the coming year. Positive job growth, but we're still going to see modest deceleration in the U.S. economy as we go into the second half.
I appreciate your contrarian take, and I very much like it. Really, some great notes here. What don't you like about this market right now?
Well, I just think that the fact that the price appreciation is just moving well above fundamentals. So again, at Vanguard, we have a long-term orientation. We still believe stocks will outperform bonds over the next several years, but I think we also have to have reasonable expectations. And I think we're continuing to see a disconnect. Prices continue to exceed fundamentals, and that's the reason why we should just be prepared for some downside risk to the equity markets at some point this year.
If a correction is coming, as you say it probably will be this year, what sectors can investors be in to sort of mitigate the damage for themselves?
Sure. Well, I think first is to stick to the plan. I mean, one of our biggest counsels to advisors and to investors this year is to not get over your skis, right? And to not take on undue risk, particularly given the strong performance we've seen over the past 3 or 4 years. So that's fantastic news. What you tend to see at times, though, is investors at this point in time starting to take on undue risk. And so I think we're having more modest expectations. If you are an active investor, perhaps parts of the market that are more value-oriented, that have not participated as strongly as some of the growth sectors and the tech sectors.
When you talk to clients right now, do you get the sense, and I can't think of a better term, that they are foaming at the mouth to get into this market, that type of euphoria, which ultimately leads to maybe a contrarian take?
It's a really good point, although it's not as euphoric as, say, the late 90s. You know, I mean, when we saw that,
it's probably a good thing.
Which is a good thing, and that would be a positive upside risk to some that are a little bit more bullish on the financial markets. You know, in the late 90s, we saw cash flows going into anything that began with E for equity. Here, it's a little bit more balanced cash flows across the mutual fund and ETF space, and so in that sense, that's one positive factor.
People are being a little more choosy this time, but there's a lot of cash still on the sidelines. For whatever we want to say about this market hitting record after record, there's still a lot of money on the sidelines.
Yes, and I think the biggest thing is to stay invested, stick to the plan, because if we are talking about a lower return environment, we certainly didn't have it last year, but the math pretty much dictates over the next several years, not negative, but lower than historical average. That tells me as investors, you have to stay dedicated to the plan, and then again, just be mindful of what sort of risk you want to take on in the next few years.
Given how quickly and sharply we have advanced in the markets, is your correction maybe something more like a quick bear market where we can lose 10 to 20% in a month.
Well, and again, listen, I'm personally not hoping for a correction.
Absolutely.
It's just when you do, and it's pretty simple. I mean, when you have valuations that are well above historical averages, and you have a stock market that tends to be volatile from year to year, that's why we have an elevated odds of a correction. But we do not see a bear market because that would be associated with a recession. And our odds of recession are not zero, but they're not at that 50% level that you mentioned. So I would hope that should we have one, it would be short-lived and that the markets would bounce back, similar to what we saw in early 2018 and the early part, towards the end of 2018, when we saw that rapid fall. But actually, many investors, if they stick to the plan, then they saw the gain quickly there.
So you're looking at more like a 10% sell-off, like a good old-fashioned correction.
Yeah, which is actually natural. I think what's actually somewhat unnatural about these markets is the very low persistent volatility we've seen. And so that actually would be a little bit healthier, I think, for the financial market.
If we saw more volatility.
More volatility, because that would also mean that there would be a higher expected risk premium or return for equities over a longer period of time, which sounds somewhat contrarian, but I think that would be actually a little welcome development.
And before we let you go, political risk. I can't think of a better person to ask than you. Political risk, how are you thinking about it in the portfolio?
Well, we track policy uncertainty. We believe that it's structurally or more secularly going to remain elevated. I think that's where you have to think about diversification. And there, I think you should look more so outside of equity into fixed income. So despite the low level of interest rates, should we have a correction this year in the U.S. equity market, I can tell you one area of the market that probably will rally, and that's the fixed income market, high quality. And so I think thinking about that in the role of bonds, despite the low yields, can still provide some ballast going forward.
All right, Joe Davis, really good thoughts. Thanks for coming.
Thank you for having me.
For more insight into the global economic outlook, Alexis and I will be in Davos for live coverage of the World Economic Forum. It starts on January 21st. We'll be joined by Editor-in-Chief Andy Serwer and our very own Julia LaRoche. Coming up here on The First Trade, Taco Bell knows what it takes to keep good employees, and it's not free taco nights. We'll tell you their plan in our Companies to Watch.
Now for a look at some of the companies and stocks the Yahoo Finance team is watching for you today. A big deal for one of the world's biggest drug companies. Eli Lilly is buying Dermira for some $1.1 billion in stock. The biopharma company is working on a potential blockbuster treatment for dermatitis that's currently in phase 3 clinical trials. Apple is accused of stealing technology and secrets for the health feature on its Apple Watch. Healthcare tech company Masimo filed suit against Apple, saying it obtained company secrets by faking a working relationship and then hired away key Masimo employees. Masimo claims its technology was key to Apple overcoming performance issues with its watch. And it is a tough labor market for Yum Brands. In order to find prospects in a dwindling pool of restaurant managers, the company's Taco Bell brand is offering $100,000 to potential managers. It's also hoping it will keep current managers from leaving. The company usually offers between $50,000 and $80,000 to its managers. And Pokemon fans are going into battle against Nintendo. Players are upset because they're being charged $60 for an expansion pass for the game's Pokemon Sword and Shield. That's in addition to each game costing $60 and an online subscription service that adds up to another $20 a year. When the announcement was made on YouTube, fans said they'd go broke with this price point. Coming up here on The First Trade, is Grubhub for sale? We're going to dissect next in our trending ticker. Stay with us.
Let's take a look at one of today's Yahoo Finance trending tickers. Shares of Grubhub are under pressure. Now, rumors continue to swirl that the food delivery company is for sale, and Heidi Chung joins us again to discuss. Heidi, this is a real unfolding situation. What's the latest?
So, Brian, all of this started on Wednesday when we had a Wall Street Journal report saying that Grubhub had hired financial advisors to explore strategic options, perhaps like a sale or a deal. Now, today we're starting to get reports that perhaps some of the people interested in Grubhub include grocers like Walmart, Kroger, and Albertsons. Now, Yahoo Finance did reach out to Walmart. We have not heard back yet, but we reached out to Grubhub and they did share us a statement. I'm going to read a really quick part of it. It says, quote, "While our policy is not to comment on rumors, given the considerable media speculation that appeared Wednesday, we felt it was necessary and important to clarify that there is unequivocally no process in place to sell the company." So right now they're saying, no, we just hire strategic advisors to see what our options are. There's nothing in talks right now. And Brian, I know you feel that Grubhub is not a good takeout target, but this is an interesting take if the grocers look to get in on the space.
This model is completely under pressure. Alexis, the company's results, profits have plunged for the 9 months months ended September 30th. They came out and they already issued disappointing profit guidance for 2020. And from what I've been hearing and the sources I've been talking to, there might be even downside risk to that bad 2020 guidance.
Well, look at all the competition you've got, right? DoorDash, Postmates, Uber Eats. I mean, is 2020 going to be the year that we finally see some consolidation, you think, Heidi, in this sector? Because they all can't seem to survive. I mean, even Grubhub, in its latest letter to shareholders, was talking about they called customers promiscuous in the way they've been using these services. It's really hard to get loyalty.
That's absolutely correct, Alexis, and I do think that we are going to see a lot of consolidation in the space. Now, it's going to be interesting to see what kind of company looks to swallow up a company like Grubhub. Now, unlike its peers like DoorDash, Postmates, as well as Uber Eats, Grubhub is actually profitable, even though we did see that huge drop in profits in the third quarter. So, I mean, I've talked about this with Brian. Uber Eats, even though they don't have a lot of money on hand, we know that they are very big on hammering down their investment in Uber Eats. So it wouldn't be totally out of the picture to say a company like Uber Eats might look to swallow up this company.
This business model stinks. We'll just leave it there, Heidi. Well, I'm sure we'll be talking about it a lot more this year. Heidi Chung, thank you. We're starting off the year strong with stocks hitting fresh record highs this week. And on that note, it's time for today's Flashback Friday. Now, we spoke with Planet Fitness CEO Chris Rondeau. He gave us some insight on 2020 in his outlook, and he has some big plans to open a lot more stores.
We opened 261 in 2019, which is a new record for us, over 230 in 2018, which is also a record. So great momentum here going. You know, this year for 2020, we haven't quite put our forecast together yet, but you know, right now on top of the 2,000 stores open, Brian, we have over 1,000 locations still committed in area development agreements with our current franchisees, and half of those will open the next 3 years. So we've got a lot of runway for growth and a U.S. potential for 4,000 stores.
And they also have those partnerships. Remember, it cut a deal with Kohl's. It's going to be expanding that partnership this year. So, you know, talk about crowded space, talking about the food delivery, gyms are crowded as well, and Planet Fitness seems to be doing it right.
And you know what else they have? Tanning beds and free pizza giveaways. So you cannot go wrong with tanning beds and free pizza giveaways.
All right, it was a rough quarter for Bed Bath & Beyond for sure. That stock plunged after the company reported earnings that fell way short of expectations. It's also wiping out any kind of outlook it would give. The company said it still plans to close 60 stores. That's after shuttering 14 in 2019. It does say, though, it's going to delay 20 of those closures, more for inventory issues. But we spoke to an analyst yesterday about Bed Bath & Beyond. She has a sell rating on the stock.
$8 price target.
And what was it?
$8 price target.
An $8 price target. Yeah. You know, Bed Bath & Beyond does have a new CEO. We'll see if he can turn things around. He's only on the job for 2 months, and he's already made plenty of changes.
What's that song? It has only just begun. And I think over Bed Bath & Beyond, they'll have an investor day in March of this year. They have a lot of things going on. I think the next step for them is, first of all, hiring a management team. The new CEO, Mark Triton, wiped out all of the underperforming, lagging executives in the C-suite, 6 to be total. He has to hire some peeps.
And they also, he even admitted their price point's not where it needs to be, and they need to do more to their website to attract younger shoppers. So changes for sure for Bed Bath & Beyond this year. And we have a big week ahead here on Yahoo Finance. Brian is going to be sitting down with Microsoft CEO Satya Nadella for the latest on the cloud and Microsoft's plans for 2020. That's going to come up Monday here on The First Trade.
Yeah, pumped about that one.
All right, taking one more look at the jobs report. 145,000 jobs added last month, less than the 160,000 that the street was expecting. The unemployment rate held steady at 3.5%. Wages rose less than expected, 2.9% year over year. The market response, pretty muted, in a word. And that's it for The First Trade for this Friday morning. I'm Alexis Christoforous.
And I'm Brian Sozzi. Now let's get one more look at the markets with Inez Ferre down at the New York Stock Exchange. Inez?
Brian, Alexis, records for the markets this morning. We're looking at the Dow that's up 15 points. It's about 30 points away from 29,000. The S&P and the NASDAQ also higher this morning. Six Flags is plunging, though, this morning, down around 17%. This is after the company gave a warning of fourth quarter revenue shortfall, and also saying that it has had some challenges with the parks that it's been developing in China, saying that this is in part because of the decline of the real estate market in China, and their China partner has defaulted on its payments to Six Flags. So Six Flags, you're seeing this morning, heavily under pressure. Looking at some of the Dow components, Apple hit another all-time high this morning, reaching $311 a share. And also just checking out Boeing. Boeing this morning is flat. This is after the company released some internal messages regarding the 737 MAX jet, showing that employees had some doubts about the design of the jet. One of the messages said that the plane was designed by clowns, and Boeing has said that these messages are completely unacceptable. Right now, the Dow is up 20 points, inching higher and higher towards that 29,000 level. Make sure to stay with us. On the Move is next. We'll be talking about the jobs report and the record highs today.
Ten a.m. in New York City, 30 minutes into the trading day, and stocks are trading higher. Help wanted. The December jobs report ends 2019 kind of with a thud, adding just 145,000 jobs in that month. What it means for the year ahead. Email outrage. Boeing is back in hot water after internal communications hint at a possible cover-up regarding problems with the 737 MAX. And delivery confusion as Grubhub denies rumors of a sale. One big name emerges as a possible suitor. Welcome to On the Move. I'm Adam Shapiro.
And I'm Julie Hyman. Thanks for being with us. Our top story today is, of course, jobs, jobs, jobs. The U.S. labor market finished 2019 on a bit of a sour note. December's payroll and wage growth missing expectations. Non-farm payrolls increased by just 145,000, while the unemployment rate held steady at 3.5%. Wage growth missed estimates as well. We've got team coverage to break it all down with Yahoo Finance's Jessica Smith in Washington and Inez Ferre at the New York Stock Exchange. First to Jess, break down the numbers for us.
Yeah, 145,000 jobs added in December. That is short of expectations that were 160,000. The unemployment rate held steady at 3.5%. Wages, as you mentioned, also missed expectations. We saw average hourly earnings rise by 3 cents to $28.32. That's a 0.1% increase month over month and a 2.9% increase year over year. That is the weakest year over year growth we have seen since July of 2018. Economists were looking for 3.1% growth. Labor force participation rate was unchanged at 63.2%. And then we want to look at a few of the industries here. Retail added 41,000 jobs. Healthcare added 28,000. Leisure and hospitality added 40,000. Mining lost 8,000 and manufacturing lost 12,000 jobs in December. And looking at 2019 as a whole, manufacturing added just 46,000 jobs for the year. Compare that to 264,000 in 2018. And we also had some revisions to the downside. The November jobs number was revised down to 256,000 from 266,000. October, that was revised downward as well. That came in at 152,000 from 156. So that's 14,000 fewer jobs than previously reported. One highlight from this report is the U6. That's the broadest measure of unemployment. That came in at 6.7%. That is the lowest on record. And finally, looking at 2019 as a whole, we saw 2.1 million jobs created for the year. You can compare that to 2018, where we saw 2.7 million jobs created. Adam and Julie.
All right, let's head to the floor of the New York Stock Exchange, where Yahoo Finance's Inez Ferrer is standing by. So tell us where the reaction from the traders and investors. What are we watching right now?
Yeah, Adam, the traders that I've spoken to are saying, look, this jobs report was nothing to be too concerned about. Wages came in light, but they're not too worried. And one of them telling me this won't change the narrative of the economy. And you can kind of see it being reflected right now with the Dow. It's up 30 points. The S&P's higher, the NASDAQ higher. We're actually so close to that 29,000 mark, and that's really what everyone is watching here. And oil has been volatile this week. It's been down about 1% this morning. And just taking a look at some of the Dow leaders this morning, we're looking at Pfizer, Apple hitting another all-time high this morning, Coca-Cola, Verizon, and Intel. And some of the Dow laggards this morning include Travelers, Walmart, ExxonMobil, as some of the energy stocks have been under pressure, Home Depot, and JP Morgan. We're watching that 29,000 level. We're about 10 handles away from it.
Inez, thank you. Let's take a deeper look at those jobs numbers with Marcus Schomery, PineBridge Investments chief economist. We also want to bring in our panel for the next 90 minutes. It's Yahoo Finance's Akiko Fujita and Kristen Myers. Marcus, when you look at these numbers, I mean, to me, even more than the headline disappointment, that wage number really stands out to me as still sort of puzzling, given what appears to be the tightness in the job market.
Well, you probably put your finger at the one part where I would say I'm a little skeptical that was a real number, because don't forget, the jobs numbers, wage numbers get revised a lot. I wouldn't be surprised in a few months if that looks a little bit different. On the face of it, it looks like a pretty steep slowdown. That's absolutely right. But to me, this was much more of a clarifying report. Nothing probably for the market to cheer about, but something that I think economists really like, because it confirms and clarifies a couple of trends for this year. One, for example, is that job growth is slowing. This was the weakest average jobs year since 2011. And there's two reasons for that. One is slower demand, because growth has slowed, economic growth has slowed, but also supply constraints. We're increasingly running into problems not finding skilled enough workers to fill our jobs. For a while now, we had 1 million more job openings out there than there are people unemployed. And there are no pockets that we suddenly can find people. If you look at the number of people who come into the labor market from outside the labor force, that number was virtually zero this year. It was pretty strong in 2018, but in 2019 was virtually zero. So the pockets of people to find to come into the markets are virtually empty.
How would you explain to us this, and it's a deep dive metric, but does it have forecasting for the economy and investment choices? I want to go to mining, because in 2018 we saw 63,000 mining jobs added. That was the support stuff. That's the pipes and the equipment and the trucks, all of that. We lost 24,000 in 2019. We've lost 8,000 in just the last month of December. The trajectory is down. What does that mean for me as an investor? Obviously, we understand what that means for mining and for the election, perhaps going forward.
Well, mining is a really tiny piece, right? But it doesn't look any different from manufacturing more broadly. And manufacturing job growth has stalled, and that's very consistent with everything else we're seeing from the manufacturing industry, right? If you look at industrial production, stalled. If you look at durable goods orders, stalled. If you look at the PMI numbers, stalled. I mean, this is just confirmation of what we know has been happening for the last 12 months. Very consistent. The business sector remains stalled out, not in recession, but stalled out, and there seems to be no sign of a rebound. So what is required here is a sentiment booster. It's not that interest rates are too high or that companies don't have enough money, right? But we need a sentiment booster. And what is that? More Fed rate cuts. And I think that's what this job reports support. Because of the business side, because we see no sign of a rebound in manufacturing, but also the slowdown we're seeing now for the overall consumer that's coming next year. We need more Fed rate cuts.
I just want to mention, to flag something we showed on our screen, the Dow has now hit 29,000, which is a milestone that some people were waiting for. And it doesn't mean a big percentage increase today, but just a nice big round number.
Well, and it goes to your point that you say the market is kind of just shrugging off the number that came out today. I want to pick up on Julie's point again, though, because we're looking at 3.5% unemployment, and the question is why the wages aren't going up. You said earlier when we were talking off camera that it's just not going to go up. This is sort of a different economic model we're dealing with. How should we be thinking about that number now then?
Yeah, I've been saying this for years. The lesson that companies learned from the last recession is that whoever had too much of a cost base was the company that probably wouldn't survive. And I think that's the lesson that everybody is implementing in their business policies. So profit margin maximization or profit margin protection is the most important thing. So companies rather forgo growth than increase their cost base. That's why wage growth has been so tepid and so moderate. And we had the strong growth years in this cycle, right? Those were 2015 and 2018. Those were the strong growth years. And if wage growth doesn't pick up then, it won't pick up now.
Hold on one thing, because there's something that we can't ignore here, which is that, when we talk about unemployment 3.5%, Taco Bell is talking about its need to find people. And you probably heard about this. The chain announced it's going to test a $100,000 salary for the restaurant's general managers. Now, remember, Yum Brands owns Taco Bell. They also own KFC, I think Red Lobster. Is this a sign of just how competitive it is for employers to find employees who have skills that they can turn around immediately?
Oh, yeah, because the place you can get your workers from now is not the unemployment pool anymore. It's other companies that you compete with, right? If you Taco Bell, the best place to get workers now is from Taco Bell rivals. But you have to weigh then the potential risk of raising your cost base against the future outlook for sales. And when we are in an environment where we're not going into recession in the next couple of years, but these numbers tell me that consumer income is slowing because job growth is slowing, average hours worked is weaker this last year, average hourly earnings are slowing. All that tells me that the consumer will not strengthen in the next couple of years, but it will slowly, gradually weaken in the next couple of years. In that environment, I'm not sure you really want to raise your cost base by adding more workers that basically then forces you to pay everybody else a higher wage.
We talked about this dichotomy the other day with Mohamed El-Erian, sort of the pessimism or more of a glum tone among economists, and then what we're seeing in the market. And I just want to quickly go to Inez, because again, we've hit records again on the major averages. Inez has got her 29,000 hat on.
I do!
But again, this is really sort of a disconnect, Inez. It's kind of fascinating.
It is, and that jobs report, the traders here have sort of said, look, the markets are sort of like shrugging this off. If you look right now the Dow is just a few handles below it, but we had hit 29K just a few minutes ago, and Pete Tuchman has these made, and these are made, this is a quick turnaround, because the last time we were at 28K was not that long ago. Here's Pete right here with a hat as well.
Inez, thank you. Real quick, Marcus. This jobs report information, is this the kind of jobs report we would see at the top of the cycle, when we've peaked? Because we see a lot of money coming back in quickly because people don't want to miss out. Is this a warning?
No. See, the cycle is dead. It's the wrong question to ask where we are in the cycle. Is this late cycle? That's the wrong question. What's happening right now, and this jobs report confirms that to me once again very strongly, we're converging towards the long-term potential growth rate in the US, which is 2%. It will be very hard to get off that 2%, up or down, as long as the Fed continues to support growth and supports the market. And to me, it's not inconsistent to see, I wouldn't call it glum. I think these are moderate growth signs, and the Fed is leaning on the easier side of policy. No wonder wonder you have moderate economic growth and rising financial markets. There's no inconsistency there for me.
Marcus, if indeed you're correct, and we've sort of had a reset of how companies pay their workers because of their cost basis, what happens if we get a national $15 minimum wage?
Yes, that risks destabilizing this nice, stable environment that we're in right now. You're absolutely right. So you have to be a little careful. But the evidence so far of past increases in the minimum wage has not really shown that there's a widespread pass-through into the rest of the economy. There's not that many people who actually make minimum wage. And I think the resistance to raise everything with it in parallel will be very high. So, and again, this report shows there is no upward pressure on wages. I think what we're seeing right now is wage growth perfectly calibrated at inflation plus productivity. And as long as we stay there, we have about 2% inflation, about 1% productivity, 3% wage growth. It's perfect. Will create no problems to the economy. If we go significantly above that, then we create pressures on company profits. But as long as we stay around that model, the economy can do that for a number of years.
Marcus Schomer, thank you for joining us. We've got a programming note for everybody. Trump advisor and director of the Office of Trade, Peter Navarro, will be on Yahoo Finance's The Final Round today at 4 p.m. Eastern. We're going to get his thoughts on this latest jobs data and, of course, much more.
All right, Boeing shares, we're watching those as well. They're in the spotlight today after newly released internal communications between Boeing employees revealed their concerns over training requirements for the 737 MAX and messages employees write about fooling FAA regulators and pressure to keep training to a minimum. Yahoo Finance's Alexis Keenan joins us from the newsroom with the latest. Alexis, I definitely didn't even include sort of the most incendiary language in some of those messages.
There's a lot of it, and I'm still going through it, Julie. These messages were released by Boeing at the urging of Congress members. They were handed over to the FAA in December, but we're just now getting a chance to go through them. These are internal communications between employees of Boeing about specifically their simulator program for the 737 MAX. Now remember, that's a physical replica of the plane as close as they can get to it in order to train pilots. It's a very pricey enterprise, and given the chance to either take it or leave it, airlines can choose whether they want to give this additional training to their pilots. But if the FAA does not require it, as was the case with the 737 MAX, they can leave that expense behind. Now, these documents span from a period of 2013 to 2018, and during that time, Boeing was working on both its MAX program as well as the simulator for the aircraft. But during that time, they would have had two main goals. One was to make a determination with the FAA that it did not need these simulators to be required by the FAA, but also they would want to encourage customers to not need them either, to keep costs down and keep this plane at a lower price. During that time, Boeing was having some trouble getting the simulator to function as they wanted to, and that means the FAA would not be able to approve it for use unless they got it right. So I want to read to you some of these communications from the documents. These are mostly from 2018, and note that this is after the time when the first MAX was delivered to its first customer. That was in May of 2017. The first one from 2018 is a Boeing employee asking a colleague, would you put your family on a MAX simulator-trained aircraft? I wouldn't. Another exchange, an employee saying about the MAX, this airplane is designed by clowns who in turn are supervised by monkeys. And in another 2018 email, this one from a Boeing management pilot telling a coworker that they were concerned about prior work on the MAX, saying, I still haven't been forgiven by God for covering up what I did last year, I presume there. Can't do it one more time. Pearly gates will be closed. Now, Boeing in a statement said that the qualification activities referenced in these communications occurred early in the service life of these simulators. Since that time, both internal and external subject matter experts have repeatedly tested and qualified the simulators at issue. The company says we regret the content of these communications and apologize to the FAA, Congress, our airline customers, and to the flying public for them. Julie?
Okay, it's Adam, and we're going to deal with the fallout for Boeing here and talk about this among the panel. They're just damning, those emails. And there's one that goes back even further, 2015-16 era, when they were trying to get the plane approved, where they the email implies they misled the FAA by trying to confuse them, and they referred to everybody in the room. It was like watching dogs watching TV.
Right. So I'm really glad you brought up the FAA, because a lot has been talked about with the Boeing story, essentially how cozy our regulatory authority is with this company. This is an agency that is supposed to be certifying the safety of these planes, and it seems as if increasingly there's been this, revolving door between the FAA, between Boeing and other airlines. And I'm wondering, considering how many hearings that we're going to be having upcoming in Congress, if we're not going to be seeing some changes in the way that the FAA and also the way that Congress and also the public really demands that our regulatory authorities look at certifying some of these planes. As Alexis mentioned earlier, they kind of left some of it in the hands of the company. And as we're now hearing, they were a little bit flippant and casual about the safety of their own planes.
And it wasn't just the FAA and U.S. regulators, right? There were also some messages regarding the Indian authorities where the person sending the message implied that they sort of made the Indian regulators feel inadequate so as not to require as much training.
I mean, I would argue it goes well beyond that, right? You pull it out and you think about what's happening at Boeing. There's a culture issue, I think, here at the company. And this isn't just about the 737 MAX. These are not the same story, but we heard about issues during the Dreamliner as well. This company maximizing profits over safety. And I do wonder, we talk a lot about how resilient the stock has been, just given the global demand picture. But I do wonder at what point this starts, and I feel like I've been asking this for the last 6 months.
You're going to have to rename the plane or maybe
redesign. But Boeing, Boeing, the company.
Yes. It's not just about the plane; it's about the company. That's what you're saying.
Well, we saw the CEO change, but is that enough? Because some people are saying that whole thing about, would you let your family get on one of these?
No, I mean, I don't think swapping out the CEO is going to do, make incredible changes when it comes to the culture of the company. I mean, how often do we ever see, a new CEO come in after a scandal like this and all of a sudden there's some sort of 180 turnaround? But to Akiko's point about the stock, it has been incredibly resilient. Investors have really just hung on and glommed onto any good news that they can about Boeing, and largely to some extent kind of shrugged off any bad news that Boeing has had. But to your point, where is that breaking point? When are investors going to say, listen, we're not going to keep putting money in this company that clearly prioritizes profits over safety, especially now that we have this latest news with the crash, and it wasn't necessarily potentially the fault of Boeing, but it's just bad headline after bad headline after bad headline.
Well, in fact, it looks like the Iranian shot it down,
right?
Or what the reports are now saying.
Okay, so coming up, a big week for big banks. How the Fed's last rate cut could impact earnings next week. Plus, if you can dream it, you can stream it. U.S. consumers reach a record number of music streams in 2019. We're going to play all 1 trillion. We'll be right back.
At once. Let's take another look at what's going on in the markets here today, because I want to start with the Dow. It did go above 29,000, but it didn't stay there. Now we're at 28,985, so a brief flirtation. Still, though, we are at records for the major averages in the wake of the jobs report. I want to take a look at what's going on in the Treasury market as well, because we've been talking a lot about what is going to happen with the Fed? What are the implications? We're just down 2 basis points here, even as we just heard Marcus Schomer talking about this sets up the Fed for potentially more rate cuts. 1.84% is where we stand on the 10-year note here. And also, I've been watching what's going on with oil prices. Oil down for yet another session today, down 6% this week alone. So if we've got a little bit of slowing job growth, not necessarily surprising for us to see what's going on with gold prices. I also want to take a look at some of the trending tickers we've been watching, because Grubhub is a developing story we continue to watch this week. Here's the 5-day chart for Grubhub. Grubhub coming out and saying, no, it is not potentially looking to put itself up for sale. It came out with a statement rebutting a Wall Street Journal report from earlier in the week that had sent the stock spiking. So still the 5-day chart, it's up 8%. But if you look at today's session, the stock is pulling back by about 8%. We'll have more on this story next hour, and we'll be right back. Fourth quarter earnings season gets into full swing next week. The big banks are going to be in the spotlight. We've got JP Morgan Chase, Citigroup, Wells Fargo among those reporting. Rusty Vanneman, Chief Investment Officer at Orion Advisor Solutions, is joining us now from Omaha, Nebraska. And Rusty, you call financials a favorite sector. I've been looking at some of the early analyst chatter on those bank earnings. Some of them are saying net interest margins maybe are bottoming and we're going to start to see some improvement here. Are you in that camp as well?
Yeah, we're in that camp. I can't be a contrarian there. That's exactly what we're thinking. We think with the yield curve getting steeper and net interest margins will improve and financials should do better. Besides, they have amazing relative valuations supporting them. They usually do trade a discount to the market over the last 25 years, and that discount is a lot wider than it typically is. So improving fundamentals, great valuations. We like financials.
But you also expect below average returns for fixed income. Can you dive into that to help investors figure out what you're actually telling them?
Yeah. Well, we build portfolios for long-term investors, and obviously we have to build them to certain risk levels. So fixed income remains a really important part of that. There's no better way to diversify equity risk than high-quality duration through fixed income. That said, interest rates are just really low, and that has to shape return expectations for fixed income. With 10-year treasuries just below 2%, it's just really hard to get super excited about that return potential, but fixed income will still do the job in terms of diversifying risk.
So, Rusty, big banks actually performed pretty well in 2019. We've seen a rally over the last couple of months with some of the big banks, roughly about 20%. I'm wondering what kind of upside you're seeing in 2020 versus what we saw in 2019.
Well, that's a good question, because obviously stock prices move in front of the fundamentals often. So they're probably already doing that in anticipation. But we still think relative valuations are still so attractive that it's just really the beginning of the run. Financials have underperformed for years. They just finally reached new highs of late. So we think they have a lot of potential to move a lot higher on a relative basis and in absolute terms.
You also think that value stocks are at their cheapest levels versus growth stocks. And I know that they can be kind of gray as to what some people consider value. But for instance, ExxonMobil, is that something, given the environment regarding climate change, but also the demand for oil, that people should be looking at?
Well, it's a good point. We really do like value stocks. And I guess that is just sort of a general comment that, a value-based ETF would make a lot of sense. But if you do break down the sectors, there are differences. So, for instance, financials look great. We just mentioned energy looks really attractive. Relative valuations are very attractive. But if you look at some other areas such as real estate and maybe even utilities, some of those areas, those are expensive. So, but to get to your question about energy, we do like energy as well. It's just those valuations are just the relative valuations are so attractive that they're just a margin of safety there that we like.
Rusty, what needs to happen to rates in 2020 to sort of make these various calls come to fruition? In other words, do rates need to start to move up for financials to look attractive? But on the flip side, that might make energy look less attractive on a relative basis.
Yeah, I think interest rates do need to move a little bit higher. I mean, our call right now is that they'll probably grind higher. Again, I'm thinking longer term rates. We're not imagining a huge move one way or the other. I would think that we'd probably get to 3% plus in 10-year treasuries before we get to sub 1. It's not really that heroic of a call because I think it's going to probably be within that range. But we do expect to grind higher. Inflation expectations seem to be grinding a little higher. Real rates are still low in an absolute sense. It seems like the bias should be towards slightly higher rates.
It feels like a long time since we've seen 3% in the 10-year, even though I guess in real terms it hasn't been that long. Rusty Vanneman, Chief Investment Officer at Orion Advisor Solutions. Thank you.
It was a record-breaking year for music streaming in 2019. Music streams in the U.S. were up 30% last year, topping 1 trillion. According to Nielsen Music, streaming services now account for 82% of music consumption in the United States. Anybody surprised by this?
No. I mean, I think this has been forecast for a while. I mean, you can talk about how big the numbers are, but I think the trajectory has been pointing directly in this direction for a while. What I think is going to be interesting to watch is, we talk a lot about Spotify and Apple Music, but there's a lot of other platforms that are starting to kind of eat into that space, not necessarily music streaming. One app I know I talk about a lot is TikTok, but in this report that came out, we did find that some songs gained traction on that platform. So it's going to be interesting, I think, moving forward to see how artists start to maybe push out beyond the traditional streaming to gain traction for their big releases.
Well, in part because they don't make very much money from streaming, right? So because of that, they've sort of had to get more creative. I mean, the live business, meanwhile, appears to be thriving because that's one way that these artists can make some money.
Right. I'm actually really curious if we're going to see a shift like we saw with, the Netflixes and the Apple TV Pluses, if we're going to start seeing Spotify open up record labels, and if YouTube is going to create a record label, and if we're really going to really see them push into that space more, they might as well, right? They're already in charge of all of the streaming. They have all of the numbers. It seems as if you're in A&R, you kind of say, oh, well, who is, top on SoundCloud or on top on YouTube?
SoundCloud's
that should be the next person that I sign. And so it'll be interesting which one of them is going to really start to do that.
Spotify's kind of doing that with the podcast, aren't they?
Yes.
They're already doing that with the podcast. I think YouTube, though, I mean, they used to say they don't want to own the content. They just want to bill you for it and send it out and make money off the advertising.
Right. Well, I mean, didn't they all say that? And now look, right? Netflix is at the Oscars. So, I mean, when is that going to change, at least on the music side of it?
Right.
It'll be interesting to see.
All right, coming up, where are the jobs? We break down the December employment report with former White House Director of Economic Policy, Todd Buchholz. Plus, planes, trains, and automobiles. Mayor Pete's $1 trillion plan to improve America's infrastructure. We're back in 2 minutes. It's 10:32 a.m. here in New York City, about an hour into the trading day. Stocks are rising, although they've pared some of their gains. The Dow did hit 29,000, but it didn't stay there. This all coming as the December jobs report ends 2019 with a bit of a thud, adding just 145,000 jobs in the month, what that means for the year ahead. Cutting back, one analyst grinds their Aurora cannabis forecast to just $1. And Taiwan heads to the polls, why China is playing a major role in Taiwan's presidential election. Welcome back to On the Move. I'm Julie Hyman.
And I'm Adam Shapiro. The Dow just hit 29,000. Inez Ferrer is on the floor of the New York Stock Exchange. Let the good times roll, Inez.
That's right, Adam, but it didn't stay there. Right now, we're down about 25 points below 29,000. We did, though, hit it briefly. Traders here saying that the markets are sort of shrugging off that jobs report, the December jobs report. Let's take a look at what's happening with Amazon. Not too much movement on the stock. This is after a Wall Street Journal report says that Amazon wants to sell ads outside its Fire streaming platform, for example, on Apple TV, on Xbox, and this would basically give TV app owners access to their ad inventory across different platforms. If we take a look at Dow component, Apple today hit fresh highs, hitting $312 a share. Apple just has been going higher and higher. And then we're watching also Eli Lilly this morning. This is after Eli Lilly announced that it will be acquiring the biopharma company for skin conditions, Dermira, for $1.1 billion or $18.75 a share. Now, back in October of 2019, Dermira was trading at around $6 a share. It's been on a tear in the last couple of months. In December, it received the FDA fast track for one of its therapies. Adam, Julie.
Thanks, Inez. Well, let's talk more about that December jobs report. Non-farm payrolls increasing by just 145,000 versus the expected 160,000. And unemployment held steady at 3.5%. Joining us now to discuss, the former White House Director of Economic Policy under President George H.W. Bush, Todd Buchholz. And we had an economist on earlier who said, this is the slowest job growth for a year since 2011, I think is what Marcus said earlier.
What a preposterous thing to say, the slowest job growth. This economic recovery has been going on since 2009. Eventually, you do run out of new bodies to bring online, so to speak. So, of course, even in a robust economic recovery, 10, 11 years later, you're going to slow down a little bit in terms of the sheer number of new jobs that are created. This was a good jobs report, a solid jobs report. The market is happy about it, and you really need a pretty sharp magnifying glass in order to find the negative story in this report.
You're not upset or concerned about the 2.9% the 2.9% wage growth. I mean, that's not quite what it has been, but it's certainly not where it was coming out of the Great Recession.
No, the 2.9% is perfectly fine. It's a little bit slower, but look, it also tells the Federal Reserve Board that we can take our hands and sit on our hands for another 6 months or another year, which is exactly what the market wants. This is another Goldilocks report. Neither too hot, neither too cold. And it just occurred to me, Donald Trump is benefiting from this jobs report. He'll take credit for this jobs report. And my gosh, if you think about his hair color, it pretty much matches Goldilocks.
So if this is the Goldilocks scenario, how sustainable are these numbers? Are we kind of smooth sailing going forward from this, or what are some of the maybe headwinds that we should be looking out for?
Look, the biggest headwind, which I don't see yet, would be inflation, signs of inflation. It's not showing up in wages. It's really not showing up in prices. But if it does, if I'm wrong about inflation, if the Fed is wrong about inflation, then all bets are off. The Fed slams on the brakes. The market loses 20% of its value, and we tumble into a recession. What are the chances of that? Oh, I don't know, 24.3%.
Okay, let's talk about something that tends to create jobs, government spending, and what better to spend on than infrastructure, right? We've got Pete Buttigieg, who unveiled his $1 trillion infrastructure plan today. They're all $1 trillion, by the way. The president's was $1 trillion. The 2020 presidential candidate's proposal outlines plans to improve public transportation, address clean water, expand internet access. The Trump administration is actually doing the internet part of this, but anything in this plan that you see that we haven't been served up before and then it goes cold and they don't do anything?
Yeah, I don't see anything new. Let's face it, during the Great Recession, President Obama had proposed and promised shovel-ready projects.
Yeah.
And I think the administration at that time did sincerely look for big projects that could create lots of jobs. But it's difficult for the federal government to create and direct such programs. Eisenhower could do it in the 1950s because we didn't have a national highway transportation program. But it's pretty difficult now to identify the bridges and tunnels where the potholes can be addressed by Washington, D.C., as opposed to local mayors. So I'd suggest that the mayor return to Indiana and fix some potholes in his local bridges and roads as opposed to proposing it for the United States of America.
So then, given that, then, what is the future for infrastructure in the United States if it can't be directed out of the White House? I mean, one policy analyst was saying, look, we've heard a lot of grand plans coming from a lot of these presidential candidates, but if you can hang your hat on something like infrastructure, that's something that a president might realistically be able to get done. It doesn't seem like you think that's the case. So then moving forward, what do you do then about infrastructure?
Look, I think
it's crumbling in the U.S.
I think infrastructure directed by the federal government should be federal infrastructure. We all get frustrated at airports. The FAA has air traffic control systems that are behind the times compared to Canada and many of our trade competitors. Those are federal, that's a federal apparatus, and that's what the federal government should be focused on. I'm less concerned about the federal government looking at, the Tappan Zee Bridge or the Holland Tunnel and thinking that in Washington, D.C., they know better than the governors and the mayors of New York and New Jersey on how to repair those.
The governors of New York and New Jersey haven't done a fantastic job.
They haven't improved. I mean, doesn't that point to the fact that it needs to be directed out of somewhere if we haven't seen improvements at the local level?
It means that the voters in New York and New Jersey should vote for candidates who will actually take action as opposed to turning them into, I don't know, the buffoonery that Chris Christie turned into.
Quite honestly, though, because when we look at that kind of spending, companies, there are stocks that do very well, but how do you pay for it? The proposal last time with the Trump administration was to change the formula, 20% from the feds, but then 80% from the locals, and then they were looking at who benefits in New York City. That would, if you're going to get a benefit from this infrastructure project, we're going to raise your, say, real estate tax commensurate with what the benefit is perceived to be. That's not going to fly so well with a lot of people.
No, that won't fly so well. But think about this. All of us have been talking about failed infrastructure in the U.S. for a long time. And yet, while these conversations take place and our frustration vents, Jeff Bezos at Amazon figures out how to deliver groceries to my house with 1 hour, 2 hour, same-day service. The fact that the private sector and companies like Amazon can somehow conquer these infrastructure problems shows you that it's not really a matter of the roads themselves, it's a matter of the leadership. And Amazon has taken the lead and showed us how you can get same-day, next-day delivery for very little cost to the consumer. So I'm not convinced that it's the federal government that can solve these problems. I'd rather give it to Jeff Bezos, let him solve it.
Same-day delivery is one thing, but let's talk about even just the subway system, right? I mean, you're saying a private company should be tackling the issues on that front to address the infrastructure issues?
I was born here in this city, and I spent a lot of time here in Manhattan. I now live in a little hamlet called Solana Beach, California. I'm supposed to care about the fact that I'll have trouble getting the E train to Queens? You should be focused on that. You should be focused on. Let me in California deal with my problems.
Why should we pay for, was it at the I-4 in California, or the I-10?
The I-10?
Yeah, why should we pay for
I'm
that?
not saying you should. I think roads should be paid for the people that use them.
Oh, you want user fees? Because Pete Buttigieg is talking about user fees.
I'm okay with user fees. And I'm okay with programs such as Mayor Bloomberg had introduced to have congestion pricing. I think those sort of market-based systems are appropriate. I see no reason why people should have freely been able to clog up the streets of Manhattan, and there should be ways of allocating that space. And the best way to allocate space is not the mayor saying, well, I like you and I don't like you. You get to drive down 6th, you got to drive up 8th. No, it should be done on a congestion pricing basis, and that creates efficiencies.
Julie will love this. I lived in South Bend, Indiana, millions of years ago. Yes, many potholes. My little Hyundai did not survive.
Todd, thanks for being here. Todd Buchholz was White House Director of Economic Policy. I just want to bring you an update on Spirit AeroSystems. This is an airplane parts supplier to Boeing, among others. And the company now says it is going to be cutting 2,800 jobs. There was a report earlier in the week that it was going to cut jobs. Now we get the confirmation and of how many. And this is because specifically Spirit AeroSystems was making some of the parts for the 737 MAX. So we'll keep you posted on this. You see those Spirit AeroSystems shares that have been pulling back this week.
Coming up, Canada's Prime Minister demands Iran allow Canadian investigators to assist in the investigation of that 737 crash that now appears to have been hit by an Iranian-launched missile. Plus, make sure to tune in to Yahoo Finance beginning January 21st. We're going to bring you live all-day coverage of the World Economic Forum in Davos, Switzerland, where we will be speaking with some of the biggest names in the world of business. The House of Representatives voted mostly among party lines to force President Trump to seek congressional approval before future military action against Iran. Now that vote, 224 to 194, is mostly symbolic. The War Powers Resolution will now head to the Senate. Canadian Prime Minister Justin Trudeau says the evidence suggests Iran accidentally shot down a Ukraine International Airways 737. Trudeau's demanding that Iran allow Canadian investigators to assist in the investigation. 63 Canadians were among the 176 people killed when that plane crashed. Iran denies that it shot down the plane. Lebanon's Attorney General ordered Carlos Ghosn to stay in the country as the government there determines what to do with the former head of Nissan. Ghosn was charged with financial misconduct in Japan, but jumped bail in a spectacular escape that made headlines across the globe. Subaru's new edition of the popular Forester has a name with a four-letter acronym you may not want to say around the kids. The Forester Ultimate Customized Kit Special Edition was unveiled at the auto show in Singapore this week. Consumer Reports says the vehicle is pretty much the same as other Foresters, but lower to the ground and has a computer that at the end of the ride says, "Was that good for you?"
CES 2020 may be wrapping up, but the tech space is certainly heating up. Yahoo Finance's Dan Howley had the chance to speak to two Dell executives about the company's latest offerings.
We're here with Dell at CES 2020, and with me are Daryl Ward and AJ Kavatra, and what we're talking about is the new Dell products that you guys have announced, as well as some concepts. So, Daryl, you take it away with the PCs first, and then AJ, we'll get to you with the badness in a good way of the new thing. So what kind of products do you guys announce here? I know you have the new XPS 13, one of the best laptops around. What are you guys doing this year with it?
Well, so we've introduced a brand new redesigned XPS 13. We've continued to evolve the design. It's been the darling of CES, and press and customers have loved it for 5 years. We continue to evolve it. We've increased the screen to body ratio by eliminating the bottom bezel, so we're really four-sided, bezel-less all the way around for the first time. We've continued to reduce the weight, and we've continued to shrink the size of the chassis itself. So it's lighter, smaller, with more screen size this year.
And then what other products did you guys happen to announce at the show?
Yeah, the other, on the commercial side of our business, we introduced a whole new category of product, the Latitude 9510. It is a 15-inch commercial notebook, the smallest, thinnest, lightest 15-inch commercial notebook in the industry. It's innovative in the way of it delivers 5G capability. It delivers experiences around commercial usage models like video conferencing and everything else. It's got enhanced mics, enhanced speakers for video conferencing. Trying to evolve the usage and the experiences our commercial customers have by using this device and not carrying all these other peripherals. We've introduced 5G, we've introduced a whole new design, premium materials, and we've also introduced Optimizer, Dell Optimizer, which takes and learns the usage of the individual user and begins to optimize applications, battery life, screen performance, and video performance, and everything else after it learns you. So it's the first commercial notebook that actually has machine learning and artificial intelligence built in to help improve productivity of the user.
All right, we got the main commercial consumer products. AJ, hit me with the craziness.
So, okay, thank you. So I'm part of our Experience Innovation Group, and one of our charter is to kind of look in the future, where things are going, how do we innovate on our experiences, how can we wow our customers. And so with that in mind, I think we decided to work on a few ideas, some that evolved the current two-in-one, the PC space, and some are even beyond that, and completely new categories. So one of the product that we showcase called Duet is a two 13.4-inch screens, and the idea there is to showcase like how you can be more productive on the go. So today, a lot of people, they sit on their desk and they have two screens, But when you go, you suddenly have one screen. Why? So if you can have two screens, maybe you can be more productive. You can have the same experience that you have on your desk. You can carry with you, and obviously, you would say, hey, where's the keyboard? So we also came up with a creative way of showing how we can use the keyboard. So it's a detachable concept. So that was what we showed. And one thing that we have changed in our thinking and approach is that we are going to emphasize on the experience first. So it can't be just kind of put some features in there and let people figure out. So that's why we actually wrote a lot of our own software to showcase these use cases. So in dual screens, there is a see and do. You're looking at something and you're taking notes. Maybe you're on a Skype call and you want to take some notes or type something. So all those productivity and enhancements work very well. You can also put in a portrait mode and with the keyboard, and you can just like your dual screen experience. So that's what we kind of showed. And of course, you can even have a single surface where you can browse the content much more elegantly. So those are some of the experiences we delivered, and we've gotten very good reviews from people on that.
All right.
So that's first concept.
Awesome.
Any questions?
You guys got it going on. Daryl, AJ, thank you very much for being with us.
Thank you.
Very quickly, I want to let you know about some breaking news. The White House is now announcing the new increased sanctions against Iran. Remember, on Thursday, the president said that we've increased them after referring to them as being severe. He said they were very, very severe, but now it's increased substantially. So you can see there, Secretary of State Pompeo is announcing these sanctions. As we get the details about what they are, we will share them with you. But this first, Aurora Cannabis is in the red this morning after a Piper Sandler analyst downgraded the stock to sell. Alexis Christoforous is here to break down the details on today's Morning Call. Alexis?
Thanks very much, Adam. Aurora Cannabis is coming off a pretty tough 2019, and it looks like 2020 is not shaping up to be much better. The cannabis producer's stock is set to go to $1. That's what Piper Sandler analyst Michael Lavery is saying. He also downgraded the stock to the equivalent of a sell over concerns about a cash crunch at the cannabis company. Now, despite Raising $80 million, Lavery notes that Aurora will probably be cash flow negative through at least the third quarter of 2021. He projects the company will have a cash deficit of more than $150 million. Now, beyond the problems with its financing, weak sales in Europe are another reason Lavery is bearish on Aurora. The company's sales in Germany have been suspended. That's because it's waiting on regulators to grant an additional authorization related to its sterilization process there. Now, in his note, Lavery writes, Aurora built its large capacity in Canada with expectations to export a significant amount internationally, but these sales have been very slow to materialize. German sales have been its highest priced and highest margin products, so the suspension of sales there hurts its revenue and margin mix. All right, let's take a look at the unenviable stock performance here. This is Aurora Cannabis over the past 12 months, down 71%. You can see today it is shedding about 8%. But not to be left out, really, in general, marijuana stocks as a whole were pretty much crushed last year. You've got Canopy Growth, Tilray, and Cronos. You can see this chart trending downward for each of them. Tilray really taking the biggest hit over the past 12 months, down 80%. Cronos off nearly 47% and Canopy down about 44% in the past 12 months. Investors simply came to the conclusion that major cannabis companies were in a bubble. Lavery suggests that Aurora should sell some of its assets this year to improve its cash position. Here's a look at how cannabis stocks are doing so far today. There is some potential good news here for the beaten down marijuana sector. That is, vaporizers, edibles, and some other forms of cannabis became legal last month in Canada, and that should at least provide a bit of a boost to sales in the new year. Back to you, Adam.
Thanks.
And coming up, racing toward Iowa, how Bernie Sanders has become the top threat to unseat frontrunner Joe Biden for the Democratic nomination. Plus, before we go to break, let's take a quick look at some of the biggest winners in the Dow today as it flirts with 29,000. Pfizer and Apple are helping it get there.
We have some more breaking news for you on the new sanctions against Iran. Secretary Pompeo, and there you see Treasury Secretary Mnuchin outlining what's going on. And what they've said is that these new sanctions will hit Iranian textiles, mining, iron ore producers, essentially the exports of those kinds of materials. They're also taking action, and that's why you see Mnuchin, against 8 senior Iranian officials who were involved in Tuesday's ballistic missile strike. Remember, they launched missiles at the Iraqi army bases that house U.S. soldiers. Pompeo said, quote, that this is that it's an effort to stop the 40-year-long effort to terrorize the world, referring to Iran's 40-year effort to do that. Also, he brought up the issue of the plane that the U.S. government believes was shot down accidentally by the Iranians. He said it's likely the plane was shot down by an Iranian missile. We're going to let the investigation play out, but it is important to get to the bottom of it.
And now it's time for Word on the Street, where we check in with our panelists and find out what stories they are watching. Akiko, you're looking at Taiwan's presidential election. Put that in context for us.
Yeah, so this is a general election that's happening this weekend. In Taiwan, normally not a country that we talk about. You want to think about this in the regional perspective, I think, because China has been watching what's happening in Hong Kong very closely. And they're really worried about what's happening in Taiwan. Tsai Ing-wen, who's the current president, is expected to get reelected. She is somebody who's been very critical of China, has not accepted the one China policy, which is essentially to say that Taiwan is part of China. So what we've seen in the past is China putting pressure on Taiwan by limiting the number of tourists that can come in, limiting the number of exports that go out. And that has really hurt the economy, or did hurt the economy initially. Now we're seeing a bit of a backlash coming back because the Taiwanese people have been watching what's happening in Hong Kong, saying we need to step up. So I think when we look at what the results are, you're going to start to watch China to see how they're going to put the pressure on Taiwan, and potentially some allies to say, look, they need to pressure Taiwan as well, come to the table to be a part or in line with the Chinese message.
All right, let's bring the politics back home, because you're watching Bernie Sanders.
Right. Also the elections, but here back at home in the United States. So we have Democratic debates coming up next week, and in just 3 weeks, so less than a month, we have the Iowa caucuses. So it's a really early chance to see how all of the candidates are going to be doing as they try to secure that presidential nomination for the Democratic Party. So a new poll came out from CBS and YouGov that actually has a three-way tie between Joe Biden, Pete Buttigieg, and Bernie Sanders. So a couple of interesting things there. I think first and foremost, one, that Joe Biden is even still a front runner, I think on some levels is a little bit surprising. He's been falling behind when it comes to fundraising totals, behind Bernie Sanders and even Mayor Pete, who also is largely looked at as a really great Midwest, middle of the road centrist type of candidate. But new reports are coming out and saying, look, Joe Biden's camp, which is still trying to forge forward as that front runner, is really looking at Bernie Sanders as the top threat to him securing that presidential nomination. So this is not the only poll that has come out recently. There are a couple of others in New Hampshire. Actually, Bernie Sanders actually has a slight lead on the former VP there. So it'll be interesting to see over the next couple of weeks how it shakes out. And also, of course, once the Iowa caucuses come about, who wins there.
All right. Well, coming up, jobs, jobs, jobs. We will look at tech sector job growth for the last month of 2019. Plus, before we go to break, take a look at some of the top trending tickers on Yahoo Finance today.
is 11:02 a.m. here in New York City, about 90 minutes into the trading day. We've got stocks hanging on to gains. The Dow, though, just barely after earlier hitting 29,000. This all coming as the December jobs report ends 2019 with a bit of a thud, adding just 145,000 jobs in the month, what it means for the year ahead. Not for sale. Grubhub denies reports the company is out for delivery and losing its charge. The details as Lime announces major cutbacks in several cities around the globe. Welcome to On the Move. I'm Julie Hyman.
And I'm Adam Shapiro. Top story today, jobs, jobs, jobs. The U.S. labor market finished 2019 on a, well, it depends how you interpret this, but some would say a sour note. December's payroll and wage growth missed expectations. Non-farm payrolls increased by just 145,000, while the unemployment rate held steady at 3.5%. We have team coverage to break all of this down for you with Yahoo Finance's Emily McCormick and Inez Ferre, who's at the New York Stock Exchange. First, Emily, please do break down the numbers for us.
Well, Adam, headline payroll growth was a disappointment. That coming in at just 145,000 for December, below expectations for 160,000. We still are seeing signs of a tight labor market in the unemployment rate. That was still at a 50-year low of 3.5%. And if we look at that closely watched U6 measure of unemployment, that dropped to 6.7%. That's the lowest level ever tracked in data extending back to 1994. And this measure includes discouraged workers no longer looking for jobs and those who are part-time looking for full-time work instead. That said, we didn't see low levels of unemployment translating into faster wage gains. Average hourly earnings rose just 2.9% in December over last year, compared to 3.1% in November. That's still holding above the inflation rate, but slowing from a recent peak of 3.4% from last February. Looking at where the jobs in December were, still mostly consolidated in the service-providing industries. No surprise there, given some of the weakness that we saw in manufacturing throughout 2019. This was particularly strong in retail and hospitality in December. Those jobs rose by 41,200 in December after losing 2,500 in November. Highest monthly increase since January 2017, and an indication of strong hiring around the holiday season and some seasonality effects due to that later holiday shopping season this year with a late Thanksgiving. Hiring trends did slow a bit in the tech-centric industries. We saw that information industries, as the BLS calls it, gained just 3,000 positions in December. That's down from a gain of 8,000 in November. We also saw average hourly earnings slow below the headline to just 2.5% in information. So that's an area to continue watching. Julie and Adam?
Thanks, Emily. And now let's head to the floor in the New York Stock Exchange. Yahoo Finance's Inez Ferre is standing by. The Dow hit 29,000. It didn't stay there. It seems as though traders down there aren't finding anything offensive in this report.
Julie, traders are telling me that the markets are sort of shrugging off the jobs report. But as you mentioned, we had hit 29,000 on the Dow earlier. Briefly, right now, we're looking at the Dow that's flat. Percentage-wise, the NASDAQ's the one that's gaining the most this morning. And let's look at some of the FANG stocks this morning, because Bernstein initiated coverage on some of those FANG names with Facebook as an outperform rating, Alphabet as outperform, and Amazon as a market perform. Amazon didn't get a higher rating because of the note citing exposure to retail and also some regulatory concerns there. And I just want to mention Synnex. This is an IT supply chain company which beat on its quarterly earnings, and also the company announced it will be splitting into two publicly traded companies, and that deal is expected to go through at the end of 2020. Julie, Adam?
Thank you. We want to talk more with the panel. Yahoo Finance's Kristen Meyer and Akiko Fujita are still with us. And on this jobs report, is there something that stands out to you, Akiko, that you think that is really going to play how an investor makes a decision today?
That last bit I'm not so sure about, but the one thing that I keep looking at is just the wage growth, and I think that's a big question mark. I know we've been talking about this all morning, but when you're looking at the kind of unemployment number that we are right now, 3.5%, it does raise the question about why are we not seeing that tick up? And I'm not sure we've gotten an answer, and it seems like with every analyst it's a different take, but I think that's still the big question mark.
I think also that, when we say that markets are sort of shrugging off the data today, I don't know that that's entirely the case. I think it might be closer to what Todd Buchholz, who was on with us earlier, was saying, is that they view it a little bit Goldilocks-y, right? That you still have growth, but it's slow enough that the Fed doesn't need to raise rates.
Right, which is also, again, this is also something that's largely been anticipated. We've been talking about that slowing growth for a very long time. So obviously we had a blockbuster of a report last month, even with the revisions down. So potentially like a one-off there, but I think that we largely got in this jobs report kind of almost what everyone was expecting. There wasn't really much to massively cheer about, but not much to be upset about either. I'm interested going forward with that manufacturing sector that Emily had been talking about earlier, particularly with this U.S.-China trade deal. We're supposed to be signing this phase 1 of that deal
Wednesday.
next week.
Yeah.
If we're going to see some of that softening in that sector, turn around just a little bit.
Well, also more
as
investment
right.
coming in, right? That's been a big question mark. But
Then, yeah,
you
the
know,
president. Well, go ahead.
No, I mean, I was going to say to your point, though, I think that even if you interpret this as a bit of a slowdown, I think the Fed has indicated it's going to be supportive, and that's what Marcus was saying earlier. That expect at least 2 cuts this year. He said starting in March, and so maybe that's why we're not seeing the big reaction you would expect from the markets.
And that's sort of in line with what Mohamed El-Erian was saying earlier in the week, that as long as the liquidity is out there, as long as the Fed is on track, unless something interrupts that significantly, this rally is going to keep going. All right, let's switch gears and talk about an individual stock, Grubhub. It's beating back those reports that it could be up for sale. Some big names, though, have emerged who are reportedly interested in acquiring the food delivery company. Yahoo Finance's Heidi Chung joined us now. And the company's saying, usually we don't comment on this kind of thing, but we're going to comment on this thing.
Hi, Julie. Yeah, that's right. So a lot of drama continuing to unfold for Grubhub. The shares have really been on sort of a roller coaster ride this week. We have shares down about 8% today, and that is because Grubhub is saying that it is not up for sale and has no plans to go on sale as of right now. So this all sort of began on Wednesday when we had that report from the Wall Street Journal saying that Grubhub had hired financial advisors to help explore strategic options such as a sale or a deal. Now, at the time, like you mentioned, a Grubhub spokesperson told me that it does not comment on market rumors or speculation. Now, the stock nevertheless soared 13% following that news. But now we have reports from the New York Post saying that several grocers, including Walmart, Kroger's, and Albertsons, are currently looking to possibly acquire the third-party delivery platform. Now, we reached out to some of these grocers and have not heard back yet. But a Grubhub spokesperson did actually respond with a comment telling Yahoo Finance, quote, "Given the considerable media speculation that appeared Wednesday, we felt it was important to clarify that there is unequivocally no process in place to sell the company, and there are currently no plans to do so." It goes on to say, "We believe that given the current pressure on profits across our public and private competition, there will likely be strategic opportunities to acquire share this year, given that our profitability is secure." So in that comment there, noting that this company is a profitable company, unlike its peers such as DoorDash and Uber Eats. But I do also want to mention here that Grubhub has been losing a lot of market share over the years. It is now surpassed by DoorDash by a lot of data companies. And so a lot of analysts have been calling for some time now for consolidation in this space amongst a lot of these larger players. Now, whether there will be some consolidation between perhaps some competitors such as a DoorDash and an Uber Eats, or maybe an acquisition by a grocer, that remains to be seen. But for now, Grubhub really shooting down those rumors that it is up for sale. Julie?
Let's talk more about this with the panel, and I am curious what your thoughts are in regards to if one of these grocers has the scale to bring in a Grubhub, because yesterday we talked about the key has got to make money. Do you use it as kind of a loss leader so that you can sell more of your stuff, but you eat the cost of the Grubhub delivery or whatever you're going to call it?
I mean, I think it depends on which of the companies would then purchase Grubhub, right? So, I mean, like Amazon, for example, has been trying to get into this food delivery space, and that wasn't one of the names mentioned, but they have essentially been trying, particularly overseas in the United Kingdom, with Deliveroo. But for Walmart, yes, they have been trying to really go after Amazon when it comes to selling their own products and their own groceries. But I do wonder if they wouldn't want to, on some way, pivot into. No, actually,
it would be a pivot for them.
It would be a pivot, but I mean, we have seen some of these companies doing some of those things. I feel like everything's on the table when it comes to this space.
It would be a pivot, but I don't think it would make sense to go straight into the kind of delivery that we're seeing the Grubhubs and the Uber Eats do, right? I mean, the reality is this is a very, very competitive space. Mm-hmm. We've seen the promotions coming through. It's kind of a race to the bottom right now. And even Grubhub themselves said, last year I think they put out a letter to shareholders saying essentially that we're finding increasingly that the loyalty just isn't there. The diners that used to come to us only, well, when they come to us, they've already ordered on a competing platform.
Right.
And so I'm not sure more players in this space actually make sense. I think this might be just a sign of the first sign of the type of consolidation we're going to see.
Well, and the other idea is some of the stories that we're reporting that a Walmart or one of the other grocery chains might be interested is that they're trying to increase grocery delivery, right? So it would be them using the platform, but I wonder if it is attractive enough on a valuation basis to buy Grubhub with all of the restaurants just to get the platform and the sort of logistics.
Right.
That to me
the
feels-
margins are already so
thought
tight.
that they could possibly build that out
themselves. I mean, Walmart already does click and
Right.
collect and does some of that. Let's move to another tech story, which has to do with scooters. Lime Scooter says it's putting the brakes on its operations in 12 cities in the U.S. and around the globe. The scooter startup also announced it's laying off about 14% of its workforce, or about 100 employees. CEO Brad Bow said in a blog post, the move comes as the company turns its focus to profitability. We've got lots of challenges for Lime and the other scooter businesses, low ridership, regulatory challenges in some markets. We have seen some of the others cut. This, to me, actually seems very similar to the story we were just talking about, where we've gone through this period of expansion in these various disruptive industries. Now you've got the contraction.
Yeah, so I think there's two things to look for in this story. One is what you said. It's the competition that's been in there. Same thing, we've expected the consolidation in space, and as the regulation starts to shake out, we're starting to see some of the players sort of cut their losses, so to speak. I think there is also this other narrative we've been following throughout all of last year, which is that companies that are looking potentially to come to market are going to have to get their finances in order. This period that we've seen of just growth at all costs is starting to, sort of cool down, if you will. And I think maybe that's what we're seeing in a company like Lime, saying, look, we're going to have to focus on profitability, perhaps investor pressure that's coming down the line as well.
Or make themselves attractive for a sale.
Right. So whom though? I mean, like Ford, or there was the...
Right, well, that's always the big question, to who? I mean, some of these buyers also even surprise me sometimes, that some of these companies even want to purchase some of these companies. But Lime is really interesting, especially that I saw that they wanted to cut also globally, because I felt like Lime was far more popular overseas, at least anecdotally, that's what it seemed like to me, than here in the United States. I almost never see them, especially not with City Bike, at least here in New York. So.
Well, coming up off the hook, why California truckers are exempt from the Golden State's new gig economy law. Plus, before we go to break, let's take a look at the most active stocks by volume on Yahoo Finance today. Stocks on the move. Take a look at Virgin Galactic Holdings. Space, remember, they just started trading publicly last year, and it is up today roughly 4%. Yesterday, we reported that their second spaceship, their rocket plane, had passed what they call the weight on wheels test, but they've also announced that they have 600 customers on the wait list after Virgin Galactic CEO George Whiteside said that Sir Richard Branson will be, we all know this, the first person to go aboard one of their planes into space. After that, all bets are off and the commercial tourism begins. The goal is still to get those voyages started at the end of this year. No specific timeline, but investors seem to like this, and it's up about 4%. What they don't like is Six Flags. Six Flags down 17% at one point today, and this comes after they warned about fourth quarter revenue, a shortfall. They expect revenue to fall between 8 to 10 million less than it was year over year. Part of the problem is China. They have been trying to expand with partners in China. One of them is Riverside Investment. Well, that partner defaulted on payments that they had to make to Six Flags, and Six Flags is saying no revenue in China. We'll be right back.
'20 could flip the script. For a decade, U.S. large cap stocks outperformed emerging markets, but will the trend swing in the other direction this year? Our next guest thinks maybe it can. Joining us now is Nuveen Chief Investment Strategist Brian Nick. Brian, you favor non-U.S. assets to start the year. I feel like we have been hearing this a lot here to start off 2020. What is your rationale?
We certainly have, and I think if you're just looking at valuation, which has seemed to favor non-U.S. assets for the better part of a decade now, that's not a good reason to invest over a one-year period. If you're looking at quarters at a time or even a few years at a time, it's not going to be a good predictor. But we think the environment is going to be somewhat more friendly to non-U.S. assets. The dollar is quite strong. We've seen a little bit of a weakness as it looks like growth picks up in the rest of the world. We have Brexit sort of behind us now. Seems like the worst of the trade fears are behind us. So in an environment where we think the global economy is actually moderately accelerating, which we think it will in 2020, that has historically been a better time to be in non-U.S. assets versus U.S. And the fact that the U.S. market has kind of melted up in the last quarter or so gives us a little bit more conviction on looking elsewhere for higher returns.
Is there a percentage that you might share with investors about you want to have maybe 40% right now in U.S. assets, whereas because of the opportunity you see, it would be good to have maybe 20, 30% in international assets, and then what would the breakdown be?
So the normal breakdown for us, U.S. versus all non-U.S., including international and emerging, is about 65-35, which is clearly a home-biased portfolio for U.S. investors. We think that's appropriate. Currency volatility tends to just add noise, so you tend to want to be a little bit more home-biased. Right now, we're slightly overweight the non-U.S. Developed part of the equity market, so we'd probably be closer to, call it 37-38%. Not a huge overweight at the moment, but one thing we think we could potentially add to it if it looks like we've gotten the call right in a macro sense, and it looks like that this is going to be a better year for international. So far, so good on that front.
So aside from developed, though, you also have your focus on emerging markets. What specifically are you looking at right now? Are we talking China? Are we talking maybe Southeast Asia? What are some markets you're liking?
So high conviction areas in emerging market equities are Brazil and China. We obviously need to see, I think, that the signing at least of the trade deal, and then some nod towards what the next steps are going to be to make sure we don't kind of relapse from this like we have from past deals. Brazil finally looks like it's delivering on the growth front. It's been a disappointing growth story for about 3 or 4 years now. We keep waiting for Brazil to kind of escape. This looks like the right moment for it, and that we think will also benefit Latin America. We're also pretty bullish on the fixed income side. That's where we have more of our emerging market overweight, because if you compare emerging market bonds to bonds in the U.S. market, the spreads on U.S. bonds, corporate bonds, are basically at their cycle lows. Emerging markets are not even at their 12-month lows. So we think there's more room for convergence there. Some of that is this, I think investors are a little bit skittish because there's been all that risk around EM and the trade war for the last 2 years or so.
So, Brian, when we look at U.S. equities, obviously earlier we were talking about how the Dow hit that 29,000 level. I'm wondering, as you're looking ahead, what catalysts are you thinking about could be pushing those markets higher, especially as we have soothing when it comes to U.S.-China trade, Iran, kind of the market shrugged that off a little bit, same with impeachment news. So what catalysts are you looking at ahead?
Yeah, the unfortunate thing is we think a lot of the catalysts are behind us, which means that we think a lot of the progress has already been made in the markets. Our target for the U.S. market at the end of this year is about where it is now. We're not looking for a lot more kind of upward surge because a lot of the things you mentioned, the Brexit kind of resolution with the UK election, the US-China trade deal, the Fed having delivered 3 rate cuts and seeming like it's not likely to deliver a lot more, at least based on the data that we're seeing. It's hard to find that catalyst. Where you could find it, though, is the big missing part of the market story last year was the individual investor was pulling money out of stocks all year, out of ETFs, out of mutual funds tied to stocks. If you start having a fear of missing out trade, you start seeing people looking at their fourth quarter statements saying, gosh, I should really be in this market. We were up 32% last year. That has historically given another leg or two to a bull market run, not just in this cycle, but in prior ones.
And that could also presumably finally bring back the volatility to the market that people have been looking for. Because if individual investors finally get in and then there's a pullback, could that exacerbate a pullback, for example?
It could, and not just in the equity markets. I mean, look at the inflows into municipal bond funds last year. $1 or $2 billion a week going into municipal bond funds. So not that big a market to take that many inflows. And as a result, that was an outperforming asset class last year. If you start having people pull money, not just out of cash and off the sidelines, but out of bond funds or other funds that they've been kind of storing money in, waiting for the right moment, if they think this is now the right moment for stocks, you could see volatility in both directions.
With the municipal bonds, wasn't that a tax play? And when you talked about emerging market debt, essentially, we had a guest on yesterday who warned, especially because there's this fear of missing out, as people are chasing yield and willing to take on risk, that one good recession tips a lot of these emerging market governments into a really precarious situation because they have taken on too much debt.
Some of them have, but we also think it's a much more diversified asset class, sort of internally diversified than it's been in the past. These economies don't rely as much on the big macro story as they once did. So you're going to have the turkeys. That's going to be every year. You're going to have a story like that where there's a government that sort of gets things upside down. There's an outflow and there's a big sell-off in the bond market, but that doesn't necessarily translate into struggles in, say, East Asia or Latin America, the same way that it might have done in the mid-2000s when it was very much kind of an up or down trade.
I think you may have answered it in this question, but I was just thinking that, we often think this correlation between stronger dollar and EM, right? That's usually not a good thing for dollar-denominated debt with EM. So does that suggest that you think the dollar is going to continue to push lower? It's going to be weaker? If you're putting your money in EM and you're expecting that to push higher, what does that mean in terms of the trajectory for the dollar?
Yeah, we have a sort of a moderately bearish call on the dollar. I think if we see the dollar move a lot this year, it's going to be against emerging markets in a weaker direction. I don't see a lot of momentum for stronger euro, stronger yen this year because those trade very much on interest rate differentials. And while we may see higher interest rates across the board this year, I don't think we're going to see Europe catch up to the United States. I don't think we're going to be seeing any hawkish rhetoric out of the ECB, certainly, or the Bank of Japan that would make people think that, gosh, I should now maybe consider owning yen or euros. If you start thinking about other currencies, though, it seems like every morning we come in, the Brazilian real is doing a little bit better. Other kind of higher beta emerging market currencies doing better on days when there's not a lot of new news, and even kind of weathered the Iran conflict, which seems like it's now kind of off the front burner relatively well. So we're actually pretty optimistic that EM currencies are poised to do well, not because the dollar is going to be weak necessarily, but because those areas look more attractive to global investors.
Brian, Nick, good to see you. Thanks for coming in.
You too. Happy Friday.
Thank you. You too.
A Los Angeles judge ruled in favor of California truckers, exempting them from the new gig economy law because they are subject to federal statute. Yahoo Finance's Melody Hom has this story for us. I imagine there are some people cheering, but others might be upset.
Yes, this is a contentious issue, Adam, and of course you're referring to the Assembly Bill 5, or otherwise known as AB 5, which went into effect on January 1st of this year. It has been met with a lot of scrutiny from all sides, especially the truckers. And the Trucking Association has, it's been an archaic industry. The infrastructure is already there. So unlike the Uber and Postmates of the world, which have filed a lawsuit against California as well, they have been very much gung-ho on making sure to maintain their independence and try to remain as contractors. Just taking a step back, AB5, of course, is trying to make sure that businesses do not exploit gig workers, providing them with basic benefits like health insurance, workers' comp, and the like. However, we have noticed that a lot of individual workers, even Uber drivers and Postmates drivers themselves, have been repeatedly saying that they would rather be independent and flexible. We also know that freelance writers, looking at our own industry of journalism, have filed lawsuits as well. On this specific case, Judge William Heiberger of the Superior Court of Los Angeles did say in his ruling that AB5, quote, clearly runs afoul of the federal law from 1994, which actually regulates interstate commerce across all 50 states. I do want to point out that there has been a macro trend of course, a trucking shortage across America, and I think this is an industry-wide issue that's been plaguing the trucking sector, specifically because of aging drivers and a lack of ability to really recruit female drivers into these positions. So this is an ongoing issue. There's a separate case that actually will have a hearing on Monday as well, but it looks like most of the truckers in this case are very happy.
Melody, really interesting as we continue to see the fallout from that gig economy law across California. And we want to thank Akiko and Kristen as well for being here for this first 90 minutes of the show. Coming up, new jobs data suggests U.S. companies now employ more women than men. Plus, Brian Chung declares bankruptcy. We'll explain what that means and how he ran his company into the ground just ahead. It is 11:30 a.m. here in New York City. 2 hours into the trading day, 2 hours into the trading day, and stocks are mixed right now. So earlier we saw the Dow hit 29,000. We saw the Dow rising. It has gradually been giving up those gains, and now it's down 1/5%. The S&P 500 is now very little changed. The Nasdaq still hanging on to a scant gain of 13 points. Paying up, Taco Bell makes a big play as it competes for workers in the tight labor market. Banking on the competition, Amazon reportedly plans to cash in by selling ads on its competitors. And bankruptcy is a scary word, but just how does it work? We'll break it down in this week's Yahoo You. Welcome back to On the Move. I'm Julie Hyman. Well, in a tight labor market, companies may use incentives to draw employees in. Taco Bell is the latest. It plans to test a manager's salary of $100,000 and paid sick leave. Irina Novoselsky is CEO of Career Builder. She's with me now. And obviously you have a good perspective, Irina, on various different industries and what we're seeing. Today we learned that wage growth was only 2.9%, but then we get these kinds of examples, right? So are we seeing any kind of differential, say, on the executive level versus the other level and in different industries? What are you seeing?
The overall wage growth is a little misleading because of what's happening in different geographies and different occupations, as you saw with Taco Bell today. But one of the things that's really overarching the wage growth conversation is really the labor shortage that's happening in America, which is how a lot of these companies are responding because they're all competing for the same talent. We have over 1.5 million more jobs than there are people to fill them. And so the only way you're able to attract people into your role is having them leave their existing job and come on over. And so it gets really creative on how you're able to bring those candidates to your company.
Right, because in some places, to your point, not only do they have to leave their existing job, but in some cases they have to leave their existing town, their existing community. And we have seen during this current economic expansion, people have been less willing to do so. So as you work with companies who are looking for employees, how are there ways of nudging people to do that? Is it a matter of paying more, or is there more to it than that?
Definitely. Well, the conversation has also changed over the last 10 years. That volume used to be the name of the game, that if you got enough resumes, enough applications, you could manually go through them and find a fit. In today's environment, that's an impossibility. That just cannot occur. And so really, it's no longer a recruiting problem, it's a technology problem. And how do you leverage AI to go into markets that you normally wouldn't have gone into, to broaden your candidate applicant pool? For example, you start looking at skill sets, not just at resumes. So the question goes from have you done it to can you do it? And really looking at the underlying skill set of candidates, and sometimes not really waiting to find the 90% or 100% fit, but giving people more of a chance to work into the role and really grow into the role.
I also want to talk about diversity and gender specifically because Betsy Stevenson, who's an economist today, tweeted that women now hold 50.4% of all non-farm payroll positions. So just a little over half of the workforce. How is that playing out on Career Builder? What are you seeing reflected there?
It's changing the way that employers are targeting these candidates. So one of the things that we see with our successful clients is being a little bit more creative. You mentioned also the city dynamic that's happening, that there's not enough candidates in the big cities to fill the job demand and the job growth. And so companies are going out into suburbs and they're going out to get that female population. And so one of the things that they're looking to offer is a more diverse route to work. So whether you're working from home one day, whether it's more flexible hours. The other thing we're seeing is actually we have a 5-generation workforce, which is really rare in today's economy than versus what we had 10 years ago. And so how are you attracting the older generation while at the same time bringing in Millennial Z? Because they're looking for very different things. And so companies that we work with that are seeing success is not having a one plan for all, but actually targeting different plans for different segments of their population.
Are you also seeing companies sort of put forward in a way that they might not have before some of the benefits they might be offering? Paid maternity leave, for example, or some of the other flexible family offerings that you're talking about. You know, whereas before, maybe you would have to get in for the interview to find out that information.
Right. The benefits package is definitely what's helping to draw candidates in. It's also paid paternity leave that is continuing to show up more and more. It's also things that are very soft too, in the sense of having more days off or more of a culture. One of the things that we are seeing is that people are not leaving to get more money as much, but actually leaving to get a different boss. And so the culture, what a company stands for, their mission, their values, is really becoming more and more critical on attracting the type of candidate that they want to.
Really interesting. Thank you, Irina. Thanks
Thank
for
you,
being
Jen.
here. Irina Novoselsky is CEO of Career Builder. And coming up, going bankrupt. What does it mean? What are the options? We'll break it down in this week's Yahoo View. Plus, before we go to break, let's take a look at the winners on the Dow right now. Even as the index itself slips into the negative, Pfizer still rising.
UK employers increased their number of new permanent staff for the first time in a year. Let's go to London and Yahoo Finance's Edmund Heafy, who has details for us. Edmund?
Well, Adam, this data is yet another sign that business optimism in the UK has increased in the wake of Prime Minister Boris Johnson's emphatic general election win. The Permanent Staff Placement Index from a key recruitment trade body hit 51.9 last month. That's the highest level since December 2018. And a broader index also published by the trade body of employment demand hit a 3-month high in the same month. And now official data from the UK government lags behind this private sector data, but in the 3 months to November, we had seen the biggest loss of jobs in 4 years. So today's data suggests that there has very much been a turnaround. And it follows Purchasing Managers Index data from earlier in the week, which showed that there was an increase in business optimism from before the election and after the election.
Thanks, Edmund. Appreciate it. Well, the retail apocalypse striking again this week with Pier 1 announcing massive store closures and rumors spreading that the company could be headed for bankruptcy. But what will happen if the company does go bankrupt? And what different bankruptcy options could Pier 1 choose? It's time for Yahoo You. Yahoo Finance's Brian Chung is here with this week's lesson. Brian.
Well, class is in session, and today's topic is a little bit of a downer. That's options for bankruptcy. And let's illustrate this with a made-up company. So let's call it Chung Shoes. Again, I manufacture sneakers, and the times are really tough for me. So I declare bankruptcy. And ever since we made that play to buy crosstown rival Chung Shoes, I've been saddled with so much debt, I haven't been able to see the sales that I need to recover the amount of money that I owe. So it's time to work on my bankruptcy filings. Now, there are a few options that we have here, but the two big ones are detailed in Chapters 7 and 11 of the U.S. Bankruptcy Code. So let's unpack a little bit. So first of all, we have Chapter 7, and this is when the liquidation really begins. First off, any outstanding leases get cut off. So the good news is I'll be discharged of the loan balance on the company car, for example, but unfortunately I also have to give the car up. Now, for companies, this could be huge. So think about other things that I might have leases on. So office space, warehouses, the chief executive's private helicopter, etc. A trustee in this case will also be appointed to then liquidate the rest of Chung Shoes' assets. So things like my trademarks, the intellectual property of my sneaker designs, even the remaining inventory of my sneakers. Now, what happens with the money that the trustee is able to scrap together with those sales? Well, they're paid out to the lenders. So Adam and Julie in this case, probably for less than the principal that you lent to me in the first place, but this is a full wind down. So sorry guys, you're gonna get whatever you can possibly get. Now, if this sounds like complete closing the doors, well, you're right. This is exactly game over. Basically, all the assets are liquidated in a Chapter 7. But what if you want to clear some of your debts, but you want to leave your assets, at least some of it, to have maybe one more shot at a comeback? Well, then you can do a reorganization, or what they call a Chapter 11. And in this case, Chung Shoes would submit a debt repayment plan to the bankruptcy court. So it'd be my plan to pay down all the debts that I'm due, even if I don't have the money right now. So I could say I do some things differently with my business to improve revenue by, let's say, 50% over the next 3 years, and then use that money to pay my creditors. So Chapter 11 means I don't have to sell my house. That means that I don't have my personal assets at risk. So under Chapter 11, as an executive, the only personal assets that I have at risk are the value of the stock that I hold. Now, the same goes for all the other stakeholders in the company, but I do want to mention that this is generally speaking. So in a sole proprietorship, for example, my personal assets actually would be on the line, so it does have something to do with incorporation. But it's important to remember that Chapter 11 is a two-way street with my creditors. So again, Adam and Julie are the ones that I need to pay back in the end. So if they dislike my plan, they say, you're never going to get that revenue up, they could convert this Chapter 11 back to a Chapter 7 and say, you got to close your doors entirely. And in fact, the creditors could actually be the ones to bring me to Chapter 11 in the first place. So it doesn't have to be me deciding that I think Chung Shoes needs to declare bankruptcy. It could be those that actually have stakes in those loans as well. Now, according to the U.S. court system, there were over 773,000 bankruptcy cases filed in the U.S. in 2018. But this also includes personal bankruptcy cases, so it's not just companies. But you'll notice that the majority, that's the purple here, 61%, were Chapter 7, and that's the full closure. And this represents obviously the largest part of this pie chart. Do you notice that only 1% a little sliver, that's the blue bit, is actually covered under reorganization under Chapter 11. Now, it sounds like Chapter 11 might be the more attractive way to go for bankruptcy because at least it offers a way to bounce back, but it's very difficult to pull off. I mean, imagine that creditors would be skeptical. If my company had poor management to get myself in the hole in the first place, it'd be hard to see how the same management could get it out. It is important to note, though, that there have been success stories in the past. So think about 1996, Marvel. That small comic book company, they actually climbed out of Chapter 11. And then there's also all the major airline carriers. So United filed for Chapter 11 in 2002, Delta in 2005, and also American Airlines in 2011. So guys, a lot of different options here for Chung Shoes. Whether or not you guys will get your money back in whole, a little bit of a different question there.
Let's break down bankruptcy a little bit more, and we want to introduce our other panel person today, RSM Chief Economist Joe Bruce-Wallace and Yahoo Finance's Brian Chung, as he's emerged from the teleboard as opposed to bankruptcy. Sears, I'm going to use this as an example. I believe it was a Chapter 7, and yet some of the assets were sold back to the people who had been the hedge fund that messed everything up, went to 7, but they bought back those assets, and now there's a portion that operates out of bankruptcy while Sears Holdings remains in bankruptcy.
Right, the mysteries of U.S. bankruptcy court, which Brian very nicely simplified. I think, what's interesting also here is we're, on Wall Street is thinking about the role private equity plays, right? So if you're a private equity company that takes over that and you saddle that company with debt, the expectation is you will see an increase in bankruptcies. And of course, that's become a very big issue, not only in the financial system, but in Washington, D.C., where there's basically a bipartisan consensus to put a stop to that. So I think, Brian, you got quite a story. It's going to go on for a number of years.
I want to take a step back from corporate bankruptcies and talk personal bankruptcies as well, which are a little bit different, but perhaps a better economic indicator, right? Because corporate bankruptcies do tend to be more rare. You said what, 773,000
total, including
total in 2018. What does the indicator look like over time, and what does it tell? Is it a forward-looking economic indicator?
Oh no, for sure it is. It coincident and forward. I mean, when we went through the recession, obviously jingle mail was very popular. People were sending back keys to homes and keys to automobiles. Of course, the balance sheet of the consumer is much better than it's been in any time in my lifetime. The U.S. savings rates, near 8%. If you decompose the segments of different income quintiles and households, you still see the bottom 2 quintiles are spending about 105 to 107% of their income. So there's always a risk. Once the business cycle comes to an end, you will see an increase in bankruptcies. The last time I think we actually saw sort of an increase in that was when we had the massive decline in oil prices 2014, 2016.
And another element that I didn't necessarily highlight is the fact that during Chapter 11 reorg, for example, a lot of the debt repayment is temporarily stayed while all the parties try to figure out exactly what the proper reorganization plan is. And that's the reason why we have what they call zombie companies, right? These companies that appear to be going through bankruptcy through perpetuity. I mean, Sears is an example of a story that continues to drag on and on and on, even though the fundamentals of the company haven't necessarily shown themselves to be a viable business model. The reason why they can do that is because the constant back and forth in the courts between the company and the trustee, between the company and those parties that they need to repay, are constantly trying to figure out what the best strategy is. At least for that time being, while they're negotiating, they can just kind of continue to fly by the seam of their pants because they don't need to pay those bits while those negotiations are happening. But that's the reason why you'll see it for many years in many cases. These companies just kind of drag on their bankruptcy proceedings.
Let's switch gears and talk about fourth quarter earnings season, which gets into full swing next week. The big banks are going to be in the spotlight in particular, as we hear from JP Morgan Chase, Citigroup, Wells Fargo, among those that are reporting. Some of the early chatter I'm seeing is that perhaps net interest margin has bottomed and that we're going to start to see improvement, if not in the quarter that we're reporting, maybe perhaps in the first quarter.
Well, I mean, bottomed is definitely something that maybe some of the bank analysts and the banks themselves would like to think. But what we saw is that in the last quarter, that was the third quarter of last year, that really we saw double-digit net interest margin decreases. And for those that aren't familiar with net interest margin, that's the difference between the money that you collect on interest versus those that you pay on deposits. For example, the big banks have had a really difficult time in an environment in 2019 where people thought maybe there would be a recession, right? You think about the yield curve inverting in August, that obviously inverted the yield curve, which made it hard to lend long and then borrow short. We've since seen it start to steepen. So maybe there is some optimism that there would be a bottom. But again, the banks have been punished, at least when it comes to to where their stocks were trading in the first half of the year last year. But it's since rebounded pretty remarkably to a point where a lot of these stocks have actually been outperforming.
Yeah, they've had a spectacular close to 2019, and we're going to have to see much faster growth, I think, to justify some of the valuations here. You know, the problems at Boeing are going to show up in the first quarter.
At the banks.
At the banks. Of course it is, right? You're going to see small and medium-sized enterprises all over the country have problems because essentially production is going to be shut down.
Well, we just heard Spirit Aerosystems saying it's going to lay off 2,800 people.
Yeah, right. They're going to be layoffs. Remember, the ex-Boeing CEO said there'd be no layoffs. There's going to be a lot of layoffs. So we'll see how this goes. I mean, we all of our 401ks are enjoying this right
You mean
now.
our 409?
409, because I wasn't going to go there, but yeah, the 409k, mine's exploding. Look, it's good. Americans are confident. Americans have been more confident in CEOs right now, right? That's good. Things going to take us into the first portion of this year. But again, we're going to need to see a much more pronounced economic acceleration to justify the valuations, not just in finance, but across the markets themselves.
All right, well, coming up, a grande size salary, how Taco Bell managers could be headed for six-figure numbers, plus saving money, the amount most Americans should have in their household savings accounts.
All right, we have breaking news in this regards. Nancy Pelosi and the articles of impeachment. She has said, quote, I have asked the Judiciary Committee Chairman Jerry Nadler to be prepared to bring to the floor next week a resolution to appoint managers and transmit articles of impeachment to the Senate. I will be consulting with you at our Tuesday House Democratic Caucus meeting on how we proceed further. So this coming from Nancy Pelosi's message to Democrats in the House. Bottom line, she's prepared to send the articles of impeachment to the Senate for a trial and asking that managers be appointed by the House to prosecute essentially whatever's going to take place in the form of a trial in the Senate.
It's time for Your Money, where we talk to our panelists about the money moves you should be watching. Brian, Taco Bell. Not usually what we think of.
What I cover, but it is an econ story, right? So there's it came out earlier this week that the fast food chain will be offering salaries of about $100,000 to some of their managers. So again, not everyone online, but managers of their store locations. This is very representative of the type labor market that we're seeing right now. And incentives need to go up if people want to find talent in a labor market where it's really tough to find workers, especially in the managerial level, people who have the right skills for those jobs. And Julie, you were talking about this in an earlier segment, but there is something to be said about whether or not this is a trend in the larger economy for maybe wages being bid up. And I know, Joe, you've seen some stories of this as well.
Well, that's right. I mean, look, you think about their parent company, Yum Brands, right? They had a very difficult close to last year. I think they were down 8%, right? Where the competitors were up. They're going to have to continue to get into that market to attract other talent, probably from their competitors. You think about, what does $100,000 mean in this market, right? Well, if you're in San Diego, you can buy a nice, one-bedroom condo for about $350,000. You can have a decent life, but it depends what the firm's asking of you. If you're just going to run the store along the rules as a franchise, I think that's okay. If you're expected to drive sales, however, they're going to have to offer much more. What were saying in the break? Who's offering $160,000?
Jack in the Box.
Jack in the Box, yeah.
Has already been paying much more than that.
But why, when we see a headline wage growth rate of 2.9%, and we hear these kinds of stories, talk to me about the mechanics of what that 2.9% measures and why it doesn't seem to reflect these kinds of stories.
Okay, well, it's supervisory and non-supervisory workers. You're tending to see the greatest portion of wage growth at the lower end, primarily due to the movement of the Great 20 metro cities moving towards $15 an hour. These are nice anecdotes. It's sort of, I was thinking about, it's the holy trinity on U.S. Employment Day: employment, wages, and equities, right? It doesn't really tell us much about the true state of the labor market. In fact, not to be Debbie Downer here, 2.9% this year means we didn't really see an increase over what we saw the year before. I mean, it's just not happening.
Peaked at around 3.4 in February
It's
last
easy
year,
to get a job, but it's hard to get a raise, right?
All right, so you're watching household savings rates. We talk about debt a lot, but why savings rates?
Well, I think it's appropriate near the end of the cycle to begin to look at what the U.S. Reserve is when it comes to smoothing out spending should we see an economic downturn. Right now, I'm fairly certain that the upper 2 quintile of income earners have increased savings significantly, and this is excluding their portfolios. So I'm not expecting to see a repeat of the last recession where you saw the wealthy pull back. It's the first time that's ever happened. Little concerned about the bottom two. And then the middle class is going to muddle through, as they always do, but they're going to bear the transition costs in terms of employment.
Okay, now I realize that savings might be a little bit different, but we keep hearing when we bring up the bottom 2 quintiles, yes, but the income to debt ratios have improved vastly for people. Why might that be a mistake to say that in this discussion?
They have relative to where we were prior to the recession. They're still spending more than they're earning. Therefore, they're going to have a much larger burden of adjustment in real terms once the business cycle comes to an end. So if you're a forward-looking investor, say 12 to 18 months out, you probably want to start reducing your exposure to those brands that target those households.
Well, and it also has political implications because it implies if income inequality is a really wedge issue now and one that a lot of people are concerned about, that's going to widen. Those people are going to fall off further.
And that's an understatement. It's going to be a chasm is what's going to happen. And that's one of the reasons why we want to start talking about I know this is going to kill everybody, automatic stabilizers. Once the unemployment rate hits a certain rate, you need to get that aid to them quickly, direct cash into pockets. Don't do tax cuts. Get that money to those people as soon as you can. That's going to smooth out the business cycle.
Whether or not Congress can do anything on that as a whole.
Well, Andrew Yang can.
Yeah, Andrew Yang certainly could. Yep.
He's got a proposal.
Coming up, where are the jobs? The December jobs report ended a disappointing year. So what can 2019 tell us about 2020? We're breaking down the numbers. And Microsoft has enjoyed a big turnaround since Satya Nadella came to the top job, with shares climbing nearly 250%. On Monday, Brian Sozzi is going to tell us how he did it, or he's going to ask Satya Nadella how he did it in an exclusive interview. Make sure you tune in.
We're coming up on 12 p.m. in New York City. We are 2.5 hours into the trading day, and stocks, well, we've pulled back off of what had been some session highs. You can see we're fighting to go back positive, at least with the S&P 500. We'll talk about all of this. The Dow did hit 29,000 earlier this morning. Help wanted. The December jobs report ends 2019. Disappointing expectations, but 2019 turned out to be a pretty good year when we look at that. And we're going to get into the jobs report in just a bit. Email outrage. Boeing is back in hot water after internal communications hint at a possible cover-up regarding problems with the 737 MAX 8. And not out yet, Democratic presidential candidate Tom Steyer. He made the debate stage, but can he still hope to challenge the frontrunners? More on the billionaire's White House hopes. Just ahead. Welcome to On the Move. I'm Adam Shapiro.
And I'm Julie Hyman. Thanks so much for being with us. Our top story today is, of course, jobs, jobs, jobs. The U.S. labor market finished 2019 with a little bit of a thud. December's payroll and wage growth missing expectations from economists. Non-farm payrolls increasing by 145,000, while the unemployment rate held steady at 3.5%. We've got team coverage to break all of this down. Yahoo Finance's Jessica Smith is in Washington, and Inez Frey is at the New York Stock Exchange. Jess, let's start with you. What's the take on the jobs report?
Well, as you mentioned, there were 145,000 jobs added in December. That did fall short of expectations of 160,000. The unemployment rate steady at 3.5%. Wages did also come in lower than expected. Average hourly earnings rose by 3 cents to $28.32. That's a 2.9 increase year over year. That's the weakest wage growth we've seen since July of 2018. Economists were looking for 3.1% growth. And then we want to look at a few of the industries that stand out. Retail added 41,000 jobs. Healthcare added 28,000. Leisure and hospitality added 40,000. Mining lost 8,000 and manufacturing lost 12,000 jobs in December. In 2019, manufacturing added just 46,000 jobs versus 264,000 the year before. Both the November and October jobs numbers were revised downward for a total of 14,000 fewer jobs than previously reported. But one highlight of this report was U6. That's the broadest measure of unemployment. That is at 6.7%, which is the lowest on record. And finally, looking at 2019 as a whole, 2.1 million jobs were added. When you look at 2018, that number was 2.7 million.
Let's head to the floor of the New York Stock Exchange, where Yahoo Finance's Inez Frey is standing by. What's the trader reaction been, especially since we hit 29,000 and then pulled back?
Yeah, I just was talking to some traders just now, Adam. They're saying they're still not too concerned regarding the jobs report, especially because the previous months had come in strong. But you are right that we did see a pullback. We had hit 29,000 on the Dow, and then the Dow went into red territory, and now the S&P is also in the red. The Nasdaq's trying to hang on to the green. If we look at the Dow components, though, we're looking at Boeing as one of the big laggards on the Dow right now, down more than 1.5%. After Boeing released that batch of internal memos regarding the 737 MAX jet. And then one of Boeing's biggest supplier, Spirit AeroSystems, says that they will be laying off some 2,800 workers in Kansas. That's more than 15% of its workforce. This is because of the production of the MAX, which has been halted, and also uncertainty about when the MAX will go into service again. Adam, Julie?
Thanks, Inez. Let's get back to the jobs number specifically and take a deeper look with Guy Berger. He's principal economist at LinkedIn, which of course also comes out with its own jobs measures. And I want to ask, first of all, how what you guys have been saying lines up with what we got with this month's jobs number.
Yeah, first thing, good to be here, Adam, Julie.
Good to have
looking
you.
back at the last 6 months, both in the BLS data and our data, the first half of 2019 was really not great for the job market. You know, we saw the unemployment rate decline stall. We saw the share of prime working age Americans decline in the BLS data. The non-farm payroll growth slow down, and we've seen it pick up. So even though there was not a great Friday in the BLS data, a great December in the BLS data, the second half of 2019 has looked about the same as the second half of 2018. In our data, same thing. You know, the hiring rate leveled out in the first half of 2019 and has really picked up. It's up about 5%. Since the late spring. So, you know, we are seeing some regained momentum, and we're curious to see where that continues into the first half of 2020.
I'm curious, Guy, about the migration issues, because once again, you've highlighted that Austin, Nashville, Charlotte have done very well for LinkedIn job hunters who are willing to move. But other cities are they're attracting people, and we keep hearing about the outflow from these places, but Chicago, New York City, they're attracting people in?
So I think these places, in some sense, are experiencing this long-running trend that's going back not just to this recent expansion, but decades, which is people moving out of the, of the Northeast and Midwest to the Sun Belt, to the Southeast and Southwest. Both better weather, in some cases more affordable housing than in places like New York. And I think, if you're in a place with good weather and relatively affordable housing, you're going to attract tons and tons of people and add a lot of jobs.
Hey, Guy, Brian Chung here. Now, the labor force participation rate still unchanged at 63.2%. So yes, it's fine that we have a good unemployment rate still at 3.5%. But is there still more room to pull people from the sidelines here? And how do you do that? Is by basically filling the gaps with employment because we know people are looking for jobs, or is it retraining that's really at the core of the issue?
So I think there's definitely more room to grow. I think, some of the flatness in labor force participation is demographic, but, we continue to see the prime working age employment population ratio go up. It's now the highest it's been since 2001, but it's not at where it was in the peak in the late 90s. And I think there's more room to expand. I think it's possible that unemployment is going to go even lower than we've seen. This unemployment rate seems really low, but maybe in a year it's going to be even lower than this. I definitely think there's more slack in the labor market. Wage growth, leaving aside the tick down this month, it has picked up, but it's still not where it's really exerting much inflationary pressure on the economy. So I would be surprised if the labor market doesn't continue to add workers in the coming year.
Guy, Joe Brusuelas here. There's a real interesting debate among professional business economists about the quality of the jobs the economy is generating. Why don't you take us in and tell me what you think about the December quality of the jobs that we're producing?
Well, I will tell you that specifically December, a lot of the jobs were added in retail. I think it's something that we noticed in our data and showed up in the BLS data. December was a really strong retail hiring month. And retail jobs, on average, tend not to pay that much. So I think within this specific month, we can say quality was up, quality was down. I'd say the thing that will do more to raise job quality than anything is labor market continue to be tight, raising wages across the board. We already know from a bunch of data that pay growth at the lower end is actually higher than it is at the higher end. We see managerial pay growth actually slower than non-managerial pay growth in today's report. And I think that trend should continue as long as the labor market's getting tight. It's gradually helping people that work in traditionally lower paying, lower quality jobs.
Guy Berger, principal economist at LinkedIn. It's great to see you. Thanks so much for joining us.
Thanks, guys.
And Joe, I just want to turn back to you, not only on the quality of the jobs, but the quality of the data, because there's an interesting note out from UBS that was highlighted in this morning's Yahoo Finance Morning Note that pointed out the way the BLS calculates data. Even if a business has closed, the BLS presumes another business has opened in its place and will be hiring at the same rate. And so UBS says these numbers are actually worse than they look.
Yeah.
What's your take on that?
Well, this isn't my first rodeo in terms of business expansions. The guys at UBS are spot on here. There's always a bias towards, growth in the BLS data, and there are some very rosy assumptions. Now, next month, we're going to get a benchmark revision going back to March 2019. The early estimate within the data implies we should lose roughly 500,000 jobs from the total produced in 2019.
This is the annual
benchmark,
that
yeah.
they do, right?
Right. This is the sort of thing you get if you subscribe to bank research or you happen to work at a systemically important research bank. Other than that, you don't see it. But mark this down. When we reconvene next month, you'll see that come off. And actually, the BLS has got a pretty good estimate, if you break it down by industry, where it's located. And really, the only real increases are in trade and transport. Everything else looks pretty bad. So these labor market dynamics are not going to look so rosy next month.
And you could add quickly, it's the same with wage growth figures, right? Yeah. The BLS does not control for changes statutorily to minimum wages in many municipalities, like in Los Angeles, for example. We know as of January 1st this year, in a lot of cities and a lot of areas, they've ratcheted up the minimum wage. So yes, people are paying more, but how much is that eating into these margins where some of these businesses might be closing too? So that remains a question.
And those year-ago comps when we get to mid-year are going to be awful, because mid-year we peaked at the 3-month average annualized pace right around 3.6%. Right? You're not going to be beat those. So yeah, we need to think about this in terms of equity valuations as we move forward into this year.
You're going to be back to talk about all of that, but you're not going anywhere just yet. Boeing shares in the spotlight after newly released internal communications between Boeing employees reveal their concern over training requirements for the 737 MAX. Now, in these messages, employees write about fooling FAA regulators and pressure to keep training in those the plane simulators to a minimum. Yahoo Finance's Alexis Keenan joins us from the newsroom. She's got more for us. Alexis?
Yeah, Adam, really disturbing to hear what goes on behind the scenes here. The bulk of these messages are between Boeing employees talking about the certification as well as the simulator program that was being developed for the 737 MAX. Now, remember, the simulator is a physical replica, basically, of the aircraft so that pilots can get more robust training for the feel of the new aircraft. These documents, they span from 2013 until 2018. That's during the time when both the MAX plane and the simulator program were being developed. At that time, Boeing had a couple of goals with respect to those programs. One would be to keep the FAA from requiring the simulator training, which they actually achieved in 2016. Now, some would argue that they achieved it because they omitted certain information about that MCAS system from the FAA. But the other thing that Boeing needed to do during this time frame was to make sure that customers would not necessarily need to have the simulator if they didn't want it. Now, they're really pricey, these simulators. In Southwest's contract with Boeing to buy their aircraft, they had a $1 million reimbursement that would go to the company if it was required by the FAA to have this simulation. So I want to read to you some of the comments that are contained in these now released documents, and note that this is after after the first 737 MAX was delivered to its first customer. In 2018, a Boeing employee asked a colleague, "Would you put your family on a MAX simulator-trained aircraft?" "I wouldn't," and the colleague responded, "No." In another exchange, an employee said about the MAX that this airplane is designed by clowns who in turn are supervised by monkeys. Now, in an earlier exchange back in 2016, there's a Boeing employee referencing a woman who's involved in the certification of the aircraft, not exactly sure what exactly her role is, but saying that she knows that she'll get, quote, crucified if the simulator training is required at a certain level. Also comments from Boeing's chief technical pilot saying that it will cost tens of millions of dollars to Boeing if the requirements for the simulator training were increased. A statement from Boeing, though, says that these communications happened early in the service life of developing the simulators. They said that since that time, both internal and external subject matter experts have repeatedly tested and qualified the simulators at issue. The company says, "We regret the content of these communications and apologize to the FAA, Congress, our airline customers, and to the flying public for them." Meanwhile, today, Spirit AeroSystems, that makes 70% of the fuselage for the Boeing 737 MAX, they announced layoffs in their Wichita facility. Those will start on January 22nd. Adam and Julie?
Alexis, what happens now? Because even though the company has been a little bit more proactive in terms of apologizing quickly for this, what's on tap in terms of further congressional hearings, for example?
So we did hear so far from Ted Cruz, who is being really critical of just hearing about this information. He said in a tweet, "The fact that we are just now seeing these documents is unacceptable." He said Boeing needs to explain to Congress why, after multiple hearings, that we're just hearing about this correspondence now. I've also heard from one of the lawyers representing the bulk of the victims' families in the Ethiopian Airlines crash, saying that Boeing has withheld this information from them, trying to keep it out of discovery in their lawsuit, calling the information irrelevant. So I think you'll see a big push for Boeing to really disclose all of its cards here. This information just keeps trickling out.
Alexis, thank you. Appreciate it. Let's dive into Boeing a little bit more. Joe, I want to come back to a point that you made in the last hour, which is Boeing's effect. Not only, obviously, they've got some cultural issues and all of these emails, but the ongoing effect on the economy.
It's going to shave 0.5% off GDP in the first quarter, and that assumes that they get production going a bit through the remainder of this year. It could be a much larger hit to the economy. I remember when Boeing production was shut down due to the Japanese earthquake and nuclear disaster in 2011, we went down to 1% growth. So this is a story that's going to be played out. Something else here. Boeing's too big to fail. It's
Right.
too important of a national security instrument to fail. But this is an enormous market and regulatory failure. This isn't what's supposed to happen in capitalism. You're not supposed to end up with the national champion and no alternative. Yet here we are. They're never going to be fully brought to account on this. I mean, Americans are just getting pissed about this. I spent 200,000 air miles last year. I spent a lot of times in airports. This is the topic of conversation.
And the problem too is that, I think even unpacking what the horrible text messages that were said, basically admitting that the design of this plane was faulted from the get-go, that Boeing cleaning up this mess has really been a huge mess as well. I mean, think about the fact that Dennis Muhlenberg was basically booted out when it was found out among the board that he couldn't get the plane back in the sky by the end of 2019. It wasn't because of the aviation accidents themselves or the misdesigns of the planes that it seems like have been admitted to by the company and employees as well.
He kept trying to pressure the FAA, kept making statements and was getting ahead of the FAA, and the FAA was saying, hold on. But the other thing that when you talk about how long this could last, United Airlines towards the end of last year announced that they did not expect the plane to be back in schedule by March, because remember we used to say March. They said, and they're going to revisit in June whether they think this plane would be back.
In my estimation, this is restarting a production is a 2021 story, and this is really going to drag the consensus forecast on growth down going through this year. We did a town hall in Wichita late summer where we were discussing with our clients on the ground about the importance of Boeing, and one of the very nice gentlemen who owns a medium-sized business said, "This is an existential question for me. If they shut down production, I'm going to have to look for business elsewhere." Where do you go? Boeing's the only game in town, right? So this is going to be on the tips of our tongues for a long time.
Meanwhile, you say you fly so much. Would you fly on a MAX even when it gets back in the air?
No, we're going to try to work around that. We are trying to work around that every time I fly. One of my standing rules is avoid it wherever necessary. I'm on a Southwest Airlines flight to Houston. I normally fly American. You know why? Because they don't have the exposure on 737 MAX this Sunday.
All right. Tesla and General Electric are the two most valuable loss-making companies. They are part of a high proportion of public companies that have been losing money despite this long bull market. We want to throw this one at the panel. And there was a statistic, though. Julie was talking about this this morning. What is it? 40% of the companies that we invest in that are on the markets are not profitable.
No, they're not. They're actually showing large losses. I don't know if this is something about how the new economy operates because of the way in which venture capital interacts with many new companies. But you look at Tesla and you're like, how long can they go on like this? And is he going to accept that 11-figure payout as they're still losing money, right?
I mean, I think for the longest time there was this idea that these large blue chip stocks, right, those that had scale also came with profits. But as we've seen from the IPO market in 2019, that's not the case. You have these companies that have Bs in terms of their top line growth or top line revenue coming to market with massive losses. Companies like Uber, companies like Lyft. But what we've seen is that the Valley and PE firms have been valuing that. VC firms have been perfectly comfortable throwing money into those ventures because they think that the growth trajectory really allows them to continue to have these future prospects that allow these equity prices to be at the multiples that they're at right now. I think Joe's right. I mean, this is kind of symbolic of a new normal.
You know, when I think about a company like Uber, right, I'm thinking that's a play on driverless technology. Is that how the Valley sees it, or are they preparing for a new reality where you have to prove it now?
Right.
Right. I just wanted to bring some more numbers into it, and all of this, by the way, is from the Wall Street Journal. So 3/4 of IPOs were made by loss-making companies last year. That's according to a University of Florida finance professor. What kind of companies are losing money? 42% of them in the U.S. are healthcare, which is interesting. So you have a lot of biotech stocks that are sort of moonshot, drugs in development, and another 17% of them are tech stocks. So it's interesting that a higher proportion are healthcare. Some of those companies end up getting acquired if their drugs end up working.
Yeah, and that's not necessarily a surprise. I think that's kind of been a story because the capital that you need to raise to run a lot of these healthcare ventures are enormously expensive. A lot of them rely on grants from the federal or local governments to operate at all. But if you hit that one drug, if you get that one FDA approval, that's all it takes sometimes.
As we have this discussion, can you put this into context, though, for us? I mean, when we look backwards, what would we have seen? Would this be an anomaly?
I think probably not. I think that we've had a structural change in the economy. We've got different investors who use different metrics that are far forward-looking, that have to do with the adoption rates of these new technologies or these new wonder drugs, or even in a retail space where you can buy some very interesting life sciences products over the counter that you couldn't.
Yeah. Fair. All right, coming up, making money off the competition, how Amazon plans to cash in buying and selling ads to its competitors. Plus, the December jobs report missed estimates. Will break down what that means for the Fed straight ahead. We are continuing to watch what's going on in these markets as we now see the Dow pulling back by 0.4%. So we have seen a reversal to the downside. And now, in fact, not just the Dow, the S&P 500 is down about 0.2%, and so is the NASDAQ. So we've had a reversal here for the major averages after we saw gains early in the session. Looks like most of the other assets are pretty steady as she goes here. So let's take a look at the sectors to see what could be underneath the movement that we're seeing. So we are seeing the real estate, the interest rate sensitive groups that are rising right now: real estate, utilities, healthcare, the more defensive groups, and the cyclicals on the downside. Industrials are taking a hit right now. They're off by about 0.5%. Financials, we were talking a lot about the bank earnings that are starting to come out next week, and that there's some optimism over some of those bank earnings, according to some of the investors we've been speaking with today. But financials ahead of that are down about 0.5%. Also, as we check in on some of the trending tickers that we watch on yahoofinance.com, what represents the market better than Apple? And here today, it earlier touched a record. Now, though, it is coming down, so mirroring the movement that we are seeing overall in the market. I also want to point out some of the action that we're seeing in the semiconductors, which, of course, have been a very, very strong area of the market. Advanced Micro Devices, of course, also hitting a record very recently. And even with the very strong performance last year, we've seen analysts raise their price targets on it over the course of the week. But today, we are seeing it pull back after hitting a record once again in yesterday's session. We'll be covering much more in terms of the markets for you throughout the rest of the show. We'll be right back.
According to a Wall Street Journal report, Amazon wants to build its ad inventory and sell on other streaming services. The e-commerce giant has been selling ads on its Fire Stream platform, and now it wants to add its technology to other streaming TV systems like Xbox, Apple TV, Android TV, and PlayStation. Yahoo Finance's Dan Roberts joins us via Skype with more about this.
Hey, Adam. Yeah, it's a wild story because the competitive landscape in streaming has been really interesting lately. And, you know, we saw that Netflix and Disney now acknowledge their direct competitors. You no longer have Disney allowing Netflix ads on any Disney-owned channels. So it is surprising a little bit to see that competitors to Amazon's Fire TV system are even talking to Amazon about letting Amazon fill their ad inventory. But I also think it's a sign of just how effective Amazon has become at selling ads. I mean, this is about Amazon's publisher services business, which is growing really quickly. So some irony in the idea that Apple TV would let Amazon, which is a competitor in creating original content, fill ad space on Apple TV, but I believe it.
Help us understand, because you know this much better than most of us, how this gives that Amazon a fighting chance in the battle, say, with Google when you talk about programmatic trading along these lines.
Yeah, I think it's not just Amazon and Google. Sorry about my partner here.
Yeah, Mumford, right?
Look, Amazon, Google, and Facebook are all starting such vibrant ad sales businesses. I think it's yet another example you can add to the tally of different businesses that Amazon is now in. Now, again, I do think that it's hard to talk about this separate from the original content race. And in that regard, Amazon and Apple are competitors now, although Apple TV Plus just starting off. I mean, it's just begun, and Apple TV is going to have to ramp up its spending. But I think this is Amazon wanting to have yet another major business vertical. You know, you look at AWS, which is still the profit engine in some regard. But we love to say, whenever we talk about everything Amazon is doing, this company wants to do it all. And ad selling is a part of this.
Dan Roberts, Mumford, right? That's the pooch, right?
That's right, yeah. And he's more of a Roku fan.
All right. Dan Roberts, thank you. Our next guest thinks that 2020 will be a great year for the markets, with the Fed committed to low rates and no recession on the horizon. Eddie Gabor is the co-owner and managing partner of Key Advisors Group, and he joins us now to talk about all of this. You know, one of the things that we talked about going into this, and we just heard from Joe Brusuelas, that things are going to reset in the next couple of months. And investors need to pay attention to this because, for instance, labor numbers may not be as good as we have thought this whole year. Yet you're confident we won't see a slowdown. Why?
No, I do think we are seeing a slowdown right now economically. I don't think that ends the bull market. I believe the bottom line from a market perspective, until we have a recession, with the macroeconomics behind us, with the Fed off the table, I think this market has legs still this year, and we'll see double-digit returns. Now, I hope that we see a pullback of 6 to 8% here in the near term, because my one concern here is we are getting a little bit complacent. There's no fear in the market. VIX index has been pretty low. So we need a pullback in order for this market to stay healthy, in my opinion.
And what would, for you, what would a healthy pullback look like?
At least 6 to 8%. We need some fear in the market. That may sound silly, but you know, when you keep that fear in the market, cash stays on the sidelines, and that's healthy for a bull market.
All right, so I think it was Steve Sosnick who told us earlier that he had been watching people who'd been on the sidelines all through last year at the end of the month, jumping back in. That usually signals a problem and that we might be getting what you're talking about. Do you agree? And if so, when do we get the 6 or 8% pullback? I'm trying to time here, but are we talking mid-year?
I think we're going to see it sooner than that. If I had to bet, I would say within the next 4 to 6 weeks, we would see that type of pullback.
Why so quickly? Is it the Boeing factor, for instance? Can we pull up Boeing again? We're seeing Boeing go, drop today because of those emails and those tweets, but Boeing's going to have a negative impact. We saw layoffs affiliated with Boeing this morning, that supplier. Is that going to have the kind of impact that would lead to what you're discussing?
So Boeing definitely has an impact overall. I think the other thing too is, the overall manufacturing has really showed some slowdown. That coupled with the fact that, look, investors have had a record year last year and the resilience has stayed this year. I think it's prudent, and I think you will see some profit taken here done in the first quarter.
Okay, for the investors who are building their cash right now, who are waiting, getting their powder ready to shoot, say 4 to 6 weeks, what sectors or any particular stocks you think they should be looking at when that, if what you say will happen, does happen?
So when you take a look at the pullback, of course, everybody's situation is different in their risk tolerance. We know that. But I personally still like financials. I think tech will still do well this year. I'm making a contrarian call too on some energy stocks. I'm a boring investor. I like dividends.
Let me interrupt you there because I asked earlier, and I'm keeping an eye on oil because if dividends fascinate me, and there are dividend yields, for instance, at ExxonMobil. I think it's almost 6%. The traditional oil companies have that kind of dividend yield, and yet their valuations or their stock prices have been flat. You know, they trade within a range but don't really go anywhere. Is that what you're talking about?
I am, exactly. And especially for my client base, you know, income is an important thing for our clients. And when you look at companies like Exxon, like you mentioned, they got a healthy balance sheet. They didn't perform well last year. So as a contrarian, I like that. And then you have the dividend yield. You know, it's a little bit more of a defensive play, but I think late cycle, having some defense in your portfolio is an important thing for investors to do.
Okay, and as I wrap up with you, is there an unexpected event? I know the unexpected, the Black Swan event. I don't know what that would be, but that you're getting hints of this is something I need to pay attention to for your clients?
One of my biggest concerns short term is what's happening in the repo market right now.
Yeah.
Okay, and if some news comes out as there's a reason why they're having to put liquidity in, that could be the Black Swan event that causes a big sell-off.
All right. Eddie Gabor, appreciate your being here. Coming up, planning for retirement, the responsibilities women face while working for the golden years. Plus, Bye-Bye Brady, the new NFL stars that are taking the spotlight in this year's playoffs.
It's 12:32 p.m. here in New York City. 3 hours into the trading day, stocks are now all lower after the December jobs report missed estimates. Initially, they were higher, however, and then pushed lower. About 30 minutes ago, we started to see that turn. A new warning from the FDA. The agency recalls a popular product over concerns it contains a possible cancer-causing substance. Find out what it is ahead. From drinking to texting, lawmakers in one state consider making it illegal to have a cell phone if you're under the age of 21. And changing of the guard with names like Brady and Brees out, a new crop of superstar quarterbacks gets set to dominate the NFL playoffs. Welcome back to On the Move. I'm Julie Hyman.
And I'm Adam Shapiro. A new study found the impact of long-term caregiving falls largely on women, both emotionally and financially. and those costs are significant. It's a significant concern for retirement. Christy Rodriguez, VP of Thought Leadership for Nationwide Financial, joins us from Columbus, Ohio, for this week's Women and Money segment brought to you by USAA. Thank you for being here. All of us, I think, can relate to having a relative or knowing someone in this situation. But there's nothing, it seems, what do we do is where I'm going with this. Do businesses need to do something to help men and women, share in this responsibility as perhaps older relatives need care? What do we do?
Yes, no, great question. Thank you for that. And thank you for having me. And you're right, it is really a problem that everyone can become involved in. When I think about, employers, it's about making sure that we understand the ramifications of caregiving and the impact that it has on their employees. I think as individuals, it's also important to have a comprehensive plan. Really understand, really how long, particularly women, are going to live, and have a plan surrounded around healthcare costs as well as your long-term care costs. And then I think for advisors, it's also very important. We're now seeing an increased amount of women who are utilizing financial advisors. And here at Nationwide, we have a number of tools that those advisors can use, as well as a long-term calculator as they look in terms of planning for that extended life that is really going to go well beyond what generations before us have.
And the results of your survey really throw into sharp relief how acute these concerns are, right? When you find about 2/3 of caregivers are women, but not only that, over half of the female caregivers you surveyed agreed with the statement, "I'm afraid that caregiving expenses will keep me from ever retiring." 83% of people you surveyed agreed with that statement. So there's clearly a very close tie and interplay between gender and caregiving and retirement. How do we cater to those concerns?
That is so real, and you hit it spot on. And, when we think about the disproportionate amount of women who are caregivers, and you think about that has a systemic effect, because that's women kind of even taking off in those high earning years to care for loved ones. What we do know is it's very rewarding. And just as a personal side note, I think about my own family. I have a grandmother who just passed away last year at the age of 98. And my aunt moved in to care for her 26 years ago. And we don't think in terms of caregiving being that long extended period. And you're absolutely right. And that's why, it has changed even the narrative within my family, and me having a position like this, but it's changed the dialogue for us to really talk about how do we want to receive care. That was the conversation around the Christmas dinner. And, where do we want to be? Where do you want to live? Do you want to stay in home? And it's something that's very realistic, not only for women as they care for individuals, but as we think about and planning for our long-term care ourselves.
Hey, Christy, Brian Chung here. So when we talk about the aging population here in the United States, there are questions about how some of these caregivers can live on a living wage in many high-cost cities like in San Francisco, Los Angeles, for example. So it seems like structurally there's a lot of questions about how to supply in the future a workforce of caregivers, given how wages can be quite difficult in a lot of those cities. What are some of the structural recommendations that you might have for addressing some of that inequality there?
Great point. Again, I think the baseline comes to having a plan. And I think, that would be one thing personally we can own from a structural perspective. And I think really what brings to light in the Nationwide Retirement Institute survey is really around how do we become now having a dialogue. And again, it goes back to that first question, a collective dialogue around employers, around advisors, around many other constituent groups, as well as legislation to say, how can we have an impact to help these most vulnerable people as they age, but more importantly, the caregivers. And if you think about it, even some of the things that we are not even addressing in the survey, some of the direct cost, the stress that it weighs on, the day-to-day of caring for someone and maintaining a job. These are all things where we really have to have that convergence of a health and wealth conversation
Christy?
and a plan really to augment that in the future.
You talk about the direct cost, and because of personal experience, I can tell you that in some parts of the country, for assisted living, it's going to be anywhere from $5,000 to $10,000 a month. And I don't know many of us who can afford that. So I don't know if it's government or if it's employers, but I don't know if government or employers can afford that.
Right, and I think that's, again, I'm sorry, go ahead.
Okay, Chrissy, Joe Brusuelas here. One gets the idea that we have a retirement crisis unfolding. That implies that it's a multi-generational problem. How are you speaking to the younger cohort in the nation who are just really entering the workforce, are a little bit away from entering their peak earning years, where they're going to have to take care of not just mom, but grandmom?
Now, great question. We're starting the conversation by saying you can start early. What we found in our own data, when we mined our own data, most individuals don't start saving for retirement until they're 31. That is some critical, crucial years in advance of that, somewhat upward of 10 years that they could have been saving. And so what we're really trying to have a conversation around, it's not an all or nothing approach. You can pay down your student loan debt and save for retirement at the same time. And we give tangible tools and really applications to show individuals on a personal level how they can advance that and how they can optimize and make the most out of their retirement savings, as well as living within their means and paying down that substantial debt.
Christy Rodriguez with the National Retirement Institute, we appreciate your being here with us.
And continuing our...
Thank you so much. I enjoy it.
Thanks, Christy. And continuing our discussion about women and the dynamics in the economy. In the December jobs report, it was found that women hold slightly more than 50% of non-farm payroll jobs. The economist Betsy Stevenson highlighted this on Twitter today. Joe, it's so fascinating because as we look at this number, and as we talk about what we were just talking about, women, are, of course, tend to be still disproportionately, not just the caregivers, but for their ailing parents, for their children, that tends to fall to them. So how does this dynamic affect society? I know it's a big question.
Well, change is going to come, and it's not going to come quick enough. So there's going to be some social tensions. With respect to what we were just talking about, there's going to have to be a national response. There's a growing retirement crisis. And Adam, we can't afford it, but we're going to pay for it.
And we are. I'm telling you the numbers, and this is in South Florida, which is, no income tax state, but that kind of thing. But insurance companies, by the way, if you're out in the market trying to find a long-term care policy to cover yourself or a loved one long-term when that day, if it should come, they don't really, it's 3 years with a cap that doesn't cover. I mean, no one sells the lifetime policy anymore.
We're still early in the retirement of the boomers. Wait about 5 years. The social pressures to change are just going to grow, and there's going to be a response. I think there's also something here in this idea that women are now 50.4% of the workforce. If you look at the workforce excluding self-employment, men still dominate that. There's 109,000 more women in the workforce now. We've reached an inflection point, and things are going to change. If you work in a medium or large size firm, women are now dominant in what we'll call traditional employment. And so when we're thinking about design of benefits, whether that's healthcare or 401k, flexibility on the job, the way in which we structure work hours, both directly and indirectly, thinking geographically, thinking telecommuting, I would think that we're going to look back on this in 5 to 10 years and think, this was the year, this was the time when we really begin to redesign the way in which work is necessary to accommodate the majority, which are now women.
You guys are on notice. Coming up, young stars take over with big names like Brady and Breeze out. A new crop of young quarterbacks gets ready to rule the NFL playoffs. Plus, take a look at how streaming stocks are faring in today's session. We got Netflix, which is down a little bit today.
Let's take a look at the top trending stories on Yahoo Finance right now. The Food and Drug Administration recalled more heartburn medications. The FDA found traces of NDMA linked as a probable human carcinogen. Pharma companies recalled several batches of unexpired ranitidine tablets due to the possible presence of that cancerous substance. The International Olympic Committee is set to ban public political displays in the 2020 Olympic Games. It published a strict rule for guidelines for athletes to follow that includes barring actions like taking a knee or raising a fist in the air. Now, the guidelines do not disclose what the punishment will be for contestants who disregard the ban. A car featured in one of Hollywood's most intense chase scenes is gearing up for the auction block. The green Ford Mustang GT that was in the 1968 film Bullitt is expected to drive up a large price. The auction starts tonight in Kissimmee, Florida. Kissimmee by day, but it's Kissimmee, Florida. It's Kissimmee by day, Kissimmee by night. One of those. It's. You don't know that?
Let's get to football. The NFL playoffs are underway. Football fans everywhere are anxiously awaiting the divisional round, which kicks off tomorrow after the wild card matchups left many underdog teams victorious. Joining us now to discuss is national insider for NFL Network and NFL.com, Ian Rappaport. Ian, thank you so much for joining us. I do want to talk a little bit about the changing of the guard in terms of the various quarterbacks, right? Because on the one hand, you have the huge stars like Tom Brady and Drew Brees that are now sidelined. You also have more black quarterbacks who are now going to be taking a front seat role as we head into these playoffs. What's your take on all of it?
Yeah, in my eyes, this is really what the NFL needs. I mean, obviously, Tom Brady is great, probably the greatest player of all time. Drew Brees also tremendous, owns so many of the great passing records and really has been a dominant quarterback for more than a decade. And of course, we can't forget about Aaron Rodgers. He's pretty good too, and they got the number 2 seed. Packers are going to be all right here. But you're right. It is certainly a changing of the guard. And there's so many exciting, fun, young quarterbacks. I mean, start with Lamar Jackson, probably the MVP this year. You got Deshaun Watson. You got Patrick Mahomes. I mean, obviously, Russell Wilson has been there and done that. Nothing new. Jimmy Garoppolo, who you're showing right here. This, it seems, is what the NFL has kind of been waiting for, which is the next great wave of young quarterbacks. They do happen to be black, some of them, obviously. Almost all of them are really, really exciting, which I know is kind of a cool thing as well. I like watching this kind of brand of quarterbacks, and I'm pretty excited for this weekend.
Ian, I can remember Bob Greasy. That's how old I am. My dad used to take me to Dolphins games. So as you talk about the different eras changing, right? Wow. He used to drive a Chevy station wagon. His kids went to the school around the corner. But here's the deal: Kirk Cousins, Minnesota Vikings. The trade that they made. A lot of people questioned that. They're not questioning it now, though, are they?
No, the signing of Kirk Cousins. The biggest free agent signing for a quarterback that we'd seen, a fully guaranteed deal. And, of course, there was criticism of Kirk Cousins. First of all, why didn't the Redskins want him? That was a fair question. They could have signed him. They tagged him a couple of times. Why didn't they sign him to a long-term deal? And, when it came time for the big moment, was he actually going to perform? Well, he performed probably through the best pass of his life to Adam Thielen late in that game last weekend. And, there's a lot of exciting, fun, young stars. We talked about some just a second ago. Cousins is pretty good too. And, the way he threw the ball this year, the way he helped guide that team was impressive in its own right. And I think he'll probably be excited about not answering any more questions about not being able to get it done in the spotlight, especially if they come in and beat the Niners this weekend.
All right, so in sports, youth's often served. So who's the best quarterback? Is it Jackson or Mahomes? Is it Jimmy G, who might have the best team? Or is it that old guy wearing number 12 in Green Bay?
That old guy is pretty good. And I will say this. I'm sure that Aaron Rodgers is kind of laughing a little bit to himself as we all drool over, Lamar Jackson and Patrick Mahomes and Deshaun Watson. And I'm sure he is just going, okay, we'll see. Because that he wants to be considered the best. He is insanely competitive. And I'm interested to see how he kind of responds to all this. As far as who's the best, overall, I don't know. I do know that Lamar Jackson had the best season. He's probably going to be the MVP. And it's not just that. I mean, his personality, he is such a leader for his team that they've sort of become him. He's infectious. And I'm sure a lot of people didn't believe he could be the starting quarterback of an NFL team, let alone the best starting quarterback of an NFL team. I know his team was behind him. I was at training camp with him this year, and I remember getting pulled aside by an assistant coach and him telling me, look, you need to understand this Lamar Jackson, he is really good. And told me very seriously, and I kind of stopped and was like, okay, I need to start paying attention. His team believed, and I'm sure he's getting ready to show all of us this weekend.
Hey, Ian, Brian Chung here. In that last game with the Patriots, there was a lot of chatter about that maybe being Brady's last game in a little while. I mean, where were those rumors coming from? Is it really substantiated? Do you expect to see Brady coming back next year?
The real and firm answer is I don't know. It is the first time in Brady's life that he is going to be a free agent. He is not under contract. He cannot be franchise tagged. He can't be transition tagged. He, certainly he gets to choose where he goes. And, he has said he wants to play. He has said that he is motivated to play, wants to be back in the arena. But as Bill Belichick said, it is a two-way street. They have to agree on a contract. Brady wants to be back. Would he be back for $1 million a year? Probably not. What about 20, though? What about 25, which is about what he made last year? The contract is going to be part of it. And for the first time, he gets the opportunity, if he wants it, to look other places. Leverage is a fascinating thing on both sides. And this is going to be the biggest story of the offseason.
NFL Network's Ian Rappaport, thanks so much for being with us.
Thanks, guys.
Coming up, don't drink or dial. A proposed law could soon make it illegal to own a cell phone if you are under 21 years old. Plus, take a look at how bank stocks are doing right now ahead of earnings next week. In my best Bernie Sanders impression, buzzer beat around. 3 stories, 1 minute each. Okay, forget about it. Let's go. Democratic presidential candidate Tom Steyer qualified for the debate, and he's out with a new immigration proposal. It would allow immigrants who flee the effects of climate change to be eligible to enter the United States legally. Good, bad, what? Indifferent idea?
I got to say, people were making fun of Tom Steyer and making fun of the fact that he was even on the last debate stage. It seemed like a lot of people forgot that he was, in this race at all. But he's really actually branded himself pretty well as that climate change candidate.
Okay.
There's a lot of advertising.
It's the branding. It's the money he is spending on the ads. He's polling at number 2 in Nevada.
That's right, because
money can buy the
breathing
election,
a sigh of
I
relief
guess. I
because
don't know.
Marianne Williamson dropped
Right.
out.
Well,
So
if you
he-
drop
she was-
125 million in air saturation, you're probably going to see an uptick in the polls. But that's good politics. that sort of massages the erogenous zones of the Democratic Party with respect to
Oy.
immigration and climate change. Look, in Guatemala, a lot of that land is no longer arable. This isn't going to stop no matter what wall Trump builds.
Right.
This is going to happen. So we're going to have a more rational conversation about this other than the dirty, dirty people immigrating here.
Well, if you're going to massage the erogenous zones, you might want to listen to this. The world's largest brewer, Anheuser-Busch InBev, is entering the hard seltzer market with a Bud Light seltzer. It's set to debut on Monday. Flavors include mango, black cherry, lemon lime, and strawberry. And I believe Bud Light is going to be devoting part of its ad time during the Super Bowl to Bud Light seltzer. You're a hard seltzer guy.
Okay,
right?
yes, but apparently I cannot tell the difference between
what you like,
taste
right?
test. I wasn't able to distinguish a White Claw from a Truly. So it's all going to taste. Look, I think most people will say it'll taste all the same. So unless they try some new flavors, which doesn't seem like there's anything that dramatically different from what's already offered, I don't know what's going to be the distinguishing factor other than media buzz for right now.
It's less filling though, right? Tastes great.
Oh, I mean, compared to other types of.
It's a lot like wine coolers from the 80s and 90s.
He doesn't know the
college
reference.
girls. I know he doesn't.
They were
I've
gross
seen this
then,
before.
and it's
gross
now.
now, exactly.
Yeah,
Never had
Boons
a wine
and
cooler.
Tunes was my Saturday morning.
Bartles and James. Bartles and James.
Never had
Remember the two old guys who used to sit out there? Bartles and James.
Are those the ones that look like
James,
the lava lamps?
Yes.
Shaped like lava lamps?
Yes,
Okay.
that's correct.
Oh, just go get a box of wine and call it a day. A Vermont lawmaker introduced a new bill to the U.S. state
To the Vermont State
to the
Senate.
Vermont State Senate that makes it illegal for people under the age of 21 to possess a cell phone in Vermont.
He said he doesn't have any thought that this will
Okay.
actually go through, but the guy's trying to make a point. Is it the right point to
What,
make?
that he's an idiot?
Yeah, what's the
you
point?
can smoke weed, but you can't own a cell phone. I mean, this is crazy.
Stupidity. I
Yeah.
guess people use their phones a lot, but that's a choice people make, whether they're under 21 or over 21.
What's it going to do? Hurt the environment in Vermont where nobody works? And
Right,
there's
but I mean,
cows?
if the point is to tell people to use your cell phone less, then what's the
No,
significance?
no, no. So the point is, he's saying essentially that people are trying to regulate guns. Why not try to regulate cell phones? And he is pro
Oh,
Second
it's the
Amendment.
reverse.
So basically, he's saying social media use leads to things like suicide, for example, and bullying among teenagers. So this is aimed at drawing attention to that.
Okay, well, if it took us a minute to figure that out, then the message
Recidivism
is
and
probably not
retrograde is
that
what
not
that
that
is.
great.
Yeah.
That's all I'll say.
Okay, Joe Bruce-Willis, thank you so much for
Pleasure.
being here with us for the past 90 minutes. Brian Chung, thank you as well. My condolences on your bankruptcy. And let's take a last look at the market, shall we? As we head towards the break, we are still seeing stocks in the red, although the NASDAQ is just marginally there. So anything could happen in the next several hours of trading.
As you well know. Okay, so the trading session continues and Wi-Fi PM is up on deck, ready to take you through it.
It is 1 p.m. in New York City, and the major indices are whipsawing in the afternoon trade as the Dow retreats from topping 29,000 for the first time in history. On tap for today, a lighter than expected December jobs report coupled with a November downward revision continuing to show softness in America's manufacturing sector. We'll dive into what those numbers mean for the state of the economy. Plus, new internal messages at Boeing turned over to Congress, revealing how employees really felt about the troubled 737 MAX plane before 2 deadly crashes, and digging into the true cost of tariffs with the Phase 1 China deal on deck. A new investigation revealing tariffs are boosting American lobbyists at the expense of the country's small businesses. Why the swamp is alive and well. All that and more. This is Wi-Fi PM. Good afternoon, everybody. I'm Zach Guzman, and join me on Wi-Fi PM today is Yahoo Finance's Emily McCormick, along with SLT and Stretch founder and CEO Amanda Freeman, back with us in studio. Good to see you again. Happy Friday.
Great to see you.
We are checking the market action right now, and interesting, this day of trading right here. We're showing you what it looked like this morning because we had, of course, the jobs numbers come out to start the day, and we've seen a pop, as I mentioned above, 29,000 for the first time. But now in the afternoon, we're seeing stocks come down a bit since we got those jobs numbers, but want to dig into those. Only 145,000 jobs were added last month, missing economists' expectations of about 160,000 on average. The unemployment rate held steady, though, at 3.5%. Retail, healthcare, and hospitality all saw strong gains last month, with manufacturing and mining falling behind yet again. So joining us now to discuss is Payton and Rigel chief economist Jeffrey Cleveland. And Jeffrey, when we look at this, I mean, into the numbers, a downward revision for November, I think that was maybe largely expected. But what do you think about the softness in the December report?
Well, Zach, I'm getting text messages from friends, family, colleagues this morning that, it's a mediocre jobs report. And I think context really matters here. If you go back to the summer, we had worries about a downturn. We had an inverted yield curve. We had all the trade concerns. And with all that said, in the last 3 months, the average monthly job growth has been 184,000. So perhaps a little bit weaker in the month of December, but I think it's important to look at that 3-month average, 184,000. To me, that is still a pretty strong labor market, pretty good job growth, getting us to 2.1 million jobs added for the full year. So I still like what I'm seeing. So I don't worry too much about the little bit weaker than number in December.
Got it.
Jeffrey, what do you make of the print that we got on average hourly earnings? Because that was really a disappointing spot in this report. That was just at 2.9% for December, down from 3.1% in November and down from the peak last year of 3.4%. That's coming even as we have that unemployment rate still at a 50-year low. What does that actually indicate for us, and where are we headed on that measure in 2020?
Well, two things. It could be a bit of noise in the month of December that weighed on wages, and the next month we'll see some of that fade. So, keep that in mind. The other thing is, the big takeaway for me is the unemployment rate has fallen a lot. We're at 3.5% on the official rate. We're at 6.7% on the broader, what I would call the real unemployment rate, the U6 measure of unemployment. That is at an all-time low, and it continues to fall, yet we're not seeing a whole lot of wage growth. So for us, it means that we still have slack in the labor market. We still can see further declines in the unemployment rate without getting concerned about overheating. And I think the Fed should just sit on the sidelines, let the economy continue to run, let the job market tighten further, and we will get more wage growth in the next 12 months, in my opinion. If you look at lower tier wage earners right now, they're earning about 4% year-on-year wage growth, and I think that will continue to improve. This is a good sign. We'll get more wage growth as the job market tightens further, but we have more room to tighten.
Yeah, well, it's fitting that we have currently right now 2 guys talking about this with 2 girls on set, because we also got the numbers right now. The Labor Department data showed that women accounted for over 50% of all jobs last month, so about 50-50, but this is the first time that the majority of labor participation was from women. So that's a big finding in this report as well. Of course, the trend has been moving in that direction, but what do you make of that, Jeffrey, and then Amanda as well?
I'll tell you what, my two sisters will be very excited right now. You know, they're telling me women are taking over the workforce, and I think it's true. And that's been a longer-term trend that we're seeing. I expect that to continue. That's a structural shift in the labor force.
Yeah.
I obviously love to see this trend as a female founder who employs a majority of women at my businesses. I think it goes to show you that companies really are making the commitment to hire women in positions where they might not have in the past. So it's very encouraging.
Yeah, I mean, that's kind of been the trend. Even when we look at kind of the college education trends as well, people who are getting college educated, we've seen that trend continue as a lot of women go to college. But what is interesting, Emily touched on the wage growth that we've been discussing here and kind of why economists are so puzzled that we haven't seen that. One interesting note, too, that we were following this story, Taco Bell is looking for new ways to win over employees. Bloomberg reports it will test a $100,000 salary for general managers at certain locations this year. Jeffrey, when you look at that, I mean, is that an example of how low unemployment is changing the face of fast food and some of these bigger behemoths trying to attract proper talent and how tight the labor market's getting?
Yeah, my colleague Peter Beer always says that the best thing to happen for the average worker is a tight labor market. So we need to continue to see a decline in the unemployment rate. That's the best thing in real time to help just the average worker. And we're seeing anecdotal evidence of that. I expect that to continue over the next 12 months. We're going to have an even tighter labor force. We'll have an unemployment rate by the end of the year that's closer to 3.1, 3.2% from the 3.5% today. It's probably also worth noting, I should say, I think Payton & Regal, you know, my firm, we were ahead of the curve. We were co-founded by two females in 1983. So we're on the cusp of this trend, if you will.
Yeah, there you go. Yeah, there you go. Shout it out. First one's there. Very nice. All right, Jeffrey Cleveland, thank you so much for joining us. Appreciate you taking the time, sir. And a reminder to stay tuned to Yahoo Finance. Trump trade advisor Peter Navarro will speak out with us right here on Yahoo Finance at 4 p.m. Eastern Time on the final round. You won't want to miss that. Well, Boeing is facing even more backlash over its 737 MAX aircraft with recently released internal messages between Boeing employees revealing greater concerns over the training requirements for the jet. One employee revealed to be writing that, quote, "This airplane is designed by clowns who in turn are supervised by monkeys." Another adding, quote, "Would you put your family on a MAX simulator trained aircraft? I wouldn't." And in one message, an employee writes about fooling FAA regulators, saying, quote, "I still haven't been forgiven by God for the covering up I did last year. Can't do it one more time. Pearly gates will be closed." So some intense messages there, guys, revealed here on the part of Boeing.
Right, and again, more bad press that we're getting around the 737 MAX development. We did have Boeing coming out earlier this week and saying that was going to be implementing simulator training as part of getting the 737 MAX back into the sky, originally saying that that wouldn't necessarily be part of it. The Wall Street Journal ahead of that, having said that simulator training was something the FAA was exploring actually forcing Boeing to do for this airworthiness directive. But the costs are just piling up, and it's not just the public scrutiny. It is literal cost to Boeing's bottom lines. We're going to see the actual extent of that once we get earnings out later this month. But Boeing has already earmarked upwards of $6.1 billion for its customers, for Southwest Airlines, for American Airlines, these other airlines that are having to bear the brunt of this. And it's something that could continue to mount.
It's pretty, I mean, they're just damning messages, but the company responded to them in a statement, in part, writing, quote, "The qualification activities referenced in these communications occurred early in the service life of these simulators. Since that time, both internal and external subject matter experts have repeatedly tested and qualified the simulators at issue. We regret the content of these communications and apologize to the FAA, Congress, our airline customers, and to the flying public for them." Kind of just a good reminder that any message that you're sending within a company could at any point be turned over like this. I mean, if there's an investigation, so maybe a reminder there. Maybe these employees didn't really mean the things they were saying, but in the hindsight of having 2 fatal plane crashes, obviously it doesn't look good for the company when you're thinking about what it can do to get the plane back in the air.
It's the first thing you learn at business school is keep in mind anything you put in writing could end up on the cover of the New York Times, and this is a case where it really has. It's shocking that people did put that in email.
Yeah, and shocking that, I mean, these were kind of the discussions going on behind closed doors at Boeing when you have these questions swirling and then you know the end result of what happened with them. I mean, obviously, there have been a lot of question marks over the company and the way that they maybe didn't respond to initial questions and concerns on the part of employees.
Right, and again, these messages may or may not have been innocuous in their initial sending, but put together, it really is painting this picture of potential negligence and potential just misconduct in creating the 737 MAX, and that is yet to be determined as this investigation continues on.
Yeah, I mean, we'll continue to monitor what Boeing does with this ongoing problems with the 737 MAX and whether or not they can actually accelerate their timeline to get that plane back in the air and appease the regulators that have been watching it. But Boeing's also at the center of another story that ties in tensions between the U.S. and Iran as the Trump administration slaps new sanctions on the Middle Eastern country. Take a listen to what Treasury Secretary Steve Mnuchin told reporters earlier today at the White House.
Today's sanctions are part of our commitment to stop the Iranian regime's global terrorist activities. The president has been very clear. We will continue to apply economic sanctions until Iran stops its terrorist activities and commit that it will never have nuclear weapons.
And I say that Boeing's tied into this because of a plane that was shot down. We'll get into that in a second. But first, the tariffs here, the sanctions, I should say. The U.S. will impose the sanctions on Iran's metal exports along with 8 senior Iranian officials. And of course, we saw this kind of go tit for tat in the way that the scenes have played out so far after that attack on Iraqi bases with American forces. But now sanctions, a lot of the question marks are, is this the appropriate response for the time being? And it seems like that's the measured response coming from the U.S. side.
Right. This was largely expected. If we remember those Trump remarks that came earlier this week, that very brief speech where he essentially said the retaliation or the reprisal from the U.S. side was going to take the form of economic sanctions. It wasn't going to be a military confrontation. That was seen as a very good sign, both for markets and for those really monitoring these geopolitical tensions. And I think we're getting the actual manifestation of those promises today. And that's why we didn't really get much of a market reaction to the initial announcement of these sanctions.
Yeah, and something that, I mean, they've been applying through their max pressure campaign. We've seen the sanctions playing a critical role in the pressure that they're putting on Iran. But what is interesting, I noted that Boeing was tied into this as well, and part of it is because Iran is now denying that they shot down a Ukraine-bound jetliner that crashed outside of Tehran earlier this week. The New York Times reports American intelligence shows Iran is responsible, but it was most likely unintentional. That video you're seeing there of the actual plane that was downed. House Speaker Nancy Pelosi is out with a timeline relating to impeachment. We're going to dig into that in a second, but just first, the reactions there in terms of Iran denying the role in taking that plane down.
This investigation is going to be thorny. I think everyone has really agreed with that just because it's occurring against the backdrop of these heightened U.S.-Iran tensions. Of course, the U.S. would want to send in investigators to deliver their side of the story and present their evidence from the investigation. But at the same time, because of the potential threats of the U.S.-Iran tensions, that's something that maybe the U.S. government won't want to actually implement. And just with all the nationalities that are involved with this, it's something that is going to be very sticky.
Yeah.
It seems like very unfortunate timing if it really was an accident, if it did in fact happen that way.
Yeah, and it's one of those things too that obviously there were reports of kind of the clues, everything there on the scene kind of getting picked up, which is not what you'd see if an investigation was being carried out the right way. Normally that area would be blocked off. There were reports of that happening, which raised a lot of question marks as well. But we'll see what happens as more details come out from that. But back here stateside, House Speaker Nancy Pelosi is out with a timeline for sending articles of impeachment against President Donald Trump to the Senate. The lawmaker wrote to House Democrats, quote, "I have asked Judiciary Committee Chairman Jerry Nadler to be prepared to bring to the floor next week a resolution to appoint managers and transmit articles of impeachment to the Senate." Guys, we know that she's been waiting to make her move. It appears that next week is the timeline here. Interesting, though, in the way that we've highlighted how this might impact the 2020 race when you have all the senators waiting to see what could be happening here as they move along with impeachment.
Right, and it wasn't just the Senate that was necessarily pressuring these articles to be sent along. It was even House Democrats who were saying, why are you waiting? And the argument that Pelosi had presented and that had been reported wasn't necessarily that strong, saying that she was really trying to get leverage, get a trial that she felt was fair in the Senate. But really, what I think a lot of people were latching onto is that was really just weakening her argument that the impeachment process was this very necessary, expedient trial that needed to take place.
And it's been delayed for so long. I mean, it's been dragged out for so long that at this point, I think it's been watered down. I mean, when you think about what the American public might be thinking here, is just that if it was so serious, why is it taking so long? And does it become less of a stain on the president the longer you draw this process out?
And it just makes it start to look more political, I think, is the other threat.
For sure. We do have one note to make on the 2020 race, one update in regards to who's running on the Democratic side. Marianne Williamson is officially out. Her campaign website reads, quote, "The primaries might be tightly contested among the top contenders, and I don't want to get in the way of a progressive candidate winning any of them." So Marianne Williamson officially stepping aside in the race for 2020. Largely expected because she hadn't raised too much money on the last quarter. Kind of expected based on her polling numbers as well. Some people are surprised she even lasted this long. Something to hang her hat on, I think, for how far she came and the press that she brought to some of the issues she's been pushing for.
Yeah, finally starting to see this race narrow down, the candidates, as we head into Super Tuesday, into the primaries. And, perhaps there are more shoes to fall.
And perhaps she'll be in some sort of cabinet at one point, too, depending on how the race shakes out. So something to watch. But coming up, food delivery giant Grubhub giving up its gains after slapping down reports of a possible sale. Plus, McDonald's hit with a discrimination lawsuit, why 2 executives are suing the Golden Arches over an alleged purge of African American staff. Right after this. Welcome back. Grubhub is slumping today after the delivery giant shoots down reports it's considering a sale. In a statement to Yahoo Finance, Grubhub states in part, as we see shares well off today, there is unequivocally no process in place to sell the company, and there are currently no plans to do so. We have always consulted advisors about a broad range of issues, including potential acquisition opportunities. That has not changed. In fact, we believe that given the current pressure on profits across our public and private competition, there will likely be strategic opportunities to acquire share this year, given that our profitability is secure. And it comes as the New York Post reports that Walmart and other grocers are eyeing the food delivery company. Interesting statement there, because we have seen Grubhub give up pretty significant chunk of share over the last year, but it is a crowded space. A lot of delivery people out there, including DoorDash, Postmates, Uber Eats. I don't know if you can have that many people playing here, but Grubhub apparently denying that the sale is on.
I think competition really is the biggest story when we think about food delivery, especially looking at these other public companies like Uber with Uber Eats, which is actually a faster growing segment than its ride-hailing business, and really trying to boost profitability on that end. But I mean, Grubhub shares are down by about a third over the past 52 weeks, and it's really just a reflection of the fact that they're losing market share, losing customers, and ultimately failing to contend with the competition as we can see it now.
Yeah, DoorDash being one of those well-funded private companies. But Amanda, we were talking about this before. The platforms here, it's interesting the pressure they're putting on restaurants too, because now restaurants need to worry about how they're actually working with these delivery companies, choosing which ones we want to work with, and then also having to pay them.
Yeah, and how much room is there to add the fees on? Because it's not making the food any cheaper. It's like, what is a customer's willingness to pay to get something delivered instead of picking it up? The margin just gets smaller and smaller for the middleman. And it makes it hard when minimum wage is going up and costs go up every year. It really makes it hard, I think, for the middleman, which Grubhub is.
Yeah, and I mean, even it's tough for even big restaurants. You wonder what it does to like small mom and pop shops as well. But nonetheless, as they say that a sale is not necessarily in the cards, seeing shares off more than 6% today. Shifting away though from the food delivery space to the actual food makers. Fast food chain McDonald's is facing a new lawsuit over racial discrimination allegations, and Yahoo Finance's Kristen Myers joins us now with more details on the case. Kristen, what are they being sued over here?
Right. So 2 black executives in Texas, of course, McDonald's being a Chicago-based company, but 2 operations execs in Texas actually sued McDonald's alleging racial discrimination. There's a variety of things that were actually named in the lawsuit. So they said that during their time that Easterbrook was actually CEO, as we know, Kempczinski has now replaced him as a new CEO after Easterbrook was found to be in this consensual relationship that violated company policy, that under Easterbrook's leadership, that they saw black executives decline from 42 to just 7 in a matter of years. Now, I did reach out to McDonald's, and I do want to say that they kind of pushed back on that allegation in the lawsuit, saying that there was actually restructuring within the company and that the total number of executive roles declined across the board, not just disproportionately for African Americans, as this suit alleges. However, this lawsuit also alleges that for black franchisees, that they were being pushed out of the company by being subjected to this unfair grading system, that they weren't allowed to sell their restaurants in an open market, and that there was also a culture of retaliation. Now, this is all coming after a couple of months ago, there was a lawsuit filed by 17 McDonald's employees in Chicago that said McDonald's was prioritizing profits over safety, that they were routinely subjected to violence within the stores, and that McDonald's was not doing enough to protect them. Now, I do want to say that, it's a new year. Obviously, McDonald's now has a new CEO.
New leadership, yeah.
Right, and he has recently come out, and we've gotten the letter. Yahoo Finance did obtain the letter from the CEO that he sent out to his employees that said that he's proud of what McDonald's has done, but he has been telling employees, according to reports, that essentially the party culture is over. That Easterbrook kind of fostered this culture of late night schmoozing and partying, and that is all done with. Kempczinski wants a completely professional atmosphere going forward.
And also dedicated, supposedly, to what the company said, dedicated to equality across all racial groups in the company as well.
Yes, McDonald's has said exactly that look, actually, they say that half their execs roughly are people of color or women, and that they are committed to gender and racial diversity. I do want to mention that, of course, that Easterbrook was not the only executive from McDonald's that was named in this lawsuit. Kempczinski was also named in this lawsuit. He was formerly the president of McDonald's USA, and then there was also a regional president that was named in this lawsuit by these 2 African-American employees.
Yeah, and now that this issue's been raised, something to keep an eye on as we move further and further along in the Kempczinski era at the Golden Arches. But Kristen Myers, thank you so much. Appreciate that. Well, just after the break, one of the world's largest cannabis companies suffering a 1-2 punch of downgrades today, while Wall Street is souring on Aurora Cannabis as shares tank, as you can see there. Plus, a look at 2020's workout trends. Could Peloton quickly be forgotten when Wi-Fi PM returns? Welcome back to Wi-Fi PM. We are checking the market action we're seeing right now in stocks well off their session lows. The Dow battling back, paring its losses off just 45 points as the S&P and the NASDAQ stay in the green for now. We'll see what happens throughout our show. Well, things are going from bad to worse for one of the largest cannabis suppliers. Aurora Cannabis, as you can see there, is trading off today about 10% lower after two downgrades, one from Bank of America and another from Piper Sandler analyst Michael Lavery. Lavery cut his rating on the cannabis stock to underweight from neutral and slashed his price target to $1 a share, down from $3, citing notable risk on the company's balance sheet, writing, quote, "We expect negative cash from operations until fiscal Q3 2021. And even with $80 million Canadian projected proceeds from its at-the-market stock offering, we project a $200 million Canadian cash deficit in the interim, which may prove difficult to finance in this capital environment. And Emily, that's not good. Not to mention Aurora's medical marijuana operation in Germany is still halted as they are awaiting approval to its sterilization methods, and that is hurting forecasted sales as well. But generally across the space, you were hoping for a kind of relief in 2020, at least when it comes to Aurora Cannabis, not getting any of that to start the year.
Yeah, definitely not. And for Aurora specifically, it really is about these debt fundamentals. Of course, those are coming just because sales in Canada hadn't been as strong as people had anticipated with recreational sales coming online. But I mean, this company has a Canadian $360 loan coming due in August 2021. Huge concerns that they're not actually going to be able to hit that repayment. Yes, they still could restructure these covenants, but Aurora hasn't really given any indication that it would do so yet, although that would probably boost some shareholder confidence in this company. And revenue growth has continued to slow. I mean, that was just up 154% the most recent quarter, which sounds great, but that was starting from a low base, and that was also starting from a place of growth of as much as 450+%. So really seeing a major slowdown here and a lack of profitability.
It's interesting, too, though. I mean, when we talk about the space, you know, there are so many questions around marijuana, and now something as boring as debt load, you know, being the main problem for a company like this. It's kind of funny when you think about, maybe we have matured to a point where this is just looked at as any other company. It's just numbers on the sheet, and you figure out if it's actually funded well or not funded well.
And it seems like the only place a lot of these stocks are getting growth is when they open in a new state, is when a new state becomes legal. So they really just have to get the laws passed in more states in order to see, you know, it continue to go up.
And we've been waiting for Aurora to make their U.S. move. They haven't really done that, right? When we talk about it, Canopy has made their deal with Acreage Holdings. We've been waiting for what Aurora might want to do, but maybe just not in a cash position to really do that right now.
Well, and the fact that they have tabled for now their expansion into Alberta and Denmark, so potentially falling behind on that international expansion as well, as we've seen other companies in the space trying to accelerate with this land grab and just trying to get ahead of trend.
Yeah, and that's very problematic for Aurora, since that was a big chunk of what they were hoping for moving forward. A big chunk of the reason why they were growing so much weed. Now, where to put it becomes one of the major questions. But we'll shift away. I'm going to call marijuana a health trend because people say that it's a healthy thing sometimes, maybe.
When used healthfully.
When used healthfully, of course. But we'll shift away from that health trend to another big one in 2020. Fitness app ClassPass announced it raised $285 million in its latest round of funding, pushing the workout company above the $1 billion valuation needed to secure unicorn status. So now ClassPass, congrats, you're a unicorn. But Amanda, you obviously run a fitness company here. So what's the relationship like with ClassPass, and what have you seen in terms of people just using that service and how it ties to yours?
Sure. So ClassPass is an undeniable force in the fitness industry. I say it's a middleman between customers and the actual fitness providers, and it's evolved its business model pretty much every 6 months since it opened.
Yeah.
And so you're always a little bit on edge waiting for what they're going to do next. But they are actually a partner of my business as of recently, and they're undeniable. People are really reliant on it, and they've changed the nature of the business. It will be very interesting to see what they do with all this money. It's a lot of money, and I know it's for expansion, and I know they're also going more into wellness beyond fitness, but it will be interesting for someone like me to see what they continue to do with the credit model and how they continue to evolve their business model.
How did you actually feel about partnering with ClassPass? I mean, did you feel pressured into doing so just because that's the way these fitness classes were actually getting customers? Or was it something that you really welcomed with open arms and you're still seeing good margins even with ClassPass's take rate? What has just been that dynamic for you?
So we went on recently, so it wasn't something that I was eager to do, I would say, but it is a very important marketing channel in today's environment for fitness companies. It's really the way that people find out about you, especially the millennial fitness enthusiasts. And these aren't even necessarily the enthusiasts. They're more
who wanna
casual.
go to the gym.
Yeah, and I say that they're the more casual users who aren't as addicted to one workout or aren't as set on one workout. They play the field. What's available, what's interesting. That's that consumer on ClassPass.
Which seems like it's important because you're making a lot of contacts with people who might not actually know your brand yet on ClassPass, kind of the Netflix of workouts out there. But you're also launching at SLT a new class, SLT Tread.
Yes.
So that's to me. Sounds exciting, but what's going on with that?
We are super excited. So SLT Tread is a 55-minute class that combines our traditional model, which is a workout on a Megaformer, which is like a high-intensity Pilates workout. So it's 25 minutes on that machine with 25 minutes on a treadmill. So we have the Woodway treadmills. It's super intense, and so you get the fast cardio on a treadmill, and you get what we call slow cardio along with toning and strengthening on the Megaformer.
What made you want to get into that, mix and match it? I mean, is that what people are wanting to do? Because it seems like all these crazy workout classes are do this, do that, move around. Barry's Boot Camp gets a lot of accolades for that. All of them. Just do whatever you want and keep moving.
Yes. Yeah, so what got us to start it was we've always had a little pushback from people who are sweat junkies or, fast-paced junkies who really want that feel when they're working out, saying that SLT isn't enough for them. And we knew that if they would try it, they would see that it was. And this could be a gateway for those people. And it gets you that cardio and strength training in one. And some people were doing SLT on a Monday and something more fast cardio on a Tuesday because they felt like they complemented each other. And here's one workout where you can get both done. Very efficient, very effective. And it's combining two very challenging workouts into one.
Very interesting stuff. I don't know if you do all of these things too.
I really like Barry's Boot Camp, but I'll have to check that out because it sounds like a good alternative.
I'm just a classic push-up, sit-up kind of guy in between my buckets of chicken from Popeyes, but that's basically all I do. But very exciting stuff, and that's kind of what we heard, the trends of mixing and matching all of these things to kind of give everyone what they want as well. But let's check in with Ines Ferre on the floor of the New York Stock Exchange for more broad market action. Ines?
Zach, we're off the lows of this session right now, but the Dow still in the red. It had reached 29,000 earlier this morning. We haven't been able to get back to that level just yet, but we'll see what happens in the next few hours. And just looking at Boeing, Boeing is a Dow laggard right now, down more than 1% after Boeing released those internal messages regarding the 737 MAX jet, with some employees putting into question the design of that jet. And also Spirit Aerosystems has announced that it will be laying off some 2,800 workers in Kansas because the MAX jet production has been halted, and also because of the uncertainty of when that aircraft will be back in service. We're also today watching Uber. This is after Uber says that it will stop operating in Colombia by the end of the month, at the end of the month. This is after a judge said that Uber had violated some competition rules and has ordered it to cease operations in Colombia. Zach?
Interesting. All right. Ines Ferre on the floor of the New York Stock Exchange. Thanks so much. We'll check back in with you later on in the show. But next on Wi-Fi PM, we're digging into the remaining tariffs on Chinese goods and revealing how they are hurting small businesses and giving a huge boost to DC lobbyists. More on Wi-Fi PM right after this. Welcome back. A shocking report from ProPublica reveals some Washington lobbyists are helping companies get exemptions from tariffs, but that it can sometimes come at the expense of America's small businesses. So join us to discuss is the author of the report, ProPublica reporter Lydia DePillis, along with Yahoo Finance's Adriana Belmonte along as well. And Lydia, I mean, it was fascinating reporting to read. What we've seen here, because a lot of companies out there, it's a complicated process to apply for exemptions to the tariffs here.
Yeah.
What have you seen when you've looked into how lobbyists are helping some of those companies, some larger ones, do it?
Right. Well, so anyone can hire a lobbyist, but it is pretty expensive. And so we have seen a big jump in the number of companies hiring lobbyists for trade issues, whether it's exemptions or just generally shaping trade agreements. And they need them, frankly, just to figure out how to do it. You need to make sure the form is filled out right. The Office of the U.S. Trade Representative has a really specific set of criteria, and if you don't check all those boxes, then your chances of success are pretty low. So it's both law firms and then the lobbyists, and it's especially helpful if they have connections to the administration, because this is a pretty hard White House to lobby unless you know the guy in charge.
Yeah, because you were going through some of the companies that had worked with some Trump associates in terms of actually going through how to navigate this process. What did you see in terms of how much they were paying those people, and then also how successful they were in getting those exemptions?
Yeah, one example that really jumped out is a guy named Brian Ballard, who was Donald Trump's lobbyist in Florida, headed up the inauguration committee. His firm has been doing a ton of business. And he charged one company that makes radiology machines for cancer treatment more than $500,000, basically for access to the White House, including a meeting with Peter Navarro, who I believe is coming up later today. Navarro said he doesn't get involved in the exemptions process at all, but they did get the exemptions they were looking for. And then they turned around and told their investors in one of their SEC filings that exemption saved them $23 million. So pretty good ROI on your lobbying dollars.
Jeez.
So I kind of want to take a step back here. What I thought was really interesting, you talked about how it affects small business owners. You specifically talked to Mike Elrod, and he said that he voted for Trump in 2016. He still plans on voting for Trump despite all of this going on with the tariffs. Did you notice that as a common theme with other small business owners you spoke with as well, that they still maintain support for the administration?
Because he ran on draining the swamp, so it would seem counterintuitive.
Yeah, well, so, a lot of these folks are small-time entrepreneurs, and they've built up their businesses that do trade with China and really depend on that. But they're not necessarily liberal folks, and it takes a lot to change your vote, especially when there's such a gulf between what the parties want these days. So for Mike Elrod, who imports water heaters from China and distributes them around the world, it's a really crushing hit to his business. Essentially, he can't grow it anymore. He's had to shrink and by attrition. And yet, there's other things that the administration has done to make life easier on the regulatory front. So he figured, look, this has been really consequential for me, but it's not enough to change my vote.
I do have a question about the report overall. I mean, how is this, I know you framed it around Trump's trade war, but how is this really any different from lobbying business as usual in D.C.? Because this is a trend that we see not just on trade issues, but on big tech issues. I mean, it's the companies that are rich enough to hire these lobbyists that ultimately get their interest serviced. So what makes this different?
Of course. So the revolving door and lobbying has been a long-term feature of Washington.
Sure.
And I don't know overall what the trends have been in terms of spend, but there's been so much change in this administration and so much confusion on the behalf of businesses. And trade has been the one arena that has been not good for business overall. I mean, there's some businesses that have benefited, but if you look at the tax bill, most of the regulatory agencies, all of that has been, we want to help you, tell us what you need. And on trade, it's been like, please don't do this, please don't do this, please don't do this. And because the tariffs have been so sweeping, and they have had these procedures that do allow for exemptions from almost all of them, that's created a huge need for businesses to make their case.
Yeah, I mean, just when we look at kind of the success rate in some of these companies that have worked with those people in getting, as they say, they don't say that they're accepting money for inside access and actually saying that they'll guarantee that these exceptions will be granted.
Yeah.
But we have seen some pretty successful opportunities and attempts to get that. And they have gotten it.
To say that it's not a guarantee. There's plenty of big businesses that have applied for exclusions that have not gotten them. Like General Motors, for example, applied for a bunch, got none. Tesla is another. But if you do have the ear of the White House, Apple, for example, has about 25 exemptions they've applied for that they really need in order to sell their products at, okay, they're inflated prices. They could probably inflate them a little bit more.
Sure.
But Tim Cook, the CEO of Apple, has famously had a really good relationship with the president.
Yeah, fair. I mean, it's all very interesting reporting, just something to think about when we think about how lobbying has impacted the tariffs and how the tariffs have impacted small business. But Lydia DePellis and Adriana Belmonte, thank you so much for joining us. Very interesting reporting. Coming up, Amazon looking to grow ads outside of its own Fire Stick TV. How big of a boost that could be for the company next. Welcome back to Wi-Fi PM. I'm Zach Guzman, and joining me today is Yahoo Finance's Emily McCormick, along with SLT and Stretched founder and CEO Amanda Freeman, back with us in studio. We're checking the market action right now, and we're seeing stocks pair their losses. The Dow off just 31 points, the S&P and the NASDAQ in the green for now. We'll see what happens throughout the rest of our show. But for now, Amazon is reportedly looking to branch out. The Wall Street Journal reports the e-commerce giant is considering selling ads on other streaming platforms outside of its in-house Fire TV. Some of those places could be Apple TV and Xbox, maybe even PlayStation, if you want to get into that service as well. But when we talked about this, I mean, ads are a growing piece of the business for Amazon, so it would make sense to extend past just Fire TV Stick.
Well, and not only that, but Amazon also has this huge trove of consumer data just because of its e-commerce platform, and that's something that it could really leverage by expanding its ad business. I mean, Amazon has data on shopping and browsing, and previously it's been collecting this and using it with apps to target the ads that it sells on the Fire TV, and it could potentially, the Wall Street Journal reporting, could potentially actually expand this to a further ad business.
Yeah, I mean, ads for Amazon has been growing about 33% last year, close to about $9.85 billion when we talk about revenue coming in for Amazon off of ads. It's only about 7.6% of the share, though, that they have when it comes to streaming, or the ad market, I should say. But obviously, Fire TV Stick is not a lot of the streaming world, because there's also Apple TV and all those other options we talked about. So they're kind of limited unless they get onto these other platforms. The question is, which platforms are the ones they're trying to target? And we were just talking before the commercial break. I have Netflix and some of these other things. Apple TV I don't have, but I think other people do. Apple TV is very popular.
Yeah, I mean, Apple TV is how some people even get to Netflix,
Yeah.
right? And if you still have your old TV, you need an Apple TV to get to anything.
Yeah.
So, that's where that opportunity is.
And that's kind of why we've seen the want here to partner with some of these other businesses too to get their ads on those devices.
Right. I mean, look at some of the companies that are really benefiting from this. Look at Roku, for example. Stock surging over the past year, potentially continuing that as we see these streaming wars heat up. It's just opening another opportunity for the companies that are serving as the actual infrastructure supporting these platforms.
Do you think it makes sense though too to be focusing on the ad space for Amazon with all the things that they have going on? Is that like kind of where you think the effort should be placed?
It's a good question, but again, as you highlighted with those metrics, advertising is a growing business for Amazon. Internet advertising in particular, it's becoming more and more formidable of a foe for some of the incumbents like Alphabet, parent company of Google, and Facebook. So it's obvious that they have experience in this space and could potentially continue to grow that.
Yeah, we'll see if they can actually do it or get some of these pretty significant deals done. I mean, if they're trying to work with some of the other tech players in the space, we saw how complicated it gets. Even when we look at the way that Disney's been working with Netflix and working with Roku and all these other streaming players, it gets very complicated and does remind you back to the old cable days as well. But after the break, the family split, fit for a queen, with Prince Harry and Meghan announcing a break from the royal family to pursue their own financial endeavors. We'll chat the money they're leaving behind and how they could pursue branding for themselves apart from the royal family. Stay with us. Welcome back. Prince Harry and Meghan Markle are officially stepping back as senior members of the royal family, and we're breaking down how much they could lose or gain in this week's Fame and Fortune. Joining us now is Yahoo Finance's Alexandra Canal. And Alexandra, the couple made this announcement official on Instagram, which shocked a lot of the royal fans out there. And according to even some reports, the Queen herself was unaware of this before this news broke. So what's really going on here within the royal family?
So let's bring this back to Wednesday when they posted this bombshell Instagram announcement on their public account, Sussex Royal. They wrote in part, "We intend to step back as senior members of the royal family and work to become financially independent while continuing to fully support Her Majesty the Queen. We now plan to balance our time between the United Kingdom and North America." So let's focus on that financial independence. Right now, as a royal, you're not allowed to earn any type of professional income. That is something that they want to do moving forward. So if we look at the current structure of how the Duke and Duchess of Sussex earn their money, 5% of their total income comes from something called the Sovereign Grant, while 95% comes from the Duchy of Cornwall. Now, I want to start with the Sovereign Grant because this is ultimately what they're going to be losing when they step down as senior members. So the Sovereign Grant is funding to support the official duties of the Queen, including travel, security, staff, upkeep of the homes.
A lot of
Last
money.
year, as you're seeing, that purse totaled $107.9 million. Now, we don't know exactly how much they receive from this, but we know it's 5% of their income. On the flip side, 95% comes from the Duchy of Cornwall, and this is private estate managed by Prince Charles. This has a ton of money. The value is about $1.2 billion. Charles earns about $28.3 million. Again, we don't know the exact allowance, but the New York Times reported that both William and Harry receive about $6.5 million from this. And that is something that Meghan and Harry both said that they want to continue to receive moving forward. So we say financial independence, but really things are largely going to remain the same. They're still going to have their security paid for by the public. They're still going to continue to stay at their cottage in the UK. That's, of course, owned by the Queen.
So it's like financial independence like you would expect from a 23-year-old living in their parents' basement saying, I'm financially independent, I am making my own decisions, but I also want my allowance.
Now, Charles and the Queen could say, we're not going to give you this allowance, we are going to take this away, but experts think that that's probably not going to happen.
Is there any precedent for this? And if not, what does this actually, indicate going forward for the royal family? Does this sort of, cut into just the esteem that they have or potentials for future royals down the line to make a similar move?
This is unprecedented. The Office of Buckingham Palace and the Queen, they released a statement pretty much saying that they didn't know this was really happening. They said this takes a lot of time and any changes are going to take a lot of consideration and a lot of policy changes moving forward. Ultimately, people don't think this is really going to hurt the brand of the royals and the monarchy. I did speak to a company called Brand Finance that looks into the brand impact of the royals. They contribute about $2.3 billion to the UK economy every year. So if that were to take a hit, that'd be pretty devastating for the economy. But they don't think that's what's going to happen. They think this is just a continuation of this story and not an end to anything. So the brand as a whole should remain intact.
I mean, it's important to look at the royal family brand too, but now Meghan and Prince Harry are establishing their own brand as well. So that's going to be separate, and they have the opportunity to capitalize on that.
Yes, they seem to be doubling down on their brand and sort of Kardashifying themselves. I made up that word, but I think it totally
sounds like a verb.
It totally goes in this situation because they actually filed a trademark in the UK for their brand Sussex Royal, and they filed under a variety of classifications, including print and matter, clothing, campaigning, charitable fundraising, education, and social care services, just to name a few. And what this seems to be indicating is that they want to turn Sussex Royal into a brand where they can sell merchandise or get paid for the brand to be in place. So that could be a clothing line, that could be a new blog name. We know Prince Harry has that mental health initiative with Oprah Winfrey.
Sure.
That's going to be on Apple TV+, so maybe there's something with that. So it seems like Sussex Royal is going to house everything about Meghan and Harry, and it's kind of going to be their umbrella corporation of sorts.
Could be a workout class, could be an SLT Sussex Royal.
Every agent in Hollywood is about to go after them, and every brand is thinking of how they fit with these two. And
that's what I'm saying. I think you're seeing dollar signs here in terms of why they would want to do that. I mean, even their news announcement had their logo, right?
Right, and that's something that is very telling. They made this announcement on their Instagram page, not through the Office of Buckingham Palace, completely through their Instagram. They're drawing a clear line in the sand saying, this is our brand, this is how we communicate with our fans, with our followers, and it really does separate them from the rest of the royal family.
Big time, man. I mean, these are big moves. These are separating family moves right now, and a lot of pressure as the world watches to see what happens.
They're going to have the support of their family if they want to make this work moving forward, but it could be a good thing for everyone involved.
We'll see, but very exciting moves. It's fun to watch from afar.
Very fun. I mean, we're going to keep talking about it, so, it's fun stuff right now.
Very good stuff. All right, Alexander Canal with the Fame and Fortune of the Week. Thank you so much. Appreciate that. Amanda Freeman, thank you for being here for the full hour. And Emily McCormick, thank you as always. Let's check in with Ines Ferre on the floor of the New York Stock Exchange for more market action. Ines?
Zach, I'm here with Pete Tuckman. Pete, we saw earlier the Dow hitting 29,000 and jobs report, slight miss. Were you concerned at all about it? Are the
No,
markets
I'm not. You know what? I'm not. Those numbers get rearranged and decomposed. And so I don't, while they often can have a big effect on the market, this market is sort of trading in no man's land and at a high level, right? I thought the market was going to open above 29, but it didn't. I think we did touch it, with some fervor, but it quickly faded. I'm not sure whether a little bit of what's going on geopolitically in the world is eating away at it. When you put together the perfect storm of some fear and anxiety around what's going on with the presidency, with Iran, with the shooting down of the plane, with a confrontation with the Russians, I guess, in the Persian Gulf. There was some stuff about a boat went up against a boat. Let's be clear, and you know me, I'm a big bull, but short guy, big bull.
Okay.
But at the end of the day, the market is a little bit overbought at this point, or a little bit long in the tooth, as they say, and that perhaps 29,000 is a bit of a far reach. Net, could be. I don't believe we're going to see it. Some people feel that January may be a bit of a pause in consolidation.
I mean, we got here rather quickly, too.
We got here very quickly. We had a couple of stumbles along the way from 28 to 29. But I would say in short order, we made it to 29. And that's a significant play.
Do you see anything that would take this higher right now, or are we going to be in this range for a little bit?
I think we need to churn and burn here for a little while and try and understand what's going on. There's a lot of geopolitical stuff going on. Economically, we seem sound, but there's still the China thing that's not clear. There is this geopolitical situation, which is a bit of a wild card. We still have, an administration here that's under attack. And so there are unknowns.
Last quick question. I know you got the hats earlier. You've been the one that gets those hats. Do you have the 31 already?
31s I don't have. I surely do have the 29s. The 30s you're going to have to wait and see.
All right. Thanks so much, Pete. Zach?
We'll see how long it takes before we whip those 30 hats out. But coming up, the last jobs report of the 2010s is out. Two experts are weighing in on Yahoo Finance next. The ticker starts in 2.
Good afternoon and welcome to the ticker on Yahoo Finance. I'm Shauna Smith. Checking in on the market action. We briefly had the Dow above 29,000 since, though it has pulled back under that level. We are, though, off the lows of the day with the Dow off just 41 points. In terms of the worst performing stocks in the Dow, Boeing, NASDAQ off just around 1.3%. We're also seeing some weakness in Travelers and United Technologies. The S&P and the NASDAQ, though, still holding on to their gains. Let's get to the big story of the day, and that is the jobs report. The U.S. economy adding 145,000 jobs in the month of December, missing analysts' expectations. The unemployment rate holding steady at 3.5%. Joining us now for more on this, we have John Lonsky, Moody's chief economist, and we also have Mark Hamrick. He's Bankrate.com senior economic analyst. And John, let me start with you in terms of 145,000 jobs added in the U.S. economy last month, missing analyst expectations. What do you make of this number?
Well, we didn't miss by much. You have to realize there's about 150 million jobs out there, so the percentage miss is quite small. I think this report indicates a still growing economy, a healthy labor market. You know, if there's any risk we have going forward, it's more a shortage of workers, shortage of qualified workers, as opposed to a dearth of available jobs. The positive outlook for 2020 holds. The market, you know, has come off from its highs. It's basically flat. That's the S&P 500. But there's no reason to conclude that we're about to see the U.S. economy slow down to such an extent that the bull market in equities is all but over.
Mark, let me bring you in here. What do you think? Net revisions for prior months also took 14,000 off of payrolls here at the slowing monthly average. Does this raise any red flags to you?
No more than red flags that we knew the day before the report. As John noted there, the miss was really sort of a scalpel, kind of a slice, and the downward revisions were rather minuscule. If we start to see a lot of misses to the downside, obviously that's different. I think people need to be reminded that we are 11 years into an economic expansion. The unemployment rate is at a historic low level. But the number of jobs being added, annually or on a year-over-year basis is falling. We had something like 176,000 jobs added a month on average last year, compared to 223,000 a month added in the year before. That is natural if this expansion is as mature as we believe it is. And the other part, we look back at where we were a year ago, let's say December of 2018, people were reaching for their tranquilizers in the medicine cabinet there, fearing that a recession was imminent. Federal Reserve delivered its own kind of medicine, and we think we're in a better place right now.
John, what about the average hourly earnings? They were up 2.9% year over year. It was the first sub 3% reading that we've gotten since July of 2018. Does that concern you at all?
No, it does. You know, that in part is because of some sort of measuring problem, a statistical glitch, if you like. And if you take that aside, if you put that aside, you probably would get wage growth of at least 3% annually. In a way, you know, this slow wage growth is a good thing. And so is this a modest pace of payrolls expansion. It is telling me that corporations are not rushing to hire workers, rushing to pay higher wages, and that is add to employee compensation costs in a manner that might be regretful later on if this anticipated increase by business sales fails to materialize. Corporations, you know, they're even skeptical of what's going on with their equity prices. Something like 77% of surveyed chief financial officers, CFOs, claim that the equity market is significantly overvalued. So perhaps this is time for a bit of caution on the hiring front and as far as labor compensation is concerned.
Mark, do you say when you take a look at where the stock market is today, we had the Dow above 29,000, although it was just very briefly that it did cross that mark, but do you think that we're overvalued where it stands right now?
Just to be perfectly frank, that isn't an issue that I pay a lot of attention to in my work. I would pay more attention of issues that are relevant to our Bankrate audience, and that is, you know, most individual investors are looking at a return from the market over the long term. They are not short-term investors. Obviously, for members of your audience, that may be a different issue. Absolutely, if you see records being chalked up on a day-to-day basis, you know, you think that good times should not last forever, and you are due for what might be viewed as at least a normal timeout. I think for most investors, though, and I want to encourage, by the way, millennials to look at more aggressively investing in the market, because they are the ones who have traditionally, according to our surveys, seen real estate being a better investment in their view than the stock market for long-term money, meaning 10 years or longer, and that's just frankly mistaken. So whatever level we're at, this level won't hold. These levels are only temporary almost by definition. But you know, we are late in the expansion, but the recession risk does not seem to be terribly high in terms of what we're looking at immediately.
John, what do you think?
The equity market is overvalued, but it is not as grossly overvalued as it was in 1999, 2000. This may not be the best time to get into the market. If I was a millennial thinking of getting into the market, I would wait for a correction of some sort where the market slides by 5% before I commit a lot of money to stocks.
All right, John Lansky and Mark Hamrick, thanks so much for joining me today.
Thank you.
Well, let's get to the latest developments on Boeing, the company releasing internal communications showing that employees mocked their own colleagues, regulators, and criticized the 737 MAX jet. Now, Boeing responded in part saying that we regret the content of these communications, and we apologize to the FAA, Congress, our airline customers, and the flying public for them. The language used in these communications and some of the sentiments they express are inconsistent with Boeing's values, and the company is taking appropriate action in response. We have Akiko Fujita here with me. And Akiko, when you take a look at what some of these comments were, Boeing's response to them, how troubling do you think this is?
Well, it is certainly troubling, but let's kind of pull back here to look at the context of all of this, right? This is something that was released to the FAA by Boeing back in December. The comments are just now coming to light, and it details internal communication specifically related to Boeing's or the 737 MAX's simulator program, as well as the certification of the plane. And the timing of all of this is really key here, because we're talking about between 2013 and 2018. This is a time when Boeing was #1 working on the simulator program, trying to get certification from the FAA, and also trying to convince the FAA that this could be done without additional costs, essentially. And let's point to some of these emails that have come down, because they certainly do point to the fact that a lot of these employees were troubled by what was happening inside the company. One email reads, "Would you put your family on a MAX simulator-trained aircraft? I wouldn't." Another writes, "The airplane is designed by clowns who are in turn supervised by monkeys." And then there's this one from a Boeing management pilot who expressed concern for prior work on the MAX, saying, "I still haven't been forgiven by God for the covering up I did last year. I can't do it one more time. Pearly gates will be closed." And Shauna, just to stress the point here, these emails came down after the first 737 MAX had already been delivered.
Yeah, well, and that's what's so scary, because we talk about the fact that, one, obviously so many lives have already been lost if these jets do return to air, just in terms of whether or not customers will even be willing to take the risk and fly on these planes anymore. What do you think this means just in terms of the potential timeline that Boeing could have in order to get these planes back in the air at some point?
Well, it's still a big question mark, right? I mean, I think the question is, what does this mean for the investigation? We heard from Senator Ted Cruz saying, essentially, you know, it's troubling that Boeing was not even forthcoming in bringing forward these comments now. So this is now going to be added to the broader assessment of the, you know, return of the 737 MAX.
Yeah, we talk about the ongoing investigation as this still continues. Obviously, a lot of the suppliers have been hurt today. We had a report out that Spirit AeroSystems plans to cut about 2,800 jobs as the 737 MAX continues to be grounded. So not only, obviously, on an investor perspective is this affecting Boeing, but a lot of its suppliers as well, as we've been talking about.
Yeah, and this is a supplier that's been really hit hard, right? Their revenue is about 50% of it is from the MAX as well. And they've basically just said, look, the uncertainty, with the uncertainty in place, we have to take these measures. Once we have a more prompt timeline, we will reassess everything.
All right, Akiko, thanks so much. Well, coming up, the U.S. imposes new sanctions on Iran after the strikes on U.S. targets in Iraq. We'll head to Washington, D.C. for the latest next. Welcome back to The Ticker. Tensions are mounting between the U.S. and Iran as the Trump administration slaps new economic sanctions on the Middle Eastern country. Yahoo Finance's Jessica Smith is in D.C. with the latest. Jess?
Shauna, Secretary of State Mike Pompeo and Treasury Secretary Steve Mnuchin talked to reporters about these new sanctions this morning. And the administration is targeting Iranian metal industry and 8 high-level Iranian officials. They say this move will cut off billions of dollars of support to the regime. Here's Treasury Secretary Mnuchin.
The president has been very clear. We will continue to apply economic sanctions until Iran stops its terrorist activities and commit that it will never have nuclear weapons.
Pompeo went on to tell reporters that the U.S. does not want war with Iran, but wants the country to behave like a, quote, normal nation. So reiterating what we've heard from President Trump, that the U.S. is ready to embrace peace, but Iran needs to end its support of terrorism and abandon its nuclear ambitions. Shauna.
All right, Jess Smith, thanks so much. Well, joining us now for more on this, we have Amy Myers Jaffe, Senior Fellow at the Council on Foreign Relations. And Amy, when you take a look at what the Trump administration announced today, further economic sanctions against Iran, do you think that this will be effective?
Well, I think that we have seen the pressure campaign economically on Iran. And that actually was part of the reason why we had to be concerned about an escalation in military action. So it's definitely squeezing the regime. That is, but it's unclear, what kind of result is that going to bring to bear without having there be a second-track diplomatic effort to try to come to terms of an agreement or a reinstatement of the nuclear deal. That's something that could, work for all concerned.
Amy, what do you think the likelihood is that things will begin to re-escalate again as a result of this?
I don't think as a result of this, but I still think we're not out of the woods in terms of the possibility of re-escalation. We still have the proxies that are operating. It's unclear, does Iran have full control of these proxies? Does the death of Commander Soleimani make it harder for Iran to control parties on the ground or not? We still have massive protests in Iraq against the current Iraqi government and the current Iraqi political system. So a lot of instability in Iraq. And we have an unsettled situation inside Iran where, it's been true that even that government, which seems to the outside world to be unified, is actually very splintered with different factions. And I'm sure those factions have disagreements about what the approach to the United States should be.
Amy, how do you think if you were advising the Trump administration, how do you think that they should respond, or what do you think their next steps should be at this point?
Well, I think at this point, the administration has established that it's not afraid of military action. It's not afraid of Iran's proxy activity. And so therefore, I think we're in a good place to try to go with a, sort of dual track where either through third parties or maybe even, through quiet diplomatic overtures to try to see, what conflict resolution would look like, maybe indicate an interest in upping the nuclear deal with different conditions and not be quite so comprehensive in the demands on Iran, but actually look for, what is practical to de-escalate, to get a better situation on the ground for the Iraqi people and their political desires, and to maybe redo the Iran nuclear deal to give it a longer lead time, not sunsetting so quickly as the original Obama-era deal, and maybe also broadening it a little bit. But with the carrot of a much more immediate lifting of certain kind of economic sanctions that the government is under now. So providing both, carrot and stick.
All right, Amy, we also have some breaking news here that I just want to get to. There's also reports from CNN that on the same night that the U.S. killed Iranian commander Qasem Soleimani, the U.S. also unsuccessfully targeted another senior Iranian military official in Yemen. This is according to a U.S. official with knowledge of the events and another source familiar. Again, this is coming from CNN. And Amy, I mean, this also points to the fact of the U.S.'s relationship with not only Iran, but even some other of the countries in the Middle East, in terms, like most specifically with Iraq. We talk about the possible fallout of what this new conflict could mean for U.S. and Iraq relations. Where do you think that stands at this point?
Well, I think there's an opportunity. I think there's an opportunity in Iraq to come up with a new arrangement. For example, the United States could defer and withdraw some of its advisors in exchange for replacing them with NATO advisors. That would give NATO a bigger responsibility. Europe has taken a good lead in trying to do conflict resolution with Iran. So that might be a solution that would preserve U.S. interests, would help Iraq maintain and enhance its sovereignty, would weaken, hopefully weaken, some of Iranian influence on the ground. That could be part of the negotiation. So there really are some options that could be tried. Now that everybody's stared down the real risk of war and had time to think about what those consequences are, the question is what kind of solutions could be viable, and having NATO take a role in Iraq, allowing the Iraqi people to have a little bit more influence on the outcome, whether that's a constitutional convention to reorganize how their parliament elections are structured or their party system. I think there's, flexibility to be creative. And the question is, on both sides of the equation, if everything's a nail, you only have a hammer. But I think that realistically, there are a lot of good solutions that are available today. And the Iranian government would have benefited had they had the Iranian nuclear deal and had limited the war in Yemen and had not been continuing to have military conflict with Israel, we might be in a different place today.
All right, Amy Myers Jaffe, thanks so much for joining me today.
Thank you very much for having me.
All right, well, oil prices may prompt consumers to ask for higher pay. Yahoo Finance's Sabeel Marsalis joins us now with this. And of course, this relates to some of the geopolitical tensions between the U.S. and the Middle East. How will this impact American consumers?
Yeah, so basically, when you look at today's jobs report, it's disappointing for workers because we see that wages are flat. So from November to December, they only went up 0.1%. And when it comes to December, it's the first time since 2018 that we've seen year-over-year growth that's below 3%. But UBS is saying, despite the fact that paychecks aren't really going up, workers still have bargaining power to raise their paychecks in this tight labor market because the unemployment rate is still 3.5%. They also say they have even more power because of the U.S.-Iran tensions that we're seeing right now, especially if they push up energy prices for an extended period of time. Now, consumer perception of that is that that will lead to gas prices increasing. So when you go to the gas station, gas pump, fill up your car, you think it's going to cost you more financial pain and actually hit your wallet. So what UBS is saying that in a climate like that, workers will likely go to their boss and say, you know what? I need my paycheck to go up. I need a raise.
And also, I mean, we can also put the fact that workers might have more sway now than they would have in the past just because it is such a tight labor market. We talk about the fact that the unemployment rate is at 3.5%. So this is a time where maybe a difference in a couple years ago where a lot of employers will be listening to their employees and may actually give them a raise or be more likely to.
Yes, absolutely. And UBS was saying that the situation right now is different from back in 2011 because that's when we saw sustained crude oil prices spike for a long period of time and for a couple of years. And during that time, workers couldn't really go to their employers and say, you know what, I want a raise because we were just coming out of the recovery. So it wasn't the best time to really play that game. But now, since it's a tight labor market, 3.5% unemployment rate, it is the time. It is the time to ask for that raise.
All right, Sabeel Marsalis, thanks so much.
Thanks, Shauna.
Well, coming up, Grubhub is tumbling after the delivery giant says that there are no plans for a sale. We've got the details as the company says it's confident in its growth strategy. And stay tuned, Microsoft CEO will join Yahoo Finance for an exclusive interview on Monday. We've got all those details, and you won't want to miss that interview. Welcome back to The Ticker. Grubhub is slumping today after the food delivery giant is denying reports that it's looking to sell. Now, Grubhub telling Yahoo Finance in part, there's unequivocally no process in place to sell the company, and there are currently no plans to do so. We are very excited about our near and long-term opportunities and are confident in our organic growth strategy and our execution without M&A. We have Inez Ferre standing by on the floor of the New York Stock Exchange. And Inez, when you take a look at Grubhub stock, it's declining today. Why do you think investors were so excited about the potential sale?
Because Grubhub had warned back in after the third quarter last year. They said that they gave weak guidance for the fourth quarter, and they also said that the competition was fierce, basically, and that they were that share was not accelerating as much. And so, in fact, they also said that they were going to be investing more in marketing when they wrote that letter to shareholders. So this is a space that has so much competition in it, and diners are being promiscuous, in the words of what Grubhub used back then, which means that they can really go from one platform to the other. So they're trying to retain diners, and that's when back then last fall, you saw the stock really take a dive. So when this report came out that perhaps it would be up for sale, that someone will buy it, then that's when investors got very excited, because the feeling is that there is consolidation coming to this space. I mean, the CEO of Domino's, Rich Allison, must be saying, "I told you so," because he has been saying that there's going to be, he doesn't want to partner with these third-party platforms, saying that there will be some sort of shakeout, that it's just unsustainable for all of these competitors to live in the same space.
Yeah, and Inez, when you talk about the fact that competition makes consolidation a very attractive idea in the space, there were also reports out there that Walmart or Kroger could be interested in potentially buying Grubhub. So even though they're saying that right now it's off the table, doesn't mean that in the future this sort of report or some sort of potential sale might come back on the forefront.
Certainly, and especially with the case of Walmart, where Walmart has seen an increase in sales of groceries. So Walmart could be a great kind of acquirer in this when it comes to Grubhub. But the competition, again, is just so fierce that all signs are pointing to consolidation. I mean, you had Square that had sold caviar. You had Amazon that had shuttered Amazon restaurants. Those were the first signs, really, of this. But the fact that Grubhub has been losing market share and has been trying to retain the diners and to make sure that they're loyal to Grubhub are just signs that this space has gotten so competitive for the players in it.
All right, Inez Ferre, thank you. Well, we have another big call on Tesla today. Piper Sandler saying that the market is underestimating Tesla's growth potential in China. The firm hiked its price target on the stock to $553. That represents a 30% upside from yesterday's closing price. We have Brian Chung with us now. And Brian, when we talk about the fact that they think that the street is underestimating the potential value or potential growth from China. What do you make of that?
Yeah, well, it's a 30% upside that Piper Jaffray has. That's relative to its previous target. That was $423. We just flashed the chart for you. The shares of Tesla right now trading at about $479 a share. So this is basically the street moving the guidepost for where they think this stock should be trading, as it's had a pretty monstrous 2 months or so. Consider that Tesla, if you look over the last 12 months, had actually been underperforming the broader markets for a good amount of time. Since then, we've actually seen it rise 38% over the last 12 months. Keep in mind that the S&P 500 during that same time has risen by only 26%, still a pretty penny, but Tesla just really on this surge amid all the optimism in China. The reason why Piper Jaffray upgraded their target is because they've been looking at China's vehicle registration data. This is according to CNBC, and they say that registration data showed a 19% jump in sales of the Tesla Model 3. You'll recall that earlier this week on Tuesday was when Elon Musk had that big bizarre event in China where he was dancing around. He was doing that to announce the first customer deliveries of the Model 3. So this is only just the beginning. So if those numbers already show a 19% jump in sales, that means that Tesla could have a really great market in China, which is quite frankly the largest EV market in the world and the prize of a lot of other automakers when you consider VW, Ford, companies like that that are actually teaming up to try to tackle this Chinese market as well.
Yeah, and Brian, what's interesting here is just in terms of the fact that they're so bullish on China. We have to remember that China's auto market is actually, the auto sales in China are expected to decline even further this year. So it's important for investors to keep that in mind when they're trying to make some of these projections as well.
Absolutely, and the Chinese economy is slowing at large, so that probably explains a lot of those auto purchasing trends that you've seen. But regardless, because of the size of China, right? I mean, in terms of population, about 1 in 6 people in the world are in mainland China. So this is just there's a huge total addressable market. It doesn't necessarily mean that Tesla will be the only player there. You see the list of automakers in front of you, but there are a number of other EV-specific names in the space, like NIO, which has been having a pretty rough last 52 weeks. But they are still trying to fight and try to beat Tesla. They're hoping to, brand themselves as the domestic automaker that can take on Tesla. But as we think about those big EV names, Tesla and Elon Musk specifically are one of those that are commanding the space. So they seem like the front runner right now. But again, a huge market to be played with in China.
All right, Brian Chung, thanks so much. Well, before we go to break, we have some more breaking news. Online mattress company Casper gearing up to go public. The retailer filing for an IPO with U.S. regulators moments ago. Casper's investors include celebrities like Leonardo DiCaprio and rapper 50 Cent. We'll keep you updated on these developments. We'll be right back. The U.S. economy added 145,000 jobs last month, missing expectations of 160,000. Leading the way were jobs in retail and healthcare and hospitality. You could also see that manufacturing and mining on the screen lost jobs, actually. Manufacturing was down off 12,000, mining losing 8,000. Joining us now is Joel Schulman. He's a CEO of ER Shares. And Joel, when you take a look at those numbers that we got out today, 145,000 jobs were added. Missed those expectations of 160, although it wasn't a huge miss.
Right.
Unemployment at 3.5%. What do you think this tells us about the state of the labor market right now?
Well, there are a couple of things related to this, and we spend actually a lot of time in my company looking at job growth. We, in particular, we focus on entrepreneurial companies and job growth. And so what we do is we analyze the S&P 500, and because this is our peek into actual data, hard data. And what we can tell you is that last year there was about $3.1 trillion between M&A deals proposed and actually completed, another trillion or so that's coming due in the near future. So we've got about $4 trillion, and a lot of jobs are being lost. And so a lot of the data that people are focusing on is looking at job growth. But when you back out the M&A, we had less than 1% job growth in the S&P 500. But there are entrepreneurial companies that are creating most of the job growth. It's about 11.3% from only 30 companies, in the S&P 500. So it's really a handful of companies in communication services, IT, and consumer discretionary that are driving the market. The rest of it, we're actually losing jobs, through M&A activity.
Joel, is that a trend that you see continuing now for the next couple of months, or at least throughout 2020?
Yeah, no question. There are a lot of, as we looked at last year, in terms of the revealing statistic, was M&A deals that actually fell apart, that were terminated, and there are very few. In fact, over the last 5 years, it was one of the smallest numbers for that period of time. And what that tells us, there are a lot of companies, a lot of M&A bankers trying to push through deals. While interest rates are low, while the market's calm, the market's at all-time highs. And so what they're trying to do is push through these deals, and so we expect to see more of that going on. And so what the data does not show when they talk about job growth is the loss through M&A.
Joel, when you take a look at where the market is today, we had the Dow briefly above 29,000. Right. Seems like we're hitting new record highs almost every day at this point. Yeah. Do you think this upward momentum that we have been seeing is sustainable?
Well, not at the same pace and not with the same companies. So when you look at Apple, that's been up 90%. It's now close to a $1.4 trillion company. I know a few, it's about 1.375. Mm-hmm. And Microsoft is 1.2 trillion, which is up 40 to 50% last year. You can't expect these monster companies to still grow at 40% or 90% per year. But there are more than half the companies in the S&P 500 that did less than 25 to 30% last year in terms of stock price appreciation. And it's those companies that we see continuing this year. We see a lot of growth potential in U.S. small cap entrepreneurial companies, and we see non-U.S. small caps being the really sweet spot in the global equity markets.
Joel, one thing that caught our attention today in the Wall Street Journal, they had this feature piece about money-losing companies. As it stands right now, they said that 40% of listed companies are in the red. When you take a look at that, is that something that concerns you?
Well, many of those companies are the Ubers, the Lyfts, the Pinterests, and these companies have Workday. It's a $40 billion or $30 to $40 billion company that's been around for 20 years. You've got a lot of these high growth companies that are losing money, and people are betting on growth. And while the top line is going up, the bottom line is still lagging. And so what we do, we have a handful of these entrepreneurial companies. We invest in publicly traded entrepreneurial companies, and some of those companies are in there. But we're shifting more of our portfolio to companies with actual cash flows, and there are still plenty of those companies. And many of the companies are reaching record profits in 2018, 2019. We expect it to continue in 2020. So I think in 2020, you're going to see at some point where people are looking at the market saying it's gone up 30, 40% in the past 12 months or so. They're going to be focusing on cash flows, and there's still plenty of those companies in the U.S. and abroad.
All right, Joe Schulman, thanks so much for joining me.
Thank you.
Let's take a look at KB Home. That stock is on our radar. Shares tumbling on the heels of a mixed earnings report. You can see the stock is down just over 3%. Now, one bright spot, though, in this report, orders coming in above the street's expectations. Ines Ferre is back with us. And Ines, when you take a look at this mixed report, what weighed on KB Home's results last quarter?
Well, basically, they said that they had some delays with deliveries in the Bay Area because of the fires and because of the power outages, and that sort of put a damper on their ability to be able to install utilities. And so as far as profitability, the company says that increased by 10%. But a couple things stood out to me with this report. One is interest rates remain low, so that's been good for the company. And the company also says that it has been catering to first-time buyers. In fact, delivery for first-time buyers was up by 56%. They've also catered to move-up buyers. Some of the concerns which had been raised during the conference call were land, because we know that land has been tight. So KB says that they own many of their lots. So they're expecting this to support their revenue growth in 2020. As far as lumber costs, those had come down, so that was good for the company. And then if you just take a look at the California area with the California coastal homes, the higher price point homes, this was asked of the company, have they seen some sort of turnaround, some recovery, some improvement with higher price points? Because again, remember that KB is catering to first-time buyers and also to the trade up, the move up buyers. And they said that they have seen a little bit of improvement, minor improvement, but the higher price point that you go, the softer that the market gets. So it is better than it was in the fall, but it still hasn't recovered. And this is a theme that we've seen with other home builders as well.
And as you mentioned, California on the earnings call, one thing that jumped out was as of January, California requiring solar panels on homes. Any guidance from KB Homes in terms of how this will be handled?
Sure. Well, KB Home says that they have experience with installing solar panels on homes. They've already done this with many homes. But as far as this legislation where it's required in some homes, they said that in some communities, it just depends from community to community. In some communities, they've been grandfathered in. In other communities, they've asked for permits in order to avoid to have to put those solar panels on. This is required on some homes. But the KB executives have definitely said that the industry right now is trying to wrap its arms around it. So as they try to wrap their arms around it, they're working in the ways that they can, but saying that as far as the installation's concerned, they've got experience in this. They've got no problem with doing it.
All right, Inez, thank you. Turning to the streaming space, Amazon is in talks to sell streaming TV ads outside of its Fire TV. This is according to the Wall Street Journal. Now, the e-commerce giant reportedly wants to sell ads on other streaming services like Apple TV and even Xbox. We have Akiko Fujita back with us. And Akiko, when we take a look at why Amazon will want to be doing this, it's a potentially very lucrative space.
Well, it is. I mean, you look at the potential there, right? I mean, I was looking at numbers here from eMarketer pointing to $8.9 billion this year. That's how much TV ad spending or streaming TV ad spending is expected to rise. It's $2 billion more than last year. But let's talk about what exactly the Wall Street Journal is reporting. That's where the story first broke. Amazon is looking at integrating its technology into some of these streaming services so that they can basically unload their ad inventory for TV streaming. And essentially what the Journal is saying is that this is still in a very preliminary stage right now. There are talks taking place between programmers and Amazon Publisher Services, which is essentially the arm of Amazon that provides that technology. Amazon, when you look at what they have done on Fire TV so far, they use data on their shopping and browser behavior, basically all the data they collect on the e-commerce platform to provide targeted ads there. So if you look at, well, what's the incentive for somebody like an Apple TV or other streaming services to really get the buy-in? Well, that's specifically why. The one catch is, though, if you want that kind of targeting, you would have to basically sell the ad through Amazon's ad buying tool. So everything would have to still go through Amazon.
Is that something, do you think that they'll receive any pushback there from some of these other tech companies that they're trying to partner with?
Well, it's tough to say, right? Because when you look at the data that Amazon has, it certainly does make sense if you want to do targeted ads. At the same time, Amazon's also in the content business. Right. If you are one of their competitors, you're saying, well, why do we want to help Amazon out even more? This is an interesting note, though. When you look at the broader advertising space for Amazon, they are making huge inroads right now, and they are the third largest digital ad platform. We talk about Facebook and Google all the time, but they're certainly making a lot of inroads there, and this points to just another aggressive move that they're looking at.
They certainly are. All right, Akiko, thank you. Well, moving on here, we have Citi reiterating a bullish call on NVIDIA, the firm adding the chipmaker to its Catalyst watch list, saying that it will outperform its peers. Brian Chung is back with me. And Brian, why do you think Citi is so bullish on the chipmaker at this point?
Well, Citi is bullish because they think that they have a pretty good runway on a number of other different types of revenue streams that are not just simply the gaming consoles themselves. So InView was the big CES conference in Las Vegas this week where a lot of tech was showed off. And although we didn't actually see the console itself, there was a lot of buzz about the new PlayStation 5 in addition to the renderings of what will be the next generation of the Xbox. That's the Xbox Series X. Keep in mind that both of those consoles will be powered by AMD chips. So that was definitely a loss for NVIDIA. But NVIDIA is really playing into some different revenue streams, as I mentioned, one of them being virtual reality. So they did unveil at CES a new rendering technique. This is what they call the variable rate super sampling, which they say will increase the image quality in VR games, which could create a number of drivers for those that are really investing in that space. The second thing is also esports. That's been a huge play over the past few years. They also unveiled something called the G-Sync display. This is something that they say will be able to deliver a faster refresh rate at 360 hertz. I don't know what that means, but apparently that's pretty fast. So that's something that NVIDIA is really playing on as well. So Citigroup saying that it has a $245 target on the stock. That's basically where it's trading today. So it seems like for right now, at least, Citi finds that the value of this company is fair, given their growth trajectory at about where it is right now.
Brian, is there any correlation anymore to the value of cryptocurrency? Because when we were seeing the rise in Bitcoin, we saw a lot of these chip makers also get a boost. That, though, seems to be in the rearview mirror at this point.
That's definitely a driver. It probably was a driver when cryptocurrency was a huge dominator in the headlines. But what we've seen is that the chip makers were actually more part of the trade narrative over the past 12 to, say, 18 months because of the fact that these chip makers really had to sit on a large inventory of product that they simply could not move during the trade war. So, and it's not just NVIDIA that's a part of that. And you think of Micron Technologies, for example, even being mentioned in President Trump's State of the Union. So they've really gotten wrapped up in the trade discussion. But what we've seen is that the story for these chip makers has really turned around the last few months when you consider that NVIDIA, relative to the market, has been doing pretty decently when you consider that it's up about 68% over the last 12 months, whereas the S&P 500 only up about 26%. So this is a company that's been doing pretty well, and this is a bigger story emblematic of the other chip makers as well. It's whether or not there are other catalysts like VR, like esports, like these new gaming consoles that can drive them further up in the next short term.
All right, Brian, thank you. Well, coming up, a new report finds that the S&P 500 is significantly overvalued as the stock market index tops 25% on the year. We'll explain all that next. The S&P 500 is now more overvalued than ever. That's according to Ned Davis research. And that argument is why many investors are tempering their expectations for returns this year. Joining us now is Ed Clissold. He's a chief U.S. strategist at Ned Davis Research. And when you take a look at the possibility that the S&P is overvalued, you're arguing that, yes, in fact, it is. Why do you think so?
Well, it just comes back to the data. We have data going back almost 90 years using earnings and sales, and no matter what metric you use, it shows that the S&P 500 is significantly overvalued if you look back over history based on earnings, the median or average stocks PE ratio, price to sales. It's all saying the same thing. Stocks are overvalued.
When you take a look at the median price to earnings ratio, now this excludes the skewed effects of very profitable and very unprofitable companies. This was in your report, but shows that the S&P 500 is overvalued by nearly 30% at this point.
Yeah, now that's, again, data going back to the mid-60s, showing that that's just what the data is showing. Now, if you look over the more recent period, say the last 5-6 years, as interest rates have been very low and the economy has been growing, and we got out of the depths of the Great Recession, that median PE has averaged a little bit higher. Now we're still about 9-10% above that fair value. But if you put in the context of other things going on, which you always need to do when you're looking at valuations, it's not quite as extreme, but still stocks are overvalued.
And when you take a look at where the S&P is trading today, 32.69, where do you see it going from here?
Yeah, as long as the economy is doing okay, which we think it's going to do, so you're probably going to get decent earnings growth along with that. And I think we can make gains this year. We were thinking, we could get well above 3,300 as we move to the latter part of the year. But to expect the kind of gains we got last year, back to back, given the economic and fundamental backdrop, is probably wishful thinking.
And what do you think in terms of leadership? Will we see some of the huge tech giants that really carried this rally or were the big providers of the rally in 2019? Do you think that will still hold true in 2020?
We do, because nothing's really changed. I mean, if you look at the latest data points in terms of the ISM report, today's jobs report, they're telling us the same thing. We got positive growth, but not very strong. And the kind of sectors that are driving growth are these tech areas, growth names. And so I think it is going to be large cap growth that's going to be the leader going forward.
All right, Ed Clissold, thanks so much for joining me.
Thanks for having me.
Well, coming up, the 2020 race is heating up. We're breaking down presidential candidate Pete Buttigieg's $1 trillion infrastructure plan. We've got that next. Democratic presidential candidate Pete Buttigieg unveiling an ambitious infrastructure plan. It aims to create millions of jobs, fix roads and bridges, and improve access to clean water. Now, his campaign says that this proposal is expected to cost $1 trillion. Joining us now is Aaron Klein. He's the Markets Policy Director of the Center on Regulation at the Brookings Institution. And Aaron, when you take a look at Pete Buttigieg's plan, taking on everything, like I just said, from roads to ensuring that we have clean drinking water, what do you think of this plan?
Well, I think it's a bold and ambitious plan with a broad definition of infrastructure that seeks to really reinvigorate a strong and prominent federal role in providing a lot of the services that Americans have come to expect that we've underinvested in for decades now.
Aaron, do you think that there's a realistic chance for a president, whether or not it's President Trump or one of his Democratic challengers, to, if they actually prioritize infrastructure, that they could get something done on this front?
Yeah, absolutely. President Trump talked a big infrastructure game and has delivered nothing. But what he did do was he spent $1 trillion on defense. If you see the $100 billion a year he's added over 10 years over his budget, that Congress has passed with relatively little debate for the American public, we've increased defense spending by $1 trillion. A different president with different priorities could easily switch funding and emphasis. If we can spend $1 trillion on defense, we can spend it on rebuilding America. In fact, that's a much more politically popular view across the aisle and much more in line, frankly, with a lot of the themes candidate Trump talked about, but not what President Trump has delivered.
And you talk about the potential cost of this. This proposed plan from Buttigieg will cost just around $1 trillion. How do you think we're going to pay for this, or what's the best way to fund this?
Well, let me say, when you say cost, that kind of makes people think about the net value, as opposed to, I like to think of it as an investment in $1 trillion. For example, one of the things that's clear in this plan is a strong commitment to providing clean water. Drinking water has historically been much more of a local and state issue, and as what we saw in Flint, Michigan, lots of communities have been drastically let down by the water infrastructure in their neighborhood. Now, when you invest in clean water and you take lead out of water, you reduce crime, you increase labor force productivity. There are a lot of other ancillary social benefits. So I don't think, it's $1 trillion of investment. It doesn't cost society $1 trillion. In fact, if the infrastructure is well spent, it will be a far greater return on investment, much more economic growth, much higher paying quality, more quality middle class jobs than a lot of the alternatives. I think there is a realistic chance. Infrastructure is one of those bipartisan issues. There are no Republican or Democratic potholes, but it has to be a strong priority of a candidate. You've seen candidate Buttigieg and other Democratic candidates really hammer home infrastructure as a core theme in their campaigns.
Aaron, do you think that the gas tax is a viable and long-term funding source? Because that's been a little bit controversial.
Oh, absolutely. I think this is something where the progressive left has to be a little bit concerned about being within their own bubble. Look, there were more Dodge Caravan minivans sold last year than all electric cars combined, if you exclude a little weird number in Tesla 3 fourth quarter sales. There are 8 Ford F-150s for every Prius sold in America. And so people who think that the gas tax isn't a viable source, I don't know, is it viable in 100 years or 200 years? No, but what we're talking about here is a 15 to 20 year window to try and get revenue in and make some important investments. And unfortunately, look, I'd love it. I'd love it if we were able to move past a fossil fuel-based car system, but that's not happening in the next 6 years in America. Look, the average car on the road is 7, 8 years old. The average truck is 10 or longer. Gas is $3 or under a gallon at the pump in most places, and people are loading up on SUVs and pickup trucks.
All right, Aaron Klein, thanks so much.
Thank you.
It's time for our last tick of the day, and it is drug makers. Now, California could be the first state to make its own prescription drugs under a proposal announced by Governor Gavin Newsom. Now, the governor says that the measure would, quote, take the power out of the hands of greedy pharmaceutical companies. We have Anjali Khemlani joining us. And Anjali, when you take a look at this, how exactly would this work?
So right now we are sparse on details, but the governor was speaking just moments ago with his budget address, which is where this proposal is included. And he's basically looking at contracting with existing generic drug manufacturers. And he said that he is already in conversation with them, will not reveal who they are just yet, but is saying that there will be a detailed proposal available by the spring that will require legislative support. He did also mention insulin by name, saying that it is one of the drugs that is top of mind. And it looks like the idea that he's going after is something that is already being done by a group called Civica RX, which is a group of 1,200 health systems that are already pursuing their own label.
Anjali, is it thought that California has enough power in order to get this done? I mean, given the fact that it's such a large state?
Absolutely. You're talking about 40 million residents, and the state has already been tracking the spending of drugs. You're looking at generics up by at least 37% compared to brands rising by 25% from 2017 to 2019. And that's something that the state has been looking at as a reason to go after this. Now, again, there are still questions about how he'll do it, which distributors, are they big or small, how he's really maneuvering through the existing market to get this done. But at the end of the day, it's going to be basically a glorified group purchasing order effect. And that's another as well, by the way, issue that he's going after is trying to band together state agencies and private insurers, private employers and insurers to try and get lower costs to the members.
All right, Anjali, thanks so much. Well, it's time to go beyond the ticker. Today's Labor Department data revealing that women accounted for just over 50% of all jobs added last month. This makes it, or all jobs last month. This makes it the first time in nearly a decade that they've outnumbered men. We have Brian and Akiko back with us to discuss. And Brian, when you take a look at this, what's your reaction?
Oh, well, the signal is that this is a tight labor market that's pulling more people off the sidelines and into the labor force. So it's great that women represent a majority now of the non-farm payroll jobs. But it is important to note that this is an accounting measure. There are many other measures that show that women are still outnumbered by men, specifically in farm jobs or those that would not be covered by this. In fact, a lot of the female gains in payrolls were in the public space, so that in the private sector, it's still mostly men that are dominating. And it's also important to note that this doesn't control for wages as well. So the pay gap between those that are female working in the same office as a male, that hasn't necessarily been closed, but this is definitely one step hopefully in the right direction.
Akiko, it sounds like we still have a long ways to go, to say the
Yeah,
least.
certainly a long ways to go. I mean, usually when I say women outnumbering men, that's not a bad thing, right? But if you look at the actual demand and what the jobs are in the market, education, healthcare, one of the areas where predominantly women, that's where the jobs are. So, on the one hand, it's a positive that women are making up a bigger part of the workforce, but at the same time, women are still predominantly in a lot of these sectors that have been dominated by women before, and that shows that there hasn't been as much change as we'd like.
All right, Akiko and Brian, thanks so much for joining the show today. Let's take one more look quickly at the markets before we let you go. All three of the major indexes are now in the red. We have the Dow, the S&P, and the NASDAQ moving lower. Keep it right here on Yahoo Finance. We have Trump trade advisor Peter Navarro. He's speaking to the final round at 4 p.m. Eastern Time. Stay tuned.
I'm Jen Rogers in New York, and this is the final round. Stocks wavering a bit, but we are right near all-time highs. The jobs report comes out, disappoints.
Miles Upland, this as the economy created 145,000 jobs to finish 2019. Wage growth rising just 2.9% over the prior year. We'll have more on all of that in the market action coming up in just a bit.
Plus, some new messages show that Boeing employees mock the FAA and even the clowns who designed the troubled 737 MAX. We have the latest as the fallout deepens, and Grubhub shares sliding as the company says it's not looking to sell itself. Why this story is just beginning. Plus, we talk all about the jobs report, what's next for trade with White House trade advisor Peter Navarro. And with us now, Yahoo Finance's editor-at-large, Brian Sozzi, to talk about all of today's market action. Let's check out the numbers to go. Under an hour of trading left. It's been an interesting day on Wall Street. For a hot second, we were above 29,000.
It counts. We're counting it.
I am totally counting it. We were there. Now the Dow has turned negative, briefly topping 29,000 for the first time ever. Boeing, among the worst performers in the index, shares pulling back following the release of controversial employee emails. We're going to have more on that coming up. But let's start with the jobs report for December, the last of the decade. I think that's kind of the last time I'm going to get to say that. What other, backward-looking data am I going to get to talk about?
I mean, we have retail sales next week.
True.
The first look at first
Hey, Schiller-Holman?
fourth quarter GDP. I was thinking about this yesterday. I was like, is it the first of this or the last of the last?
It's the last of the last.
But it's also in 2020.
Yeah, but it's looking back at
Doesn't
jobs.
matter.
I think it does. What do you think, Sozzi? Last of the decade or first of the new decade?
Last of the decade.
Last of the decade.
Okay, good.
It wraps
Okay,
up.
just-
Wraps up the 2019 and 2010 story.
So we're going out with a whimper, but it's
Yes.
okay because it's still growth.
Yes, sure. There you go. I mean, I think we'll get into this with Chris Gruppy in just a few minutes on what this means for the economy and the Fed and all that. But as we discussed this morning, I think because the November jobs report, as you can see on this chart, it sticks out like a sore thumb how big that number was, even with the slight reduction down. Very obviously, in the second half of 2019, you can see the pace of hiring slowing. And I think today's jobs report is instructive for looking back at all of 2019, right? I mean, we knew the economy was going to slow down. We knew the pace of hiring would eventually slow down considerably. And I think, 2.1 million jobs added last year, not a bad number, but certainly Sozzi indicates, at least to me, an economy that's entered a new phase of this expansion. Still an expansionary phase, but we are no longer looking at, 3 and change in terms of the number of millions of jobs added.
And I think this market wanted to see something around 200,000. This market has been sent up very aggressively on the notion that we will see job acceleration. And I looked through this report, specifically the wage growth numbers.
Yeah.
I got big, fat 0 cents that we're going to see an economic acceleration in the first quarter. And I think this market wanted this. That's why we saw the market melt up in December.
You can't have your job and get paid a lot for it too, Sozzi. You just have your job and have some growth, and you want too much.
I do.
And so does this
No, wait, the market wants too
No,
much.
I think the market actually took this fine. I mean, this wasn't going to do anything. I mean, we really didn't see any Treasury reaction, which has been driving equity trading,
Didn't really see any
nothing in the
market
dollar. I mean, it doesn't seem one way or another that the market was going to react to this because the Fed's on pause.
My one quick read is here. If you cut rates, as the Fed did last year 3 times, where's the acceleration in wage growth? Why are we not seeing faster jobs growth? And I think the market is a little disappointed that they did not see those things.
Well, but I mean, on the other side of that, and obviously the market is not imputing this today because it's down, but wouldn't the Fed thus be incentivized to further cut rates if what they wanted to see was wage acceleration? In theory, right? Yeah, but I mean, I think the Fed is very comfortable sort of with where we're at right now. And so I think that's what we're mostly picking up from today's market action. Well, for more of today's market action, though, let's go to Inez Ferre. She is live on the floor of the New York Stock Exchange. Inez.
And Miles, the Dow is down about 98 points. You guys were just mentioning earlier this morning, it had just briefly crossed the 29,000 mark. Boeing is one of the Dow laggards today, down more than 1% after the company released those internal messages from Boeing employees regarding the 737 MAX jet, some of them casting doubt on the design of that jet. And also I want to mention Spirit AeroSystems, Boeing's biggest supplier, says that it will be laying off some 2,800 workers in Kansas. That's more than 15% of its workforce because of the MAX production halt and also the uncertainty about when the MAX will return to service. And then I just want to mention Eli Lilly announcing today that it will be acquiring the biopharma skin condition company called Dermira for $1.1 billion or $18.75 a share. Back in October, Dermira was trading at around $5 a share, almost $6 a share. It has been on a tear lately. In December, it got an FDA fast track for one of its therapies. Jen, Miles.
All right, Nez Frey, live on the floor of the New York Stock Exchange.
Now it is time to talk retail. Let's start with Grubhub. The food delivery company is denying reports that it is exploring a potential sale, saying in a statement that there is unequivocally no process in place to sell the company. There are currently no plans to do so. Shares fell as much as 7% today on the news, of course, spiking earlier this week on reports that, yeah, we are for sale. Come and rescue us from declining growth and trouble with profitability. What do we make of this? What's going to happen to Grubhub?
Well, I did talk to one source, I would say, that is in the know. And this notion, this report we saw this morning that Walmart would come out there and make a bid for Grubhub is it's absolutely ridiculous. And there's no talks from what I have learned regarding Walmart and Grubhub. So let's just shoot that down. You have to consider the source, Britton Ladd, longtime grocery executive. He's pretty much an advisor right now. So let's take that with a grain of salt. But I think the model here for Grubhub is under severe pressure. They came out with an initial 2020 profit outlook of $100 million. That was almost $90 million below consensus estimates. And I talked to a lot of people, and they seem to think that might not even be hit. There's a lot of pressure out there. They're essentially giving away their food for nothing.
Well, the thing with Grubhub is they have had a pretty decent business for a number of years. They were the first player in the space. And as the company said in that very long memo they published back earlier this, or I guess it was what, the mid-fourth quarter, around there? Right?
October, I think.
November, yeah. They said, look, we've always been profitable. And now they're under pressure because you've seen the entry of Uber Eats and Grubhub, or DoorDash, excuse me. You now see JP Morgan Chase is giving away DoorDash fees with the Sapphire card, which I guess that's now an incentive for some of these major card players. And you know, it's funny, Dara Khosrowshahi, CEO of Uber, basically outlined where this market is headed, which is that of the names you see here, this is the Grubhub family, but if this were to be DoorDash and Postmates,
Caviar,
and Uber Eats and Caviar, right? All those names, it would just be what markets are the top two, right? And then everyone else is going to abandon those markets. And I think that while it was framed by Dara on the Uber call as a food delivery issue, really this is the kind of thing that we see play out across the economy. It's just now headed for food delivery, right? There's really, duopolies are sort of where we settle out in general.
I kind of think this is one of the most important stories of the week. It's more fallout from WeWork. It's trying to figure out what is happening in this quote unquote new economy of things that we thought, okay, Grubhub, they went out there, they had all this market share, it was going to be great. But then you get pressure coming, everybody's giving away the store.
Yeah.
And that's not going to work for that long. We're going to have a reckoning in some of these areas. And I love all of those companies. Right. And I love all of the, $10 off on your first delivery. But the cost of getting new customers is just way too high. It does not work. They've got to come together.
Am I allowed to plug my non-Yahoo newsletter here? You wrote about this, right? I mean, these companies are tech adjacent. They use technology, but they're not tech companies, right? And so I think the theme for the 2020s is going to be, we talk about it in just a second, Casper's S1, right? I guess they're a tech company. They sell mattresses, right? Yeah. These companies deliver food. And to your point, Jen, they're funded by tech investors who are expecting platform economics and tech multiples. And guess what? They just do stuff. You know?
After the warning they put out late last year where the stock, I think, fell 43% in one single day, they would be doing investors a disservice if they're not considering a deal. Because when you see that type of market reaction and then that type of warning, it tells you something fundamentally is wrong with this company's business model. What needs to happen? They need to probably be owned by a restaurant chain or a retailer that those profitable areas of the business would subsidize the
Grubhub
delivery.
is going to buy
No, they would be part of a restaurant company.
Yeah, okay. Talk about tech adjacent Casper. According to SEC documents, the company filed its S-1, officially planning to go public. Do we have the appetite for a mattress company right now?
I have to dig into the S1, full and fair disclosure. But from what I've learned, Casper are very aggressive. They've carved a good name out. They're working closely with Target. I think Target has been very happy what Casper has done in its stores. And it's a simple model to understand. They sell mattresses in a box.
You open them up,
and you get a mattress.
They get bigger.
I have so many tabs open. I found it.
Okay, you got the S1.
I mean,
what was your
the sleep
big takeaway
economy?
here?
The sleep economy.
I love it.
Putting in a very significant graphic right at the top of their filing, the TAM for sleep. Apparently, globally, it's $432 billion. I mean, I think everyone right now on Twitter is having some fun making fun of Casper. One, because their ads for their mattresses have been so ubiquitous. And two, because again, this is using all the language of a tech company, of what Google or Amazon may have did frame themselves as in their S1s 20, 25 years ago. But these guys sell mattresses. That's fine. It seems like it's a okay business. It's a loss-making business at this point for Casper in a big way. But you know, they've got the graphics in here. They're currently serving $67 billion worth of the sleep economy. They think they have a $365 billion future addressable opportunity. They're including medical devices, sleep tech, sleep services, sleep for travel, sleep for pets. Ambience optimization is a part of the Casper thesis here. This stuff's all fine and well, right? We go to a bed and bath, you have a lot of these products, but like, it is kind of a let's get a grip moment. Like, they sell mattresses direct to consumers instead of the way Mattress Firm does it. That's the business.
With no recurring revenue. So this is unlike the Peloton IPO.
I mean, I read the S1 and I was waiting for the point at which they said, we expect to charge customers a per night
Don't
fee.
you think that's the ambiance part? They're going to deliver like a very quiet, a white noise environment eventually, and they'll sleep track you, and then they'll charge you $12.99 a month?
I'm being sleep tracked.
Oh, that's right.
I already have an alarm clock that gets brighter as the morning goes on. These
What
things
more do you
exist.
need?
No, I'm just saying, like, these products all exist. It's just not called the sleep economy. It's called the crap I have in my bedroom.
I want to know what the ratio is between how much you spend on advertising and then how long your stock lasts and how well you do in your IPO. Think about like your Blue
They say
Aprons.
every dollar of advertising has led to $3 of revenue.
Can I just say, it is very cool to pull a mattress out of a box.
Have you done it though?
No, I want to do it.
I saw somebody do it.
I want to do it. Like, it looks really cool.
Hey,
I did
do
sleep
it. You
on
can
one, it
send
was
it back after
fine.
90 nights or whatever.
Right.
Very profitable.
It's at least 30
I don't
nights.
know.
Profitable business model.
Good fun. I wish we could talk about Casper all day, but we can't.
Weren't they in our IPO bracket? Sorry to interrupt you. They were. I don't think they went far. But they were, weren't they?
They should have been.
Anyhow,
right?
go on.
When did we do that? We do that around the tournament?
Yeah, March. I got to look it
March?
up.
Who's still private that we can even do this year? I guess it's going to be Airbnb, right?
Yeah.
That's it? All right.
Airbnb. SpaceX. And you can't go.
And we do this every year, SpaceX. All right, coming up here in the final round, we'll dig in deeper in today's jobs report with Chris Rupke. Another bad month for manufacturing. Is it more of a supply problem than a demand problem? We'll discuss. But first, take a look at where European markets close on this Friday.
Wasn't Casper in the consumer part?
labor market just finished off its softest year for hiring since 2011. So is this a sign of further weakness to come in the year ahead? Chris Repke is the chief financial economist at MUFG, and he joins us now to discuss. So I guess let's start with your thoughts on today's jobs report. I don't know. For me, I guess it's disappointing, but it's mostly in line with expectations. And we all knew that the November report was a little bit too good to be true.
Did we?
I think
yeah,
so.
266. I guess it was a little over the top. But I think usually when it's that high, you would think it would come down to 200. I was shocked that most economists, the consensus came down to 160. I'm not sure why it did that, but it ended up being correct. And yeah, 145 is kind of a soft spot, a low point. I think the problem really, and don't forget, out of 145, 41,000 was retail jobs. Well, that's not going to happen again, right? That's kind of, a lot of times this happens from Thanksgiving through the holiday season. The jobs with retail don't get adjusted properly, and it comes back down to earth in a hurry. So the number was probably more like 100 or maybe even 90 today if you think construction jobs aren't going to go up 20,000. So yeah, it was a bit of a soft spot for the end of the year. And it chimes in with some of this other economic data. I mean, don't forget we had weekly jobless claims have been elevated for 4 or 5 weeks. They came back down this week, but the number of people on the unemployment rolls is still kind of high. So we're kind of scratching our heads and wondering, is manufacturing weakness somehow starting or going to spread to the broader economy in the first quarter, which I'm a little bit more nervous about than I would ordinarily be.
So what's making you more nervous about that? Something that we were just talking about was the wage growth part of this. Is that a concern at all?
No, my wages are fine.
Oh, lucky you. You're the second guest in 2 days to tell us they're doing fine.
We're right in review season for
Congratulations.
Wall Street. No, I mean, the wage data, the problem with the wage data, it gets inflamed by politicians down in Washington, like much of life. And I mean, it did come off. Like, we have this measure of wages, not the one that gets reported, but there's working people, non-supervisory employees, like working people, not the rich bosses. And that wage number came down because it was 3.6% year over year in October. Now it's 3.0. So that's a little bit odd. But this whole series, it's a little bit hokey. Where was it going to go? You know, it's 3.0 now. In the prior cycles, before the last 2 recessions, it got to 4.2%. So we weren't that far. I mean, it's not going to go that much faster, right? So I don't know what we're waiting for. A lot of time people will say, oh, yeah, but wages aren't so good. But they weren't going to go that much faster, no way, no how anyway.
What's likelier to you, Chris, a sub 100,000 payroll print next month or something around 175?
I'm a little worried about a problem with the jobs number next month, simply because the unemployment claims data, the total number of people receiving benefits is kind of shot up. I mean, it's probably a bad seasonal factor, but yeah, I'm a little bit concerned about that. I mean, don't forget, there is still a manufacturing recession. Production itself bounced back in November from the GM strike in September, October. But still, there's something not quite right with manufacturing, and that ISM manufacturing number is still falling. I mean, that was a bit bizarre. So, yeah, I mean, we should still be watching fairly closely what's going on here. And it's ironic because the trade, you know, the signing or the expected signing of the Phase 1 China trade agreement, that's kind of taken a lot of risk off the table for the economy. They stopped escalating, the U.S. side stopped escalating tariffs. That's good for growth, but yet there's something not quite right. I don't know, is it Boeing or is it the car sales or I think one of the problems, cars, many areas of the economy can't do any better. Right? It's a 10-year, 11-year expansion.
Well, and so on that point, I mean, we have so many folks come through, and usually, you know, the fund manager types, not the economist types, who say, well, consumer's fine, so everything's great, stocks are going up forever. It sounds like you're a little more concerned about that signal we've gotten from manufacturing and not doing the classic thing, which people say, well, it's 15% of the economy, it doesn't really matter. If there's a sickness there, I'm getting the sense that you're more concerned about what that could mean more broadly, rather than just saying, don't worry, the consumer is still
Well, we have the famous example of Bernanke saying before the last recession it was contained to housing, which was a small part, but it brought down the whole house of cards for the entire economy. Manufacturing, it's still very important because a lot of these economic indicators are based on manufacturing data. So even though manufacturing jobs are like 8.5% of total jobs in the country, was 13% 20 years ago, it's a smaller share now, it's still 8.5%, and they're hurting right now. And if you wonder if that's going to bleed in and hurt the rest of the economy. I sound like a dismal economist here. I'm trying to be
really
upbeat. I don't want to talk down the stock market. All my money, every last dollar is in there.
And your note
for nothing.
Your note was pretty positive. Can you help us do our job here a little bit? At the 4 o'clock hour, we're going to have Peter Navarro on, advisor to the president.
I saw that. Very interesting.
So what would you think that we should be asking him? What should we be asking the administration on a job site?
I would tread very lightly there. Yeah.
I
would tell you what. I would tell
area.
you what. Yeah. I mean, thin-skinned. My first boss was Kudlow, actually, at the National Economic Council. So we talk every day. No, of course not. I'm not allowed to talk to anyone like that. But anyway, yeah, I would be, the markets want to hear, sort of, they shouldn't, I hope they don't, they want to hear about phase 2, phase 3. So it's unfortunate that, I believe the president was saying that, I don't know how true it's going to be, phase 2, we're going to take a look at that very, very quickly here after the signing of phase 1. I mean, for the markets, I think they know there's intellectual property problems, but they don't want to hear any more about China, U.S. It would be nice not to hear anything about it again until after the election. So, yeah, I would ask him, what is the prospect for phase 2? Are you going to be looking into that shortly, or? The market doesn't think the prospects of any phase 2 agreement is very high. Let's put it that way.
Probably say we're looking at many things.
Well, you can find out at 4 o'clock.
Yeah,
there you go.
I'll be
All right.
watching, yeah.
Chris Repke with MUFG, Chief Financial Economist. Always fun to have you on. Thanks for stopping by. Talk to you soon.
Coming up, are you retirement ready? Why you're probably not retiring at age 65. That's next. Right now, take a look at financial names trading in the last hour. Now it's time for our retirement segment brought to you by Fidelity Investments. 65 is the traditional age of retirement, but is that realistic. According to the Transamerica Center for Retirement Studies, 54% of workers now expect to retire after 65 or not at all. Joining us now to discuss is co-founder of East Paces Group, Alex Reffitt. So is this what you're hearing from your clients? Like, should we expect that these are the studies being done now, but as more boomers get closer and we all get closer and closer to 65, that this is going to go up even higher in terms of people continuing to work?
Yeah, well, first of all, thank you for having me. But yeah, as life expectancies continue to increase, it's natural that you're going to have to plan for more years that you're not going to be working if you're going to still retire at 65. So even the latest Secure Act is looking to bump out Social Security ages to 72 now, or RMD amounts to 72. So we've got to really plan for the reality that people are living a lot longer, regardless of the health in those years.
Well, and Alex, thinking about who's most prepared for this reality of how long we're going to have to work, did you find that it's really folks who are 50 to 60 who thought they might be close to retiring that are least prepared for this new reality? Because certainly folks in their 30s, we went to college during the recession. Everything was terrible. I can't believe I have a job, and maybe you're in the same boat. So I figure I'll just work till I die. But maybe my parents are facing a new reality as they approach that point in life.
You're right in that. I mean, we're not built by nature to sacrifice short-term desires for long-term goals. That's not the DNA of humans. So it can be a very difficult task to save early on and have enough by the time you're 40, 50, 60 approaching retirement. So yeah, naturally people are a little bit behind because you really have to understand the complexity of paying for 25 years post-retirement without any sort of income other than your own savings. You really have to understand those liabilities early on to be able to really be motivated to plan and save for them. Obviously, 401ks and companies encouraging employees to have an involvement with those throughout the decades that they're employed by them is obviously a huge step in the right direction. But people relying on Social Security to be the only supplement for their lifestyle once they turn 62 to 70 is it's going to be a harsh reality.
Now, Alex, first week of a new year, obviously a time that a lot of people take a look at their retirement plan. What's the one most important thing that folks maybe can do this time of year to set themselves up for the next year and maybe for the next decade as well?
Sure. The most important thing at phase one for anyone, regardless of where they're at, is to clarify their vision, to really understand where they're trying to go. If it is retiring at 65 and kind of maintaining that lifestyle that they've built, it's understanding specifically what that's going to take and kind of getting your house in order, understanding how many years you got left, how much you're making, how much you need to plan on spending, what your mortgage and all your daily expenditures are going to cost, and really building a roadmap to make sure that you're on track. If you don't clarify the goals of what you're trying to accomplish, it's going to be really hard to take the more complex steps then and actually building a strategy to get there. So the first step I'd recommend to anyone, whether they're further along down the road and just want to get an update or starting from scratch, is to really clarify their objectives and their vision for what they're ultimately trying to accomplish.
Good New Year's resolution. Everyone can get started. Alex Reffitt is principal and co-founder of the East Paces Group. Have a great weekend.
Thank you.
All right, coming up here, we'll have more on the final round. Plus, new emails show Boeing employees mocking the FAA and even the, quote, clowns who designed the 737 MAX. More unbelievable stuff from this Boeing investigation. We have the latest coming up right after this break. Welcome back to the final round here in Yahoo Finance. Miles with you in New York. Joining me, as always, is my co-host Jen Rogers, also joined today by Yahoo Finance editor-at-large Brian Sazi. He of the red Apple Watch strap today.
Oh, right.
Like to see that.
I need to change mine every now and then.
Mixing things up. All right, we've got 28 minutes to go in the session. Red board right now. We did have Dow 29,000 very briefly earlier today. We're going to finish well off highs of the session after we hit records on all three majors yesterday. A little bit of a reversal into the weekend. For more on today's market action, let's go to Inez Ferre. She is live on the floor of the New York Stock Exchange. Inez.
Miles, yeah, we haven't been able to hit that 29,000 since this morning. We are in the red with the Dow off by 125 points. I want to show you what's happening with Uber because Reuters report is saying that Uber will stop operating in Colombia at the end of January. This is after a judge in Colombia says that Uber violated some of its competition rules and had to cease operating. And Reuters is reporting that Uber perhaps is considering taking some legal measures. We're also, today, we've been watching Six Flags, which has been under pressure. This is after the company warned of a possible fourth quarter revenue shortfall. Also talking about some challenges that it's been having with park developments in China, citing the decline of the real estate market in China, and also saying that its China partner has defaulted on its payments to Six Flags. So today, Six Flags has been under pressure. Miles, Jen.
All right, Inez Ferre live on the floor of the New York Stock Exchange. We'll talk to you after the closing bell.
Newly publicized documents are causing yet another headache for Boeing. The documents were submitted by the jet maker to Congress and reveal messages between Boeing employees who worked on certification of the 737 MAX that was involved in 2 fatal crashes. Yahoo Finance's Alexis Keenan joins us now with the latest. I mean, just reading these, it makes you nauseous. It's sickening. I mean, what are all these documents? What's in here? What are the headlines out of it?
Okay, so these documents, they were released to Congress. That's why we have them. They were previously released to the FAA in December. So the FAA has known about this, as I believe the DOJ has as well. So the bulk of them deal with both the certification of the plane itself, of the 737 MAX, as well as the certification for the simulators. And those simulators are those physical, actual, simulation contraptions for the pilots, so they can so they can really experience what it's like to fly this plane. Now, it was Boeing's prerogative, as we can see through these emails and messages, text messages, to make sure that the FAA did not require these simulators. Why? They're terribly expensive. In Southwest's contract for the plane, they're the largest U.S. purchaser of the MAX. They actually had a rebate, a $1 million rebate per plane that they would get if the FAA did require this type of training. So a big deal, a big selling point for the aircraft is that it would not be required. The other thing that Boeing was trying to do during this time frame, and these are messages that range from 2013 to 2018. The first MAX was delivered to its first customer in May of 2017. So it's in the middle of this, kind of at the end of this time period. So they also needed to get the FAA to approve the simulator itself. So 2 different things. Boeing would like to have to do as little work as possible in this regard. And the only way to really get a glimpse of what goes on behind the scenes is for me to read through some of these emails. And this is just a tiny little fraction. So here we go. In 2018, February, a Boeing employee asked a colleague, and this is after that first MAX was delivered, this one, would you put your family on a MAX simulator-trained aircraft? I wouldn't, and the colleague responded, no. In 2017, in April, another exchange between employees said about the MAX, this airplane is designed by clowns who in turn are supervised by monkeys. In 2017, in March, Boeing's then chief technical pilot said in an email, I want to stress the importance of holding firm that there will not be any type of simulator training required to transition from the NG to the MAX. The NG is the predecessor plane to the MAX aircraft. So a lot of effort there to try to get this simulator both approved, but also not required by the FAA.
I mean, this was a part of the story a little while ago. We haven't talked about quite as much, but really this plane shouldn't have been called a 737. And the reason that Boeing wanted it to be is because then they could say, oh, well, you just, read the iPad update and it's fine.
That's right. A computer-based training is what they reference often in these messages. That's what they wanted. In response, Boeing is saying that, look, these communications were early on in the efforts by Boeing to get that simulator approved. They said since that time, both internal and external subject matter experts have repeatedly tested and qualified the simulators at issue. They say we regret the content of these communications and apologize to the FAA, Congress, our airline customers, and to the flying public for them. So just a lot to digest. This is more than 100 pages of documents. If you keep reading on these messages between the employees, they are quite disturbing.
Alexis, I think one of the key messages here might be the cultural issues at Boeing run very, very deep, and it's not just in the C-suite.
Yeah, absolutely. This goes down to employees, and we're having a difficult time understanding exactly who these employees are. We know that the chief technical pilot is referenced here, but the names are redacted, and so we don't know how low down the chain it goes. But for the most part, these are the folks who are trying to get the simulator approved. Just really troubling. And I would imagine that there are some concerns for the folks who wrote these messages. They still have to ensure that they're protected against any criminal liability. The DOJ is still investigating.
And this now coming, reports today that Spirit is going to lay off, Spirit Aerosystems, one of Boeing's major suppliers, going to lay off about 20% of their workforce. And we've long speculated on what the knock-on effects kind of down the supply chain could be.
This is a big one.
Now we're starting to get a sense of how permanent the Boeing adjacent companies, the companies in that sphere of influence, believe the MAX delays could be. And some suggestions, Bank of America out with a note today saying that, their conference call they had with pilots suggests that whatever the date is for the planes getting back in the air, 60 days from then, 60 days from the approval by the FAA, they would expect revenue flights. So the timeline keeps going out and out.
It's far into the future, and now we have Boeing this week saying that they are recommending simulator training, making a total 180 on this issue. And if that's the case, look, I've talked to Southwest today. They said that they have 3 simulators that are in the process of being installed, but they're not even approved yet by the FAA. They expect another 3 to come online in 2020. And the time that it takes for the pilots to be taken out of service for flying these aircraft to do this training is a huge, just mega portion of time that costs these airlines a ton of money. And as to Spirit, Boeing they make 70% of the fuselage for the MAX. It's 50% of Spirit's annual revenue. Their stock is getting hit really hard today. They have layoffs coming now January 22nd in their Wichita facility. And they also said that later this month, they're going to bring layoffs to their other facilities. They have 2 others in the United States that manufacture these parts for Boeing.
Resulting in a lot of red on the street as well.
Rupke's onto something here.
Yeah, he was saying Boeing. Americans down some 2% on the Dow. The biggest decliner of the day is Boeing. It's just near the lows that it's hit today. It's off nearly 2%. Alexis Keenan, have a good weekend.
You too. Thanks.
All right, and coming up, we'll check on the pulse of Main Street in America's South and Midwest with the CEO of Casey's General Stores. We'll talk about what they're seeing with their customers. But first, let's take a look at some of the big retail names right now, 20 minutes to go in today's session. Casey's General Store rang the opening bell at the NASDAQ this morning, reporting strong earnings, double-digit growth since last October, their most recent earnings back in December. Joining us now is Darren Rebel. He is the president and CEO of Casey's. Darren, good to talk to you again. Last time we talked, you were president over at IHOP, now moving over to the Casey's business. So give us an update on kind of where that business is at right now, what you guys are seeing with your consumers. Obviously, your store base mostly in the Midwest, so a different view on the economy right now than I think what we're getting here in financial markets.
Yeah, well, sure, Miles. Thanks for having me. And let me first tell you a little bit about Casey's itself. We're probably the largest retailer that most people have never heard of. We're a Fortune 500 company. We're the the fourth largest convenience store chain in the U.S. And what most people will be surprised to learn is that we're the fifth largest pizza chain in the U.S. as well. And we operate nearly 2,200 stores in 16 states, and we're on a great streak right now. With respect to the earnings, we did report 23% earnings per share growth in the most recent quarter, and that was our sixth consecutive quarter of 20% plus earnings per share growth.
So when you think about growing, who's your biggest competition? Is it like a 7-Eleven, or is it more an Amazon coming in and opening up different stores? They have their ghost stores around, everybody. Who is it that could kind of hem you in a little bit?
Yeah, well, we're actually in a very unique position in that we operate in rural and smaller cities throughout the Midwest, and we could do that anywhere in the U.S., frankly. But because we're in those smaller and rural communities, our competitive set is a little bit different than what you might see around here in New York. And so we do have some pretty sophisticated competitors on a local basis, but nobody that really kind of spans our entire geography. And with respect to an Amazon or something like that, we've seen a couple of them around here, but not in our areas right now.
You're fresh off an investor day yesterday, and I think the mood is you're looking for at least 8 to 10% EBITDA growth over the next couple of years.
Right.
Key to that is prepared foods. What are you doing to reinvent the prepared foods aisle? Very high margin for you guys.
Yeah, well, first I'd say we're famous in the Midwest for our pizza. And we have kitchens in virtually all of our stores, and we make the pizza from scratch every day. We have people that come in, they mix the dough, they roll it out, decorate it any way you want it, and we use 100% whole milk mozzarella cheese. And so the product is fantastic. And if you ask anybody in the Midwest that's familiar with Casey's, they just love our pizza. But specifically what we're going to do, we're actually evolving our food offering to be more like a restaurant style. So not so much the look and feel, but in terms of the process behind it, with adding a culinary team and really bring some restaurant experience. We just hired a new chief merchandising officer who has a restaurant background as well. I, of course, have some restaurant experience, and we're bringing more of that expertise to the company and really elevating that experience.
And now, you guys are more of a destination than a delivery portal, but certainly there's a lot of buzz right now about what some of these delivery players want to do. Where is Casey's at in that part of it? Is that something that you guys are doing, something you want to invest in, or are you just going to kind of see where delivery goes and figure out how you want to play that?
Well, we're tackling that from a couple different perspectives. We have 800 of our stores that have our own delivery service today. And so we are delivering a pretty significant breadth. But we're also talking to DoorDash right now about a pilot. We don't have a lot of coverage in our footprint because we operate in some of these rural and small towns. So we're going to see how it works with third-party deliveries. I obviously have some experience with that previously, so we'll see how that goes. But what we did recently do is stand up our e-commerce capability. So we can order pizza online, and it can be ready at the store for delivery or for carryout.
And go ahead.
What's your stance on cigarettes? Cigarettes are about 23% of your business.
That's right.
What's your stance on it looking out going forward? We've seen pharmacy chains pull cigarettes out of their stores, but I imagine it's very important to your customer base. Where do you stand?
Yeah, we're in a pretty good position from that perspective. We are 23% of our mix is cigarettes. That's significantly less than the industry overall, and that's a result of our food service mix. So the way we combat the decline in cigarettes, and that's been a secular decline for 50 years. The way we combat that is by focusing on our food platform and our dispensed beverages and our overall inside sales, and that mix will continue to drop over time as we.
Do you imagine pulling cigarettes out of the stores?
Not in the near term, but you never know. But really what we're in the business of is trying to provide those products for the guests that want them. And there's plenty of people that still want that product, and we'll sell that product responsibly.
I just want to ask quickly about the rewards program that you guys are rolling out. Certainly, everyone wants to be Starbucks. I mean, I think that's kind of a far off for any food service company because they're most of mobile payments. But when you guys look at the rewards space, what are you seeing just in the initial rollout, and what do you kind of envision that program going?
Yeah, well, glad you brought that up. We just officially launched our rewards program this week, and it's really unique. I think there's a couple elements that are comparable to others where you earn points based on purchases, and you can convert those into cents off per gallon of gasoline if you want to do that. You can take that and convert it to cash and get discounts inside the store. But unique to us is that we also have a platform called Cash for Classrooms, where it allows our guests to earn points, convert that to cash, and donate it to a local school in their community. And Casey's, because we've been in these towns for a long, long time, we really play a special role in the communities that we serve. And this was an opportunity for us to allow our guests to engage and give back to their local communities as well. So we think it's a great platform, very early stages, but any day now we should cross over the 1 million member mark.
In 3 days, 3 or 4 days?
Well, we had a soft launch in December, but yeah, in the first week.
Wow.
So we're getting some nice traction with it, and more to come.
All right, great. Hope to talk to you soon. Darren Rebelez is the CEO of Casey's General Store. Appreciate the time.
Thank you.
Coming up, we've got the closing bell on Wall Street just about 10 minutes away. First, though, we're going to grade the week that was for Trump. We've got your Trumpometer score coming up. Plus, stick around. We're going to be talking with White House advisor Peter Navarro about that jobs report and trade. We are back right after this.
Bing, bing, bong, bong.
Let's get to This Week in Trumponomics. As our viewers know, we usually do this on Thursday, but we had December's jobs numbers come out this morning, so today's your lucky day. You're going to get it now. While U.S. employers have added jobs for a decade, there was one aspect of this report that has Rick Newman diving in and really...
With raised brow.
Well, are you raising your eyebrows?
Some economists are verklempt.
Are you?
I have to say.
Really?
Oh, yeah.
So what's the issue?
It's a big deal in economist land.
It's wages. We've been talking about this today, and I think this deserves more attention maybe going forward. So the wage number today was 2.9% year-over-year growth in average hourly earnings, known as AHE. That's declining. So we had the peak here was 3.4% year-over-year growth in February. And if we look at the chart, there's the chart. Just look at the top of the peak, and then you can see the last 9 months. It's drifting down a little bit. What is going on there? I mean, economists have been perplexed for some time why we haven't seen stronger wage growth and go along with that stronger inflation. I mean, I think this could be, from an economist perspective, sort of the biggest puzzle of the economic outlook today. So the question is this, does that little tip over in earnings, the slowing growth, does that tell us we're at a deceleration here that's going to be prolonged, or is it some kind of anomaly? Not really sure, but it's an issue. And 145,000 is a good number, not a great number.
All right, so what does the Trumpometer think of
Well,
this
last
issue?
week it was weak, and we'll see if we improve upon that with 2.9% year-over-year wage growth. The suspense. It's intense,
Can't handle it.
Oh, mediocre.
Ticked up by one.
Mediocre.
I mean, I think, 2.9% wage growth annually is, mediocre. That's the epitome of mediocre. We've got inflation.
And no attacks on foreign actors this week. So we move up
That's
to
right.
mediocre.
No foreign hostilities this week, as far as we know. I think that could change in a second. There could be a surprise around the corner any minute. But 2.9, let's call it 3% wage growth. Inflation is 2%, so you're only 1% ahead of inflation on average. And the Brookings Institution has some new research out. They found that 44% of all workers in the United States, they categorize as low-wage workers, and the average hourly pay for those workers is only about $10.20 per hour. And those are not teenagers. Most of those are people who are in the prime age working bracket of 25 to 54. So it is possible that while unemployment is really low and we have a lot of jobs in the country, they're just mostly low-paying jobs.
Another reason why the Fed wants to stay easy.
Yeah, it's a bit of a puzzle, though. I mean, the Fed hasn't figured it out either.
Well, it's almost as if those wages haven't been mandated to go higher.
They haven't.
Maybe they will.
Puzzle solved.
Oh, unintended consequences bloom. Brian Sazi, have a good weekend.
Thanks,
You're
y'all.
going to be busy on Monday, right?
Gonna be busy 2 weeks.
Well, we're busy over the weekend, right? Isn't this NRF thing over the weekend?
It starts on Sunday and kicks off officially on Monday.
All right. Well, on Monday, be sure to check out Brian's all-day coverage from the National Retail Federation's big show over at the Javits Center. He will exclusively interview Microsoft CEO Satya Nadella. You can catch that right here on Yahoo Finance. And coming up today, we will have the closing bell about 4 minutes from now. Plus, White House advisor Peter Navarro will join us to discuss today's jobs report and what's next for trade as a phase 2 deal set to happen anytime soon. We are back with that conversation right after this.
Welcome back to the Final Round on Yahoo Finance. I'm Jen Rogers with my co-host Miles Udland, and we are joined by Emily McCormick and once again Rick Newman. We are just about 90 seconds away from the closing bell, so let's get our last thoughts here. We hit 29,000, but
now it's failing.
It was just not to be. Yeah, we're weakening up a little bit here. Is this all about jobs?
It's funny because when that jobs report actually first came out, it was pretty muted, the market reaction we had. We had the Dow futures, go flat for a little while, then we saw them bounce back up. Then it was just around noon that we actually saw this reversal in the markets. I think really trying to digest what is being taken as a mixed report, lower than expected job gains for December, lower than expected gains on the average hourly wage side, but that unemployment rate still at a 50-year low.
Looking at real estate and utilities higher here, real estate is almost up 1%. Of course, we cannot ignore what's happening with Boeing. Boeing is the worst decliner on the Dow, and it's been weakening up here, which is leading to some declines there as well. We're off triple digits on the Dow right now. That Boeing story just won't go away.
You wonder if now that they have the new CEO, Dave Calhoun, if he is, which I think he should be doing, is let's get all the bad news out. Let's get it all out there right now. Let's stop trying to cover up and keep stuff from becoming public. And we did see they flopped on this idea that pilots getting trained on the MAX would have to use go through new simulator training. They completely changed their position on that. I think that's the right thing to do. So they have a new CEO, try to take advantage of it by clearing the air and starting over.
Live pictures of the New York Stock Exchange and the NASDAQ market site closing out this week on a little bit of a down note. A jobs day here in America. We are watching live pictures there at the Stock Exchange. 9 of 11 sectors are lower on the day. We've got financials off and industrials both off about 0.8%. Consumer staples, XLP trying to get in the green game here. We had gains in Tyson Foods up almost 3%. Monster Beverage, and Sazi left.
Yeah.
Monster Beverage.
He took his bang with him.
1.8%. He took it with him for the weekend. Well, the December jobs report showed that the U.S. economy added 145,000 jobs, while the jobless rate is holding near a 50-year low of 3.5%. Joining us now in an exclusive interview to discuss the numbers is Peter Navarro, Director of the Office of Trade and Manufacturing Policy. Great to see you, Peter. So today,
great to be here.
We crossed 29,000 earlier today. We did give it up, but we have now breached that level. You've actually predicted the Dow at 32,000 and economic growth in the range of 3% in 2020. What do you think that today's jobs numbers do for your outlook?
So first of all, let me say hi to Rick. I'm getting a campaign flashback. We did some really good work back there during the campaign, and I think every time I said we were going to grow over 2%, you kind of looked at me a little askance. But we implemented flawlessly with our tax cuts, deregulation, cheap energy, and trade policy, and I think it's showing up in the best labor market in the last 50 years. There wasn't anything I didn't like about this particular report today. What I loved about it was confirmation that President Donald J. Trump has turned the Republican Party into the party of the working class, into the party of blue-collar workers. What I love is you've got workers' wages rising faster than managers. You've got people without college degrees wages rising faster than those with bachelors. And you even have African-American wages rising faster than whites, which is just the opposite of what it was during the Biden years. And this is an administration, we're just really committed to creating jobs, one job at a time, particularly for the people who work with their hands. So we're real happy about what those numbers look like today.
Peter, Rick Newman, sorry for the 2016 PTSD flashback. We were talking about this just before you came on. Wage growth actually declining a little bit from higher levels last February. And it was a lower overall jobs number than expected. Some economists are predicting a slowdown in both wage growth and in job growth for 2020. What do you think about that?
It was a great number. Hey, look, it's well within the margin of error. Maybe next month there's a revision upward, whatever. But remember, you only have to hit 70,000 jobs a month in order to maintain the unemployment rate. And the unemployment rate is the lowest it's been since a man walked on the moon. And look, it's also across groups. You got the lowest unemployment rates for blacks, Hispanics, Asians, women, disabled, veterans. It's great, and you know, these are coffee table issues, kitchen table issues. Families feel really more secure. Everybody wants a job, can find a job. Everybody who wants to get a better job or a higher paying job has more opportunities to do so. There's more job openings than there are workers. My favorite thing, Rick, is I don't know if you remember this back in 2016 during the campaign when that study came out that said that 1 out of 4 prime-age workers were out of the workforce. And we put over 2 million of those folks back into the workforce. I just love that.
Peter, I want to ask you about the status of trade right now. We expect there'll be a signing of the Phase 1 deal next week. And then there's been some, I think, lack of clarity or some mixed signals maybe on where Phase 2 goes after that. Do you expect that we would have a Phase 2 deal before the election, after the election? The president suggested perhaps Phase 2 would last past next November, and kind of where we stand on China trade relations.
You folks are insatiable. Look behind me. Wednesday, we're going to sign Phase 1. Let's let the news cycle digest that. Then I'll come back on next week. We'll talk Phase 2. How's that for a deal?
How about Phase 3? Let's just start with that,
Phase
right?
3.
Peter, as you said, we're supposed to be getting that Phase 1 deal signing next Wednesday. Yeah. Heading into 2020, though, what do you now see as the biggest threat to the U.S. economy?
My forecast, to be clear, and just to get my street cred on this, the day after the election, I predicted Dow 25,000. July, I said 30,000 if we got USMCA and we got a cut in interest rates, and we're well on track for that. If I look ahead, I'm just going to give you positive news. I look at what I call the 4 drivers of the GDP equation: consumption, investment, government spending, and net exports. If you look at each one of those, there's very good news in all of them. For the consumer, you've got low unemployment, rising wages, and high optimism. That's going to be the anchor of 2020. Government spending, this is the sleeper in that equation. A couple weeks ago, if you remember, they passed the appropriations bill and the National Defense Authorization Act. That effectively put in a very strong fiscal policy floor for continued growth. We're going to see more investment coming in because of the tariff and trade policies, because people know that this is the place to invest. And we've had 4 straight months now of a declining trade deficit. Our tariffs are working, particularly on China. And when you lower your trade deficit, that shows up as an increase in GDP growth. So, that's, I think 2020 is going to be a very boom year, a bullish year. So let's see what happens.
Just a little bit more on growth for 2020. Do you think that the 4 drivers that you speak of, that we could get growth over 3% in 2020?
Well, if you get a continued improvement in the trade deficit, that would be the most likely place where you could get above that. All I've said is that we're going to be closer to 3 than 2. 2.5 is a very good number. Let's see what happens. You got to remember, again, back to during the campaign, the Congressional Budget Office was projecting growth below 2%. And the unemployment rate was going to be at 5%. So how are we doing?
Director of the Office of Trade and Manufacturing Policy, Peter Navarro. We'll talk with you again. Have a great weekend.
Good to talk to you, Rick, again. It's been too long.
Yeah. All right, for more of today's market action, let's go to Inez Ferre. She is live on the floor of the New York Stock Exchange. Inez.
Miles, the Dow briefly this morning touched the 29,000 level, but then retreated back. So now the Dow's off 50 by 0.5%. The S&P ended down about 0.3%. And if we just take a look at the Dow laggards today, you're looking at Boeing that ended this session off more than 1.5% after Boeing released those internal messages from employees about the 737 MAX. Also, Travelers Companies was one of the Dow laggards. Dow Inc., United Technologies, and JP Morgan Chase as financials today were a bit under pressure. And then if we look at the leaders, Pfizer today was one of the leaders, Coca-Cola, United Health, and Visa. I also want to mention Spirit Aerosystems, the biggest supplier for Boeing, said that it will be laying off some 2,800 workers because the Boeing MAX jet production has been halted and because there's so much uncertainty regarding when the aircraft will go back into service. And then just looking at Uber today, Uber announced that it will stop operating in Colombia at the end of the month after a judge ruled that it had violated some competition rules. And it's a big deal because Uber had been operating in Colombia for the last 6 years, but Uber Eats will continue to operate there. Miles, Jen.
All right, Nez Ferre, have a great weekend. I think you earned this one.
You too. Great weekend, guys.
All right, let's talk a little bit about that conversation with Peter Navarro. Certainly bullish as ever on the state of the U.S. economy. Jen, I think he was very much, he wanted to brag about how right he thinks he's been about all his predictions.
And there's numbers, there are things in this number to brag about still. I mean, it's not, as much as we want to look at the wage growth, you can look at these numbers and take out the fact that we are continuing to grow. This is the longest expansion. We are adding enough jobs right now. People are coming into the labor force that haven't before. This is good. There are also questions in here, which I know but you also gave them a mediocre, you gave President Trump on the Trumpometer a mediocre, which is in the positive.
Yeah, it's third highest, right?
Territory.
Well, it's a good time to be a White House economist. I mean, whether because of Trump policies or not, I mean, the economic numbers have generally been strong for the entirety of the Trump administration. However, we did hear Peter Navarro hedge when you asked him, can you get to 3% or higher than 3% growth? And he did not say yes. He said, well, if we can get there, one of the ways we can do it is through a lower trade deficit. But what's been happening, so they seem to be happy that the trade deficit with China is shrinking, but it's not really shrinking for the right reason. I mean, imports from China are down, but exports to China are also down, and exports actually add to GDP. It's the imports that take away. So we're not really adding much to GDP if that trade gap is narrowing because imports and exports are both down. You want more economic activity overall and not sort of a reorganization of where that economic activity takes place. So he would not say we're going to have 3% growth this year. We're probably not.
Right, and then another point that I would potentially push back on, especially on the point of average hourly earnings, one of the things Navarro had said was about wages for production and non-supervisory workers rising in relation to supervisors, but at the same time, we still did see a deceleration to just a 3% gain. That was down from an October high of 3.6%, so that's another trend that is decelerating that we have to watch closely.
I mean, so the way I think about this, since I'm covering the election, is do Democrats have any room to campaign on what could be better about the economy? And I think it's really a matter of framing. I don't think Democrats are going to get a lot of traction, and they haven't gotten a lot of traction by saying it's a bad economy. It's not. I mean, it's just not going to work. You can't really say Trump's policies have failed because we still have a decently growing economy. But it is also true that a lot of people feel like they're not getting ahead and or falling behind, especially when you bring two things in. The cost of health care, which is rising by way more than incomes, and the cost of education, especially college, also rising by more.
And I think what's interesting, just kind of, not to go like too far afield with the political philosophy of this election, but in an election where it would seem so obvious that Democrats could run against a president who basically stands for everything they don't, the way to run, in my view, is to keep talking about changing the system, right? We're talking about the system of low-wage work, the system of healthcare, because to your point, on the specifics of economically biased issues, it is difficult to poke holes in what Donald Trump has done, other than, he gave a huge tax cut to the rich, fine, but it's not like Bill Clinton didn't take care of the rich too, and Barack Obama didn't take care of the rich too, right? Taking care of the rich is an American tradition, so you still have to find a way, I think, to run systemically rather than against.
Pressures on the working and the middle class. This is really now a long-term trend that transcends presidential administrations.
Yes.
It is a long-term problem, and nobody has come up with a policy that they've implemented to address it.
Rick Newman, have a great weekend.
Thanks, guys. I will.
All right, and coming up here on the final round, why do people move and where are they moving across the country? Bellhop's, one of the fastest growing moving companies in the country, reveals all in their State of Moving study. We are back with that right after this. Here's some stocks that made news during today's session. Let's take a look at shares of NVIDIA, higher after Citi added the chipmaker to its Catalyst watch list, said it expects NVIDIA to outperform its peers. Just not as exciting, Jen, as what it used to be. Remember NVIDIA just went up every day.
Could not be stopped.
It's just a regular stock. AMD, I guess, is now the hot stock that goes up every day.
Or Micron.
Let's take a look at shares. MU, best ticker in the market. Take a look at shares of Amazon. The Journal reporting the e-commerce giant is in talks to sell some of its ad inventory on services other than its own Fire TV platform. Also coming out and taking a shot at Honey. Do you see that story?
No, I didn't
Where,
see that one.
Honey, which was purchased by PayPal, Amazon putting like a little warning on their site saying, Honey is not, or this extension is not secure, blah, 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 blah. So maybe they were in the bidding. Maybe they're upset that they don't own Honey now. Certainly an interesting story there. Let's take a look at shares of Foot Locker wavering today, getting a downgrade over a Susquehanna to neutral from positive. The athletic apparel retailer's holiday sales fell short of expectations. Susquehanna not liking the story there.
You didn't buy enough shoes. We forgot to talk about that story with Sazi. He would have had a good take.
I'm wondering, and we have to talk about Reggie about this.
Yeah.
Maybe it's just me. I feel like 2019 was like peak sneaker.
And we're going down.
I don't know what we're moved on to, but it just feels like.
It's passe if I'm getting into
There was just so much sneaker buzz, right?
Yeah.
Like 9 months ago, and now it's just like, everybody got sneakers.
wearing boots. According to Census Bureau data published in November of last year, Americans are moving at the lowest rate since the government started keeping track. So what can we learn from the people that are actually moving around the U.S. right now? Joining us to discuss is Luke Markland, the CEO of moving company Bellhops. Okay, so for people that are moving, help us figure out the trends here. Where are they going?
Okay, cool. Well, thanks for having me. Very excited to be on the program. We saw two big trends in why people are moving and where they're going. The main reasons that we see people are moving, one is for money, and the other, believe it or not, is for love. And so the monetary reason is much of what most people will expect. We're seeing a pretty macro shift in people moving out of high-cost areas and moving into lower-cost states. So we're seeing people moving out of the states like California, Illinois, New Jersey, moving places further south where the tax burden and the cost of living is much better. States like Arizona, Tennessee, the Carolinas. But the other reason that was very interesting in our survey, and our survey we looked at over 2.3 million data points, was people moving for love. And actually 1 in 5 people who move are moving because they are trying to see if it's going to work out long term with a significant other. And they're taking the leap of faith and moving for love. Believe it or not, we were able to not just see why, but if it was successful. And the good news is that over 60% of the people who do move for love end up sticking it out. So it seems to be a pretty good leap of faith.
Luke, I want to shift gears a little bit because the Census Bureau came out with its most recent study at the end of the year and said fewer than 10% of Americans moved to new places in the 2018 to 2019 year. That's actually the lowest since Census began tracking these relocations in 1947. I'm wondering if that's a trend that you've seen with Bellhops, and if so, if that's impacting the business in any way.
It is definitely a secular trend for our industry that people are moving less, but it's actually one that favors us. And really, we believe there's two broad reasons why. One is people have the ability to kind of work remote, and the revolution of working from home is really become a thing over the last decade or two. But on top of that, moving is just getting doggone expensive. And tax laws change. You can no longer deduct moving from your taxes. And so what was an expense that you could have written off before is now something that you have to put on your taxes. And if you're moving for your corporation or something like that, that is not a freebie anymore. And so there's a lot of incumbents in our industry that were overcharging customers, mainly the van lines, who are seeing their net moves go down year over year. What's great is we're a company that we can move you across the country, we can move you across town, and we do both in a very affordable manner. So we're seeing actually a decrease in share from the van lines, and all that is coming our way.
You know, Luke, top city that people move to, Austin. I thought Austin was played out, but apparently not. Certainly Nashville is in there, but you guys are actually based in Chattanooga, and we hear so much buzz about kind of these secondary cities. Like, I don't even know if Boise qualifies anymore, but, Chattanooga, Asheville maybe is kind of in this bucket. Birmingham is very buzzy these days. What's your feel on that kind of the second wave of migration now that, Nashville and Atlanta and Charlotte and Austin have seen such a big influx over the last 10 or 15 years?
Yeah, I've been someone who's been able to live in quite a few cities over the last couple of years. Nashville was one, Chattanooga is another, and I can tell you, yeah, some of the safe havens for lower costs of living are now getting more and more expensive, and there's now a new tier, and cities like Chattanooga are starting to get bigger on the map, But really, what we see in the data is there's still such a sizable gap in cost of living from cities like Austin and Nashville to the states I mentioned earlier on, cities like San Francisco, LA, Chicago, New York, that while it may not, the growth rates may not be quite as high, they're still going to be very attractive alternatives that offer really great career opportunities and lifestyles.
Are people moving as much stuff these days? We talk a lot about, rent the runway or disposable, quote unquote, furniture from Wayfair or IKEA. We can get mattresses in boxes now. Are you seeing a decline in the amount of stuff that people are taking?
What's interesting is we provide full service moving, but we also will provide labor only services. And what we've seen really accelerate is people not only using our full service move, but doing the labor only before and after. And a lot of those jobs are really kind of the Marie Kondo type experience, where we are helping you organize your life, declutter before the move, or when you show up to your new home and it feels like a bomb went off, we find ourselves being brought back quite a bit to help clear out the clutter and simplify people's lives.
Luke Marklin, thank you so much for joining us, the CEO of Bellhops.
Thanks for having me.
All right, coming up here, we'll have what we're watching next week in the Look Ahead. Plus, she is the runaway Duchess, Meghan, having her own version of Megxit as the Crown deals with another royal bombshell, the latest on this week's most important saga, coming up after the break.
Now here's Miles with a look ahead at what will be making headlines next week.
Well, the labor market just finished off its worst year since 2011. Now, 2019, the economy did add 2.1 million jobs. Still a formidable number and enough to keep recession fears at bay. But 2019 also offered clear evidence that the labor market is slowing down. And although this slowdown has long been forecasted by economists, it is a reminder to investors that the Fed is not likely to have a reason to raise rates anytime soon. And so while the rise in risk assets over the last 6 months has been exasperating to market skeptics, it's really just not all that mysterious. The economy is slowing and the Fed is doing its part to support the expansion in its 11th year. An easier Fed, all else equal, will be good for the stock market, but an economy creating over 2 million jobs a year doesn't suggest a recession is likely. So no recession, but no rate hikes, and then you get higher stock prices, right? Maybe this jobs report wasn't the most exciting piece of data we've gotten over the last few months, but it does help explain kind of the whole story of what's going on in this market and looks likely to be going on in the months ahead. Now turning to the calendar for next week, the unofficial start of earnings season is here. Financials getting the party started. We've got JP Morgan and Wells Fargo out with earnings on Tuesday. Goldman Sachs, Bank of America, and U.S. Bancorp on Wednesday. Morgan Stanley on Thursday, and State Street out with their results on Friday. Other notable companies reporting in the week ahead should include United Health, BlackRock, Delta Airlines, PPG, and Kansas City Southern, among others. Citi on the schedule, although their date is not yet
confirmed.
Floating.
There's a potential for Tuesday. On the economic data side, the December report on retail sales, that's coming out Thursday morning, will be the biggest highlight. Economists expect sales rose 0.3% during the final month of the holiday shopping season. Readings on inflation, consumer sentiment, housing starts, job openings, and the Fed's latest beige book also on the calendar.
Now that's a real
Vacation's
work.
over, guys.
That's a real week.
That's it. The year has started. I got to say, it's a little depressing. I really kind of liked those couple of weeks.
It was like on, off, on,
2 days
off.
working, 1 day off. 2 days working, people not here.
Not a
Things
lot
are
of
more
earnings.
chill. Now it's like work.
You ready for it?
I hope so.
You got all the
I was working
earnings.
from home, like to start the year off, and then U.S.-Iran tensions ramped up, and
I know.
the year gets started.
Those were supposed to be like 2 days of like working from home for you, but then they ended up being like
Like the
actual
busiest
work
days.
Yeah.
Yeah.
Oh, terrible.
Actual work.
That's the worst.
Well, like Miles always wanted to be in the weather business.
Still do.
I would.
I'm still available. If you would like someone who does not have a meteorology degree to read the weather for you, I'm right here.
I always would like to be a royal watcher. I would. I don't have a degree in royals, but
Well, good news for you, Jen.
I did subscribe to Majesty magazine a long time ago. A royal mess. I was 10. A royal mess is continuing to unfold in Buckingham Palace following the surprise statement from Prince Harry and Meghan Markle this week that they would be leaving their senior royal roles. According to multiple reports, Meghan has now left England for Canada, leaving her husband to deal with the public and private fallout of their abrupt announcement. Meanwhile, Buckingham Palace released a statement of its own, saying that the discussions with the Duke and Duchess of Sussex are at an early stage. Queen Elizabeth, Prince Charles, and Prince William have also instructed aides to reach a workable solution for the couple's roles, according to a report from British national news agency Press Association. And that is your royal update. Opinions. Are we still pro Megxit? We were when it happened.
Yeah.
Are we okay?
Sure.
We're okay. Are
I mean,
you okay?
She's going out to make her own money. They trademark, Sussex Royal back in June. It's looking like they're trying to really distance themselves a little bit, just to be mostly for the income side. I mean, really, the earning potential here is probably much more significant than what they'd actually be receiving from the Duchy of Cornwall, where most of their income is coming from right now.
My thing is, like, if they're going to go make their own income, like getting a job or acting, it seems different to me than they're trading in on the royal name. They are making money on.
Yeah, well, how do the other royals make their money?
Well, she
Also
actually,
being
she actually had a job before.
Right.
So I feel like she could go do that job. I think people would hire her. I mean,
sure.
Netflix gave Obama a deal. I'm sure Netflix would give them a deal.
Netflix would
I'm
give
sure
anyone.
agents are just completely all over this already.
Right, but like the trademarking of like the bags, and they have like stationery, Duke and Duchess Sussex. I'm still, they can still go. But
I think
I don't know.
The obvious question is like the future of all royals.
Yeah.
Like, what do being royals look like in 10 years, 20 years, 30 years? I mean, because clearly, Harry's just like, I'm out. Now Meghan says she's out. So
He's like, this is different.
William's going to be the king, but like down the road, if you're not is everyone just going to dip out if they're not going to be the
But
king?
I think that's a very stateside perspective. I think they're a much bigger deal over in the UK, and it's sort of like, the Kardashians for us, which is not a perfect analogy, but, they sort of scratch their heads over the platform that we've given them out here.
Maybe we'll find out if the Trumps start a new royalty here. What? Republicans want Don Jr. and Ivanka to run in 2024. Maybe it won't happen. Coming up, we'll have more on the final round, and we will handicap this weekend's big divisional round games with Yahoo Sports betting expert and host of Mad Bets, Matt Gothard. We're back with that right after this.
back to the final round here on Yahoo Finance. Miles Olin with you in New York. I'm joined as always by my co-host Jen Rogers, also stopping by on this Friday is Yahoo Finance's Emily McCormick. Let's take another look at where we finished the week. We saw all three majors drop on this Friday. We hit record highs during Thursday's session. Jobs report that came in a little bit weaker than expected. Wages, kind of the most negative piece of news here. Though, as we noted earlier, or as Emily noted, kind of a muted reaction to the actual jobs data. Then we started to see a sell-off during today's session. Boeing, biggest loser on the Dow. More negative headlines about the 737 MAX jet. Just a stock story here we haven't talked about during today's show or made enough of so far this year. Beyond Meat shares up again today, up about 6%. Everybody who was betting against that company getting their faces ripped off right now. Obviously, that stock went from a couple $100 a share, finished 2019 around 75, and now I think it's right around $100.
Like the new Tesla. They're both like recovered and everything.
I think Ethan
great.
Brown would love to be the new Tesla.
Yes. I mean, we'll be.
Because that stock also doesn't go down ever.
Yeah, where did Tesla end today?
I'm looking it
Look
up.
it up. Let's see. Maybe we'll
See
see
how
who
fast the
wins.
internet is in here.
We'll see who's faster.
478.
Wow. 478. We're so close
478
to
down
500.
0.7 of
And there's
1%.
Beyond Meat closing back in on 100.
Yep.
So another up day and a down market for Beyond Meat. Let's turn to our top takes. Today's market-moving stories that we're watching. Today, it's all about the December jobs report. I thought it was a little interesting that what you talked about yesterday with the bias and the retail numbers and how numbers were replaced. That kind of got picked up in a couple places, especially because the retail print was so strong, surprisingly.
Well, look, there's nothing worse than like these numbers are going to be revised Twitter, right? Because people come out, they're like, oh, there's margin of error. Like that's bad. But point UBS made, Rob Martin, friend of the program, made in his note earlier this week is that the way the BLS calculates that number is they're assuming a certain growth rate for certain industries, even if firms have closed. Towards the end of the year, you see a lot of family businesses, they just shut down, right? Now, the theory, economic theory, says that other businesses in that sector will absorb that capacity and increase hiring and so on. But the BLS doesn't pick that up on a monthly basis. They tend to pick that up on an annual basis. And so, that's kind of what happened in November with the huge, boost after the manufacturing jobs were inflated because of the GM and all that stuff. But again, I think my big takeaway for this report is just that the labor market is slowing, and we need to just acknowledge that, right? Month-to-month noise is not going to change the story that there's less hiring going on, and I think that has big implications for the Fed, growth trajectory, and where the market kind of thinks this is all headed.
I mean, I still think the biggest metric and probably the most positive metric, and a lot of economists did latch onto this, was that U6 measure of unemployment. I mean, that down to 6.7%, the lowest since data started to be tracked on this back in 1994. So really showing that we are just in such a tight labor market that jobs are firms are continuously saying that finding qualified workers is one of their biggest concerns. That's something that the Fed in their beige book has continuously pointing out, and that's what's continuing to be shown in the data.
The manufacturing employment decline, I just wonder what that's going to mean political. But yes, he had me.
He's very serious.
In his note, he's usually not. He's a lighthearted guy, and his note, I felt like he's very funny. His note was a little bit more positive, but he was making me a little bit nervous about what he's worried about in the next print. And I do think, is the manufacturing sector telling us something? Has it been telling us something for a while? And we have not been listening because there's been so much other noise out there. And in this political environment, what does it mean? So I think that is a key area to continue watching.
Can we just hand wave at the consumer and make it all go away forever? All right, maybe the best NFL weekend of the year coming up. We've got 4 games, 2 tomorrow, 2 on Sunday. Fans and bettors are going to be paying close attention. Here to walk us through the numbers and discuss the big business of sports betting is the host of Yahoo Sports' Mad Bets Show, Matt Gothard. Matt, so before we get into the games, let's just talk very quickly about the industry right now, the changes we've seen, or at least as you've seen them, on kind of the content side of how interested people are in betting now that we've seen the legalization in a number of states. We on this show actually talked about that Bloomberg story of people leaving the city, going to Secaucus, New Jersey to place a bet and then coming back because they need to get their fix.
It's crazy. Those people are stopping on the side of the highway just to place a bet. It's very, very, very exciting. Almost as excited as I am for this weekend of football. But a year and a half ago when the Supreme Court shut down the federal ban, people have been flocking to sports betting. It's almost like fantasy football when that first came out. So it's very exciting to see a new demographic of people getting in on the action, trying to enhance their sports viewing experience. And that's kind of what it's got to be. It's got to always be fun. You're not going to get rich off of it. Think of it like fantasy sports, daily fantasy. That's what sports betting is going to be for the new fan. Very exciting time.
So let's dive into tomorrow's first big game. And I'm from San Francisco, so I am a 49ers fan, if not a Levi's Stadium fan. I don't really like that stadium, but that's okay. Vikings versus Niners. I know there's all sorts of like weird bets you can do and stuff, but just like the who's going to win here and then the line. Am I okay with the Niners?
I don't know. I'm kind of scared of the Niners. Last time we saw them playing, they were inches away from losing to Russell Wilson. And every game that they've had, I feel like in the last couple of weeks, have come down to one possession. So to take away a whole touchdown from them and give it to a team that is clicking in the Minnesota Vikings, I kind of go with the Vikings on this one, especially with a whole touchdown.
And Jimmy G's first playoff game, not know we're going to get there. All right, let's move to Saturday night. I think the most exciting player, everyone wants to see Lamar Jackson suiting up at home, laying 8.5 against the Titans. What do you like here?
This one I think is going to be a very quick game. And when I say that, I mean I think the clock is going to run quickly because both these teams like to run the football. So I'm kind of staying away from the side on this, and I would take the under in this one. I think both teams are going to run it. It's going to be a very, very, very ground-heavy game. I almost would say if you like the Titans somehow, take the first half money line because if a team gets up, if in a low-scoring game, that lead could hold into the second half. So I'd say the under and maybe the Titans first half money line.
Hi, Matt. Admittedly, not the biggest sports buff on the show, but definitely want to get your take on Sunday. So another big home favorite with the Chiefs at home versus the Texans. What's your take on that?
The Texans got the better hand of the Chiefs earlier this year, but Andy Reid's really good at making adjustments. So I look for them and this defense who's playing on another level to take care of business at home. And I think right now, we always say Andy Reid lays an egg in the playoffs. I think that's going to be next week. So I look for the Chiefs to cover this one by 9.5.
Laying the 9.5. You're a braver man than I am. All right, let's finish with the game I think most people have the most confusion over, which is Seahawks traveling to Lambeau. It's unclear if the Packers are good or not. What's your take here? A lot of people that I've heard are staying away.
My wife is a diehard Packers fan, so I'm not going to say that they're not good, but I don't know if they're good enough for me to put my money on this week. This is another one that I'm looking at the under. It's going to be like 20 degrees at game time. That's really cold. So I think that people are going to be betting the over on this with Russell Wilson and Aaron Rodgers. I'm going to be taking the under 46.5.
All right, so we're going the under. Not sure about the points. Packers, that adjusted win-loss was like 9-7, so they might stink. We'll see. Monday night, we got national championship game, Clemson against LSU. I can't believe that LSU is only laying 5.5, and also that the over/under is 69.5. Wild number.
It's insane, and this is another one, and I know I sound like I just like no fun, but I'm taking the under in this one. 69.5 in a national title game. There are going to be some nerves in this for both teams, so I look for them to be a little bit tight coming out, and just one bad quarter. 69.5, definitely going under. And I'd say, just for fun, I'd take the Clemson money line because there's a lot of value in that. LSU is good, but that defense has some holes in it.
As an amateur bettor, I feel like I'm getting 5 free points from LSU there because I would have laid double digits on this one. We were talking right before we came on with our crew here, and I said, the under is the sharp bet, and everyone said I like to bet the over, and you taking the unders, you host a show on this, so I think that's right. The sharps like the under in general. It tends to be the winner.
I don't know if I'd call myself a sharp, but I will definitely take it if everybody's taking the other side.
Hey, I play a finance expert on the internet. You play a sports expert on the internet. We'll count it. You can catch Mad Bets, Yahoo Sports' weekly sports betting show, Saturdays, 2:30 p.m. Eastern on Yahoo Sports, the Yahoo Sports app, Twitter, Facebook, YouTube, and elsewhere. Matt Gothard, thanks for stopping by. We'll talk to you soon.
Hey, Matt, should we bet, I'll take the Niners and you take the other one? Are we allowed to do that in this country? I don't know what jurisdiction I'm in. But anyhow, handshake next week?
Handshake.
All right.
Absolutely.
See you then. Fun.
All right, that's it. We'll see Matt next week. Emily.
Hopefully he'll come back.
Hopefully.
What if I just won the gentleman's bet there with the Niners? I think the Niners are looking good.
Yeah.
Right? No? You guys don't agree? He doesn't agree either. Now I'm getting nervous.
Something smells funny with that game.
It's like Chris Rupke.
Something smells funny.
Yeah. All right.
They're good, but
You're not
really
sure. I think Emily's leaving us.
Emily's leaving us. Emily, have a great weekend.
Thank you, Emily.
Enjoy the Chiefs game on Saturday.
Perfect. Coming up, what's the difference between Chapter 11 and Chapter 7 bankruptcy? Brian Chung explains all in this week's Yahoo U, right after this.
All right, let's take a look at some of today's winners and losers in the stock market. Stocks in the red. KB Home, after the home builder's quarterly revenue fell short of Wall Street forecasts. That stock off about 3% to finish the week. Let's take a look at shares of Urban Outfitters, down about 4% after the retailer reported comp holiday season sales that were up 3%, but revealed that sales fell at its flagship Urban Outfitters locations. Anthropologie, right?
Yeah.
Yeah, Anthropologie doing all right. I know someone who went there for something recently. Can't say what it was.
You got to go to the sales rack. Stocks in the green include Cinex after the technology services firm's fourth quarter earnings beat. Also announced plans to split into two separately publicly traded companies. And Nvidia shares pop after Citi added the chipmaker to its Catalyst watch list and said it expects the company to outperform its peers thanks to improved data center demand and the acquisition of networking products maker Mellanox Technologies. The retail apocalypse struck again this week, with Pier 1 announcing massive store closures and rumors spreading that the company could be headed for bankruptcy. But what will happen if the company actually does go bankrupt? It's time now for Yahoo U with Yahoo Finance's Brian Chung. Take a listen.
Well, class is in session, and today's topic is a little bit of a downer. That's options for bankruptcy. And let's illustrate this with a made-up company. So let's call it Chung Shoes. Again, I manufacture sneakers, and the times are really tough for me. So I declare bankruptcy. And ever since we made that play to buy crosstown rival Chung Shoes, I've been saddled with so much debt, I haven't been able to see the sales that I need to recover the amount of money that I owe. So it's time to work on my bankruptcy filings. Now, there are a few options that we have here, but the two big ones are detailed in Chapters 7 and 11 of the US Bankruptcy Code. So let's unpack a little bit. So first of all, we have Chapter 7, and this is when the liquidation really begins. First off, any outstanding leases get cut off. So the good news is I'll be discharged of the loan balance on the company car, for example, but unfortunately, I also have to give the car up. Now, for companies, this could be huge. So think about other things that I might have leases on. So office space, warehouses, the chief executive's private helicopter, etc. A trustee in this case will also be appointed to then liquidate the rest of Chung Shoe's assets. So things like my trademarks, the intellectual property of my sneaker designs, even the remaining inventory of my sneakers. Now, what happens with the money that the trustee is able to scrap together with those sales? Well, they're paid out to the lenders. So Adam and Julie in this case, probably for less than the principal that you lent to me in the first place, but this is a full wind down. So sorry guys, you're gonna get whatever you can possibly get. Now, if this sounds like complete closing the doors, well, you're right. This is exactly game over. Basically, all the assets are liquidated in a Chapter 7. But what if you want to clear some of your debts, but you want to leave your assets, at least some of it, to have maybe one more shot at a comeback? Well, then you can do a reorganization, or what they call a Chapter 11. And in this case, Chung Shoes would submit a debt repayment plan to the bankruptcy court. So it'd be my plan to pay down all the debts that I'm due, even if I don't have the money right now. So I could say I do some things differently with my business to improve revenue by, let's say, 50% over the next 3 years, and then use that money to pay my creditors. So Chapter 11 means I don't have to sell my house. That means that I don't have my personal assets at risk. So under Chapter 11, as an executive, the only personal assets that I have at risk are the value of the stock that I hold. Now, the same goes for all the other stakeholders in the company, but I do want to mention that this is generally speaking. So in a sole proprietorship, for example, my personal assets actually would be on the line, so it does have something to do with incorporation. But it's important to remember that Chapter 11 is a two-way street with my creditors. So again, Adam and Julie are the ones that I need to pay back in the end. So if they dislike my plan, they say, you're never going to get that revenue up, they could convert this Chapter 11 back to a Chapter 7 and say, you got to close your doors entirely. And in fact, the creditors could actually be the ones to bring me to Chapter 11 in the first place. So it doesn't have to be me deciding that I think Chung Shoes needs to declare bankruptcy. It could be those that actually have stakes in those loans as well. Now, according to the U.S. court system, there were over 773,000 bankruptcy cases filed in the U.S. in 2018. But this also includes personal bankruptcy cases, so it's not just companies. But you'll notice that the majority, that's the purple here, 61%, were Chapter 7, and that's the full closure. And this represents obviously the largest part of this pie chart. Do you notice that only 1%, a little sliver, that's the blue bit, is actually covered under reorganization under Chapter 11. Now, it sounds like Chapter 11 might be the more attractive way to go for bankruptcy because at least it offers a way to bounce back, but it's very difficult to pull off. I mean, imagine that creditors would be skeptical. If my company had poor management to get myself in the hole in the first place, it'd be hard to see how the same management could get it out. It is important to note, though, that there have been success stories in the past. So think about 1996, Marvel. That small comic book company, they actually climbed out of Chapter 11. And then there's also all the major airline carriers. So United filed for Chapter 11 in 2002, Delta in 2005, and also American Airlines in 2011. So guys, a lot of different options here for Chung Shoes. Whether or not you guys will get your money back in whole, a different question there.
Reminds me of the famous Richard Branson quote, how does a billionaire become a millionaire? Buy an airline.
Oh, I thought it was open a winery.
No.
That's an expression in Napa
I mean,
Valley.
winery is another one. Yeah, you could do the Wine Cave fundraiser. That's sort of like the 100 millionaire, though, right? You know, billionaires buy airlines. All right, coming up here after the break, we'll have what you missed today on Yahoo Finance.
Process.
for all the best moments that you missed today right here on Yahoo Finance.
Wages missed expectations a little bit as well. Average hourly earnings rose by 3 cents to $28.32. That's a 0.1% increase month over month and a 2.9% increase year over year. Economists were hoping to see a 3.1% increase year over year.
It's pretty close to a Teflon market, but keep in mind that that is what the Fed has created by really communicating in, I think, very, very clear terms that the bar is very high on raising rates.
I just want to quickly go to Inez because, again, we've hit records again on the major averages. Inez has got her 29,000 hat on.
I do.
But again, this is really sort of a disconnect, Inez. It's kind of fascinating.
If you look right now the Dow is just a few handles below it, but we had hit 29K just a few minutes ago. And Pete Tuchman has these made, and these are made. This is a quick turnaround.
This is another Goldilocks report. Neither too hot, neither too cold. And it just occurred to me, Donald Trump is benefiting from this jobs report. He'll take credit for this jobs report. And my gosh, if you think about his hair color, it pretty much matches Goldilocks.
If you go back to the summer, we had worries about a downturn. We had an inverted yield curve. We had all the trade concerns. And with all that said, in the last 3 months, the average monthly job growth has been 184,000. So perhaps a little bit weaker in the month of December, but I think it's important to look at that 3-month average. 184,000, to me, that is still a pretty strong labor market.
A lot of jobs are being lost, and so a lot of the data that people are focusing on is looking at job growth, but when you back out the M&A, we had less than 1% job growth in the S&P 500.
What do you think that today's jobs numbers do for your outlook?
So first of all, let me say hi to Rick. I'm getting a campaign flashback. We did some really good work back there during the campaign, and I think every time I said we were going to grow over 2%, you kind of looked at me a little askance.
Yeah.
Well, that's going to do it for us. Let's take a final look at where the market's finished. You saw Inez wearing the hat there, 29,000.
So many points ago.
So many. Dow down 133 points. Boeing, obviously a decliner there, but you have noted Beyond Meat continues to soar.
That's right. Yeah, and you know what? 2019, big year for deals and all that, IPOs, but 2020 starting right up. Casper filing for its S1. Recode reporting Penn National might be buying Barstool Sports. Look at all this stuff that's still happening out there in the world.
Maybe we'll get a merger Monday.
Maybe.
Who knows? That's all for now from New York. I'm Jen Rogers with Miles Udland, and this is the final round on Yahoo Finance.